Greetings, traders. It is I, Abdul Shabazz, and this is some real change stock options trading journey. And today is terrific Tuesday, November the 25th. My plans are as follows. I like a call at the 670 area, possibly see that to 671, possibly 672, and that is what I'm looking at. That is what I have here on my chart as well. You can clearly see the area as I have crayons here. I like to take a call possibly above the 670 area, looking for profits at 671, 672, and if the market decides to come down, then I'm interested in a put, but I'm not interested in a put until or if we break below the 6661 area. Then I'm interested in a 6664 and then possibly a 6627. I'm not in love with the market today, guys. And I love the market, but I'm not in love with the market today. Not yet. We do have some limitations. We'll see what happens. Keep in mind it's going to be a short week. We do have some 10 o'clock news coming out. But yesterday we called out that 6692 profit target area. And she hit that and just went straight sideways. With a short week coming up, I'm definitely going to be looking for A+ setups today. I will be doing my best to look for the best setups because I'm just not in love with where the market is positioned. And you could probably see that a little bit better. You could probably see that a little bit better on the daily chart. If you look at your daily chart, you will see that we still are inside. So still an inside bar inside this beautiful bearish candle that took place a couple days ago. And right now we're still trading inside of it. There is a lot of liquidity that can still be squeezed out of these bears. But you can also expect them to defend it all the way to the very end. With us having a short week, I don't know if we're going to be able to successfully overrun these bears or not. It's going to depend upon the volume today, who shows up. Today may very well be a no trade day for me. I'm not here to prove I'm smart. I'm here to make money. And I just don't like the positioning right now. We'll see what happens when market open. But I just wanted to show you guys where we are right now. If you have any thoughts, opinions, please feel free to put them in the chat as the chat is open. Shout out to Team Kick, who has been real consistent with joining us and showing up every day. And of course, to some real change teammates who have really been stepping their trading up. I really want to take my hats off to some of you and you know who you are. You have really been stepping your trading up. You have very clear focus. You know what you want to accomplish, and you are taking the steps to accomplish that. So I just want to take a moment to salute those outstanding team members of ours who are really striving for excellence. Please keep it up. Please keep it up. Give me 1 second and I'll get to the chat. Until then, grateful day to everyone. I am grateful for this day, which is why I like to say grateful day. People say, how you doing? I said, better than I deserve. Alhamdulillah. Alrighty, as we begin today, keep in mind you don't have to trade, but you do have to follow your rules. Following our rules is what makes us money. As we begin today, A'udhu billahi minash shaitanir rajim. Bismillah. And let us begin. Let's see what happens. As always, you already know what type of program I'm on. One thing is, two things for certain. One thing for sure, you ain't got to worry about me taking a trade before 10 o'clock. That's just not going to happen. It's not going to happen. It's not going to happen. And I'm so grateful to finally have gotten to that. If there has been one thing, well, it's been many things, but if I have to say the beginning, of what has turned around my trading is the institution of patience. The institution of patience. Instituting patience in everything I do now. First 5 minutes are very volatile. First 15 minutes can trick you. Have you thinking the market is going one way and then completely go in another direction. Allow the markets some time to reveal what it is thinking. And once it does that, it makes it easier for us to pick the market apart. Big shout out to the team. See what everybody is thinking this morning. Dr. JB is in the building. Let's have another great day. Quiet Soul is in the building. MYM is in the building. Dr. J is in the building. Vernon Mitchell is in the building. Todd Macon is in the building. Big Ben is in the building. And Kosi is in the building. And Brooke Sanchez is in the building. These are the active traders. We do want to acknowledge those of you who are tuning in, but just in the background watching. We're grateful for you as well as for those of you who watch the replay. We are also grateful for you as well, and we look forward to the day when you join us here live trading in person. We look forward to that. Todd says, no plans. I'm expecting some chop. I'll be back Monday next week. Everyone, please have a safe and wonderful holiday. That's exactly what I was talking about. I was like, I'm not in love with. I'm in love with the market. I'm just not in love with the position the market is in right now on a short week. So, but the market always yields us opportunities to make some profit. Wow. Right to my area, coming up on it closely. Dr. JB, that 5 is still under the 20, but the Bears are making a move. I'm kind of leaning a little bit towards that 670. Brooks, what are you thinking? Big Ben, what are you thinking? And Kosi, what are you thinking? Todd Macon, what are you thinking? It'll be a very interesting day. If you don't mind, I'm going to go ahead and get Dr. JB on the phone here. Again, right to my area, that's 670. And came right down. That is the area that I want to take a trade at. Coming into the day, I shared my plans with you guys. Just for a quick refresher, I like that 668 call. Want to get in at the 670 area. Market did come hit the 670 area, but it did reject from there. So all I will do now is reset my alarm. Reset my alarm and be patient. What happened? That's a beauty right there. That's a thing of beauty right there. But I ain't fooling with it. But that's a thing of beauty right there. Very interesting. Very interesting. Wow. Wow, wow, wow. Almost like an early short right there. I'm not locked in on that though. And Cozy said I have a long bias at the moment, but he's not locked in on it. Alrighty. Thank you for sharing. Anybody else have any thoughts they'd like to share this morning? This might yield a nice early opportunity. I see an early morning short. Wow, wow, wow. Could have shorted. I used that 670 as your risk. I love it. Does anybody know what the relative volume is right now? Let's check that. Oh no. Oh no. Abdul will not be trading this. Nobody's here. I'm gonna go have me a cuppa and wait till 10 o'clock like I always do. But man, I can't help but see it though. Once you see it, you can't unsee it. I see a very nice early short potential. You know what I'm saying? I'm just glad I don't trade early. I seen it. Once you see it, you cannot unsee it. Wow, wow, wow. Wow, wow, wow. I said it too. I said, wow. I see an early short opportunity off the 670. Using the 670 as your risk. And just that fast, she's down to 668. Amazing. I can only wish I'd have got in it earlier. But nah, I'm still, focused on my discipline. I'm just happy the market is moving. Oh, gone it. As she approaches my area of trade, I just see an opportunity where I could have got in it earlier. I'm interested in a put below the 66610 as I told you guys, but she got to make her way down there. It's a $3 drop just to get there. And I see the writing on the wall. Right to my interest area. She touched it and bounced right off of it. I'm cool. I'm still waiting till 10 o'clock. It's just exciting to see this action happening right now. You know the area, you just can't control when it's going to happen. Sometimes it happens sometimes it happens before my preferred time. I can't help that. And sometimes I see things that are opportunities. I can't help that as well. But plans are made before the market opens. And once the market opens, there are opportunities that do present itself. This is a $2 drop 5 minutes. That 5-minute candle was a $2 drop. Incredible. Incredible. I'd have been up. All righty, good job. Ben said he just scalped that put. Pretty work, Ben. Oh man, it's hurting me. It was a beautiful, beautiful green to red move. Ooh wee. Wow. Now, I ain't gonna lie, it's not easy being disciplined now. I'm only flesh and blood. I'm glad somebody, was bold enough to take that early put, because man, I saw it coming very, very early. I saw this put coming very early. Wow, wow, wow. Wow. From the 670 down to the 6665. That was crazy. Already at my area again. Wow. Is anybody looking at that 668 put? What that 668 put is doing? You see how sick I am. Bananas. So this move is up 200% already. Incredible. Incredible. Wow, what a move. Anybody else profit off of that? Kudos to you if you profited off of that move. I called out the 6661 all the way down to the 6645. And she is marching right there and just hit it. First profit target just hit while I'm on the sidelines. And that 668 right now is at $4. Over 300% move. Incredible. Incredible. Wow, what an amazing trade. Look at this. This is a washout long, possibly setting up. Looking at that 15-minute chart, bottom left. What a move. What a move. Man, I gotta be patient. Look at that beautiful, wow, red to green move by the Bulls. Man, these Bears are about to get squeezed. I want to get in a call right now so bad, but I'm not. I understand the assignment. I'm being patient. Resetting my alarm back from my entry area back where I want it to be at the 66610. I'm tired already just from looking at this. I'm already exhausted. crazy. Got a little bit of 10 o'clock news coming out. Just the benefit of waiting, man. It's just the benefit of waiting. Doggone, I wish I could have scalped that. That call would have been a good scalp. Still on the sideline. What a move in both directions. What a move in both directions. The trend is now getting ready to come. You always have to identify one of three phases the market is in. The first phase coming into market open was contraction phase. You can see that by the low volume, also the range, the small body candles, mostly sideways. And then comes the expansion phase, which is designed to take out both bulls and bears. Take out the recent highs, take out the recent lows. And this is when institutional starts accumulating shares and starts putting a squeeze on somebody. After that, the trend will come. So that's what we want to make our money, is going to be in the trend phase. I am being and remaining patient. My plans are still intact. I like a call above the 670, and I like a put below the 666.10. Showing right here on TradingView. The first profit target was hit on that put. Okay, that did take place, as the first profit target was the 6664. From the 6661 all the way down to the 6645. That trade did work. We hit that 6645 and bounced from there, and have been bouncing ever since. Very strong. Alarms have been put back in place. 2 minutes of the 10 o'clock hour. I ain't know Vernon took a trade. I just scalped it out with 81% profit. I was feeling stressed mentally. Something I need to work on. I'm done. Made about 70% of my week check. My day is coming. Yes, sir, it is, Vernon. What did you trade though, Vernon? Did you take a call? Did you take a put? What did you do? How did you trade that? Again, me being tempted on both directions before 10 o'clock. What can you do? But again, keep in mind, this is a bullish week, and the bulls do have control of the week. Glad you was able to take advantage of that. Let me go ahead and identify this control buying algo that we do have. Alrighty, 10 o'clock has finally got here. Now I need a break. I need a break after that 10 o'clock. Interesting. This is very interesting. Very interesting. That 10 o'clock report. This is reaction to that. It's never the news, it's the reaction to the news. It's coming back down on my entry, but I don't like the way this is looking. So I will not be taking this trade right now. I have no problem telling you guys I plan to wait a little longer. I don't like any of this. Okay, cool. You got in at 6682, got out at 6653. Beautiful work, buddy. Yes, sir. What a beautiful retirement you're going to have, sir. What a beautiful retirement. Shout out to Vernon Mitchell. Great journey today. Right back to my desired area, but we're very extended, less than 30 seconds left on this 5-minute candle. So I'm going to be patient and see if we get a close below this area and see if the next candle then is a continuation candle. But you know how important this 666 area is, which is why I liked my put underneath it from the very beginning, which is why I wanted to wait until this area before I got in a put. Reset my alarm. Again, I said from the very beginning, I didn't like the day. I didn't like how we were trading. Of course, the market still yields an opportunity to make some profit, as our teammate did. I saw it myself, but I let my rules override what I saw and decided to wait until 10 o'clock, where now nothing's happening. It's trading. What can you do? Waiting is trading. Now is a great time to have a cup of Brooke Sanchez. You on here? Say yes, I haven't taken a trade yet, team. Waiting for the rest of the ORB to see if it stays in the ORB or if it rejects it. At that point, I'll be looking for a put. Alrighty, sounds great. Dr. JB, have you taken a trade yet? Talk to me now. Yep, I'm just gonna wait a little bit longer. Amazing. Yep, I said it from the very beginning. This might be a no trade day for me, and I'm okay with that. I'm perfectly okay with that. I can't move as freely and as liberal as I want to because I know I have people who watch me and who are trying to learn, and I don't want them to follow me into a quick scout move if they really don't understand why it is or the basis of it, which is why I create my trading plans and do my best to stick to those plans so that people can see the area that I want to trade and understand that I'm just waiting for that area to happen before I do take a trade. This is some crazy work that's going on right now. Look at this is some crazy work that's going on right now. Look at the two candles. Look at the 30-minute. Look at the 30-minute chart. Look at the two candles we have. Our opening candles on the 30-minute chart. There's some crazy work going on right now. If you made some money in this, you a bad man. You a bad man. Tip my hat to you. If you being patient, you are as excellent as well. Shout out to you and for everybody else for being patient. As I stated coming into the market today, I didn't like where we were positioned, along with this being a short week. So, alrighty, thank you, Vernon, for stopping by. Enjoy your week. We look forward to seeing you Monday, God willing. Yeah, I don't really like this, guys. I'm gonna just go ahead, fall to the background, wait and see if my alarm goes off, and see if and how I feel about the setup if one presents itself in that area. Got news up on the left here. I know, right? Laying in the cut with a couple of quiet souls said. I know, right? Alrighty. Again, shout out to the Kick team who keeps on checking in with us, and the Kick is growing. And the next best thing to trading well is knowing when not to trade at all. Let's go ahead and stretch this 15-minute chart out to include just today and yesterday's work. For those who are new to the channel, top right is the daily chart. The bottom right is the weekly chart. The bottom middle is the 30-minute chart. To the left is the 15-minute chart. Above that is the 2-minute. And in the middle is the 5-minute, which we primarily look for setups off of. I think it's very well to have a different view of the same instrument to get a different perspective when you need to. And for now, because of all of this sideways chop, what I'm going to do now is go ahead and eliminate pre-market. Kick, oh, absolutely, man. We love to have you on the Kick team, MYM, most definitely. Just go ahead and head on over to Kick, and we're some real change on Kick. Some underscore real underscore change on Kick. It's a beautiful spot. And we'll be doing a lot more behind the scenes stuff on Kick as well. So thank you for even being interested to support us there as well. We do appreciate that. All right, let's go ahead and eliminate pre-market, get pre-market out of the way. We don't really need it. Now let's look. Now I like this view right here. And I just messed it up. Okay, give me a second. Let me get it back. All right. This is the view that I want to talk about. Give me right to there. Okay. All right. Coming into the day, here we are right here, Tuesday. This is why I do not like this, because the true points is the 650 and the 675. Okay? Once we hit that 650, there was money to be made, as we made beautiful money even yesterday, taking nice calls. Okay? But now we have plateaued. We've plateaued and we're stuck here in the middle. The Bulls have overall control of the week. The Bears have been on a run from the 675 down, but the Bulls have now reclaimed a little bit more momentum, but not enough yet to get over that 670. The 670 is key in causing the remaining Bears to cover, but will it happen today? Will it happen this week on a short week? Knowing these different variables, I was not excited about coming into today because the excitement died off actually after I got out of my trade yesterday here closer to 1 o'clock. We've been flat, including post-market, including pre-market. We do have a control buying algo that I did identify here, and I will make it just a little darker. Right there, we do have a controlled buying algo. But there is still a lot of overhead resistance coming down from that 675. So I'm just going to be patient. I still like a call above 670, which is what I've stated, and what I've also shown you here on my TradingView chart. And I still like a put below the 666 area, as I've also shown you here on the TradingView chart. Now, a move has taken place earlier this morning, but I did not participate in it because it took place earlier than I like to trade, and my rules are more important to me. My rules are more important to me. It is my rules that makes me money. But this is the view I want you guys to really see right now, especially with yesterday. You can see how we're really in the middle of the 670 and the middle of the 666. So I don't like it. I don't like anything right now. I still like my plans, but I'm not a fan of the movement of the market right now. And to me, it seems like, for the way I trade, for now, a no trade day. And I'm perfectly cool with that. We've been having phenomenal day after day after day, but understanding where the places are in the market that I like to trade. Profit taking areas and stop out areas. Profit taking areas and stop out areas. I like to look for someone to be in trouble and now they want to cover their position, or someone is up and they want to now put the money in their pockets by selling their position. Anything in the middle is choppy. This week volume that we're having is not giving us the follow through that I like. Don't get me wrong, it was a beautiful put right out of the gate. I can't wait to go back and look at the replay. I believe I called that put first, 6 minutes. 6 minutes, 7 minutes, I was calling a put. But I don't trade till after 10. That's all I got. The chat is open. Kick, the chat is open. Some real change. Team, the chat is open. I'm going to go grab me a cuppa. That's all I can do right now. But I wanted you guys to see this so you can see why I'm not really excited about today. If I end today with no trade, so be it. I'm going to go with this view from yesterday and today. We're also going to put up the news. Top right corner. Top left corner. Might even put up a little CNBC. See what they talking about.
A fresh start.
What does Foot Locker help in terms of your business? Does it help with vendors, and how do you turn it around?
Well, we'll definitely turn it around. We are extremely confident in the ability to turn this around and the plans that we've got. We've got all the vendors that we've talked to are really supportive of what we're doing with Foot Locker, and they want a strong, vibrant, growing Foot Locker. It's not only good for our business, but it's good for their business also.
Did you pay too much for Foot Locker?
I don't think so.
Why not?
Because I think when we take a look at the value creation that we can do with Foot Locker, what we think the sales can go to and what the margin rates can go to, and the low-hanging fruit there, I think we'll find that as 26 and 27 and 28 go on, we'll come back here and you'll say it was a great deal.
Well, given your track record, I certainly wouldn't doubt it, but what gives you this confidence?
when we take a look at what Foot Locker really got kind of lost retail 101, and they didn't move quickly enough when Nike pivoted from a DT to a DTC standpoint. So they didn't move quick enough to move with other brands and really kind of try to offset that. And right now, Nike's back fully engaged in Foot Locker, so is Hoka, on what the ability of us to do, be able to reinvent the stores from a merchandising standpoint. We are extremely confident. We've just started an 11-store test. Now, it's only 11 stores, but an 11-store test, we took all the product out and changed the way we present it in the stores. And if you walked into Foot Locker right now in the majority of the stores and you looked at the wall, it's basically merely a run-on sentence of shoes. You don't walk in, you don't see anything that's really important. We're not really communicating to the consumer what's important, what the hot shoe is, and we've changed that in these 11 stores. And we at Dick's we're pretty good from a merchandising standpoint. We can bring that merchandising expertise to Foot Locker.
Yeah, no, I mean, Jim was mentioning it, Jim Cramer this morning, as his mad dash, because he said otherwise, given your guidance especially, the stock should be up.
Right.
Do you think that it is largely because of those comp store sales declines that people saw at Foot Locker, the stock is actually down this morning?
Absolutely. I think they're just concerned about what's going to happen. Like I said, we couldn't be more confident about Foot Locker. We couldn't be more confident that we're making the right decisions to kind of, as we say, clean out the garage right now, do it one time, and not have death by 1,000 cuts, so to speak. So we're getting it all done, the vast majority of it done between the third quarter and the fourth quarter, and we'll have a fresh start in 2026. And we think there'll be a real inflection point for back to school, which will be the first year that we have bought all the product, laid out all the product, did all the purchasing of it. And another thing that gives us a tremendous amount of confidence is Foot Locker really, I don't know if they kind of exited the apparel business. When you go into a Foot Locker store, there's not much apparel there anymore. These 11 stores that we've done, re-merchandise those. You'll see a lot more apparel in there. The apparel's doing really well, and we see a lot of nuggets here that will change this business around, and we'll do it pretty quickly.
Is it a legitimate concern that you finished cleaning the garage just in time for the employment backdrop to weaken? We've already seen these confidence numbers come in pretty soft.
Yeah, I think we're doing exactly what we're supposed to do when we're supposed to do it. And the consumer out there, whether it's in the Dick's business or in the Foot Locker business, what they really want is if there's product that's new, innovative, that they feel are going to help them perform better, look better, that new product is selling really well. If it's old product that's been around for a while, it's not selling as well. And that's the one thing that Foot Locker doesn't have right now. They don't have all of that new product in there that they need to have. And by the time we get to the third quarter, we'll have that product in there.
How much of that new product is Nike? Is the turnaround really happening?
We think Nike, we're really excited about the Nike business. Our relationship with Nike's never been better. I think if you talk to Nike, they would say their relationship with us has never been better. And we
a lot of work was put in when Elliott came back. But do they have the styles that get the top shelf space and get people coming in?
They're moving in that direction. If you take a look at the running construct, what they did with Pegasus, what they did with Vomero, what they did with Structure, this running construct is done extremely well on the Dick's side, and where it's been put into Foot Locker store, it's done really well there too.
What about Under Armour? Any hope for a turnaround there?
Yeah, I think that we're working with Under Armour, and I think with Kevin back right now and what they're doing, I think there's we're seeing some green shoots with Under Armour.
But there's fierce competition. I mean, we covered On Running, for instance. We have the CEO on. They continue to sort of defy, first of all, what's happening in the overall market, but with prices, higher prices. I mean, even tariffs, they're not concerned, and they're taking price.
Yeah, I think this is where, when I said that the consumer out there wants products that are new and different and innovative, and if they've got that, the price, I won't say it's not an issue, but they'll pay for that product that's new and innovative. And On's done a great job with that product.
How's House of Sport doing? My kids are obsessed with this. Do you know about this?
I don't.
Giant store. I mean, giant for New York City. It's right over on the Holland Tunnel in New Jersey. Yeah. That's not even probably one of your bigger ones.
It's not. So that's 87,000 square feet, and the House of Sport stores are somewhere between 120 and 150,000 square feet. A lot of them have a field right next to it, so it's really interactive. So we've got kids who'll come and practice. Right now in the northern stores, we've turned it into a half sheet of ice so that kids are coming to practice hockey there. We've got a community skate. the House of Sport concept has been a home run for us.
Well, are those stores more profitable, or is it about just bringing in consumers young?
No, they're very profitable. So we tested these stores and make sure that they're profitable, and they're a profit machine. They've been really great.
Okay, there you can do the climbing wall.
There's David right there.
Yeah, there's right.
Yeah, Carl, you and David could race to the top of the wall.
Sounds great. Yeah, that was the.
I'll time them.
There goes our Achilles heel.
Yeah, maybe 30 years ago.
Thank you, Ed. It's good to have you here.
Great, thank you for having me.
Ed Stack, Executive Chair at Dick's.
Still to come this morning, the future of the AI trade as Alphabet hits record highs, looks to try to become the new king of the hill. Plus, what is hitting Oracle shares again in early trading today? This is now a 5-month low, back to 190, trying to defend levels that we saw at the end of last week. Later on, Thanksgiving travel expected to smash some records this year, just weeks after the shutdown strained those air traffic operations across the country. The CEO of newly listed Aeromexico will join us with a read on demand.
Time for a CNBC News update. Seema Modi has that for us. Seema.
David, Hamas says it will hand over the body of a hostage to the Red Cross today as a fragile ceasefire in Gaza holds. The group has released the remains of 25 hostages since the U.S. brokered peace deal took effect on October 10th. 3 there are still believed to be in Gaza. Hamas says the return of remains has been delayed by the heavy damage to the enclave. At least 7 people died in Russian attacks overnight in Ukraine's capital city, Kyiv. The strikes took place as high-level talks about the framework of a peace deal take place to end the nearly 4-year conflict. The U.S. is holding meetings today with a Russian delegation in Abu Dhabi as President Trump pressures Ukraine to endorse a U.S.-backed proposal by Thanksgiving. And Paris prosecutors announcing the arrest of 4 more people in connection to the theft of crown jewels at the Louvre. 4 others are already charged in the case. Prosecutors say the group took part in the daylight robbery at the world's most visited museum. The stolen jewels have not been located. Carl?
Seema, thanks. Seema Modi. After the break, the fate of the AI arms race. We're going to check in with one former Google manager and AI expert about the state of play as Alphabet climbs and NVIDIA pulls back. Get a quick check on Bitcoin this morning. Under pressure again. Still on pace for the worst month since 2022. Squawk on the Streets back in a minute.
Return Pro is one of the largest reverse logistics companies on the planet. We handle returns for some of the largest companies. Our mission is basically to solve returns. We do this in 3 basic ways: SaaS, supply chain, or e-commerce. And the goal, of course, is always to get the highest recovery for the product and to put 100% of it back on the original channel it came from. It's a double-edged sword. I think product shortages in the short term are very good for our business because people are going to come looking for this inventory. What we're hoping for is just to see a huge onshoring of inventory to augment the holiday inventory shortage, so we can see that inventory being sold and the returns coming back. But if that doesn't happen, obviously there's going to be a shortage. Typically, our kind of returns Super Bowl is around January, February, March. But it starts around the holiday season. Even back to school, there's a rush, then there's a little break of about a month. When you think about tariffs and how they affect it, it all depends on how much kind of under ordering the retailers did and how big that tranche of returns is going to be. And that's dependent on the economy itself. I can't predict it, but I'm assuming we're going to have a pretty good holiday season.
Welcome back. Alphabet getting closer to that $4 trillion market cap milestone this morning. Of course, continued flow of news about its AI business. The information also reporting yesterday that Meta is in talks to spend billions on Google's TPU chips. That's a move that would potentially at least threaten some of the buying that Meta does for, of course, the main chip supplier in the world, NVIDIA. Joining us now, XIA, CEO of AI consulting firm Malo Santo, also a former global strategy lead for responsible innovation at Google. First of all, just let me get your take on Gemini 3, which seems to have certainly captured the imagination of many investors and performed quite well on all those benchmarks that all you AI people do to sort of get a sense for that latest model. What are your thoughts?
Yeah, 100%. So I will say, first of all, that Gemini was state of the art up until last night. In the AI race, we are seeing models go ahead within 48 hours where they're taking over each other. And last night, Claude Opus 4.5 was just released, which actually outperforms Gemini 3 on benchmarks. Now, Gemini 3 was such a huge release because it made massive leaps in its ability to do coding and its ability to do reasoning. Massive leaps, like over 10% on some of the benchmarks in ways that we did not think we were going to see for quite a while. And last night, Claude Opus just leapfrogged Gemini on that as well. And so what we're seeing here fundamentally in the AI race, at least amongst American companies, is that we're moving away from the race being just about raw intelligence of models. What we're seeing these companies do is start to optimize their AI models for agentic use, meaning that they are optimizing their large language models to be able to be used inside of different systems to be able to go execute tasks on behalf of a human. And so because of that, we're not seeing as many of the flashy headlines like, hey, the AI is smarter than a doctor. What we're seeing is, hey, this AI is able to build an app on its own much more efficiently than the previous iteration of this AI model. And so we're seeing across the board, from the technology itself to the way that competition is playing out, a shift away from, once again, raw intelligence into this idea of AI-powered ecosystems to determine who the winner will be.
Yeah, and that may have been what captured so many people's, again, imagination with Gemini 3, looking at that agentic use and the potential for its use in the enterprise. Because, of course, as we discuss ad nauseum here, it's all about what is the return going to be for all of the spending that's taken place. So was this a leap in terms of how you could view the use of these tools in the enterprise, potentially replacing people, but certainly introducing real efficiencies and productivity?
Yes, 100%. I think that these agentic systems that are coming out now are still very nascent. They're still very new. These agentic systems, as they're being built, are now going out into different modes, or how do I say this? They're going out into different verticals and being able to do specific tasks there. So while you might have one, let's say, coding agent, that coding agent deployed in a scientific environment is going to look very different than when it's deployed inside of a web development environment, right? And so being able to generalize across those, which is what effectively Gemini 3 did against the SWE benchmark, the software engineering benchmark, is it made a model that was so good that it could be applied across all of these different contexts to bring applications to life in domain. And so the fact that Claude Opus, just a week and a half later, has jumped that speaks volumes to where we're actually headed with artificial intelligence. Now, I think on the workflow side, in terms of are we replacing workers, what's this mean for the workforce, and how's this going to impact labor moving forward? We see a lot of harrowing news reports coming out saying things like 20 to 25% of new grads are not going to be able to get jobs. We also see things like the MIT study that says, hey, we're failing at enterprise adoption of AI, or there isn't much ROI there. I think what we're actually in is in a shift of the way that work looks, where it's going to move away from one individual executing a series of tasks on their own to an individual organic human being augmented by a team of synthetic humans, or what we're calling agents, to be able to execute tasks on their behalf so that they can get more work done within a smaller span of time. And I think everyone's agents will be more customized to themselves. So your agent for sending email, for example, will be very different than my agent for sending email. Your agent for completing tasks or coding will be very different than the way my coding agent looks. And I think that's the future where we're headed to more immediately, where you're going to see like that old age adage where it's not going to be a person that replaces, or AI that replaces you, it's going to be a person using AI. I think this is the context where we start to see that come to life, where it's going to be a person with a team of agents making things fully automated.
It's a very helpful and good way to put it. My question is just when. Like, when does the enterprise adoption really kick into full gear and does it meet the expectations that it needs to compensate, for all of this spending that these companies are doing? Is it a 2-year story? Is it a 3-year story? Is it longer? Because if it's longer, then the market might have a problem with that.
Yeah, so working in Google Research, one thing that I found is when you are building production products on top of research, if it's not one thing, it's another. As soon as you solve a problem, another one comes up. And so I think we all have to remember that this technology is a research technology. It is still very new, very nascent, very novel, that's being developed at the speed of market and being rolled out very quickly. But hasn't had time yet enough in the market or within companies to saturate and to mature, because the technology in and of itself is evolving as we're adopting it. And so again, if we're just now getting to like an 80% on the SWE benchmark, right, out of 100% to make it operate as human-like as possible, then we're not 80% going to capture those returns in day-to-day SWE engineering tasks, because the technology is still not developed. So the question of how soon until all of these companies are able to recapture that value is also a question for the research labs at all of these companies. How quickly can you advance this technology to where it can produce more meaningful results within actual work context, not just on the benchmarks that they're tested against? Because again, you can have a model that is the best at benchmarks, but is bad at real world tasks, right? Mm-hmm. And so benchmarks are just tests. They just tell you how well the model performs against a standardized test. The same way the SAT gives you a general sense for an applicant when they're trying to go into college, but it won't tell you how well that student will do with stress in physics 4A, right? Similarly, the benchmarks won't tell you how these AI models might operate in a unique, highly regulated environment like a financial environment where data has to be secured a certain way with unique edge and corner cases. And so I think chicken and the egg problem here, how quickly will we be able to make AI meaningful, depends on how quickly we're able to develop it to be used meaningfully.
Can you address just briefly on the ROI conversation, more generally, the degree of the competitive threat from the Chinese using open source either on a cost basis, or does their competition or incremental competition change our discussion about depreciation, for example?
Yeah, so I think two things. One, the war between the US and China on AI is not necessarily about quality of AI the war between the US and China, the AI race that we're fighting right now, is ultimately a battle of two different approaches, right? China's key approach is around community, where they're open sourcing all their models, which means they take the code, they put the code out there on the internet for anyone in the world to view, to take, to run on their local computers, to improve, and can contribute back to that AI model set. In the US, we tend to keep our best models locked up inside of intellectual property, where we open source somewhat of the lower tiered capability models. And so fundamentally, because there is a different approach of development, it will always appear as though China is maybe outpacing the US, because they're inherently going to move faster. Everything is open for everyone to view, so they're going to have a faster rate of development. But as we see with Gemini 3, faster development doesn't necessarily mean higher quality. Gemini 3's state-of-the-art model was developed completely closed within Google and Alphabet's ecosystem and outperforms every single open source model that China has released over the last 6 months. And so I want to caution all of the viewers here to not get too afraid when you see that next headline come out that maybe a Chinese model has superseded Claude or Gemini. That's going to continue to happen over the next year at least, where it's going to be a constant head-to-head race. However, what that means for our battle with China is it means that we're going to two things. One, that we're going to now become more vertically integrated and less dependent on their ecosystem. So what we see with Meta starting to purchase TPUs from Google instead of NVIDIA, reducing that reliance on chips that require foreign manufacturing parts to be able to come in, but also with our models remaining closed source, that means that there's going to be an inherent competitive advantage for the adoption within the enterprise. Using open source models is great until you hack into an open source model. And a lot of these major corporations are not going to want to put some technology where anyone can see how it operates into their secure business operating environment with all their intellectual property. So that war really just depends on it's a war between profit and quality, and we're going to see how it unfolds in the next 2 years. But speed does not always dictate quality, as we can see with China's open source pace is not outpacing the quality of American models.
All right, X, we got to leave it there for now, but really fascinating. Look forward to continuing the discussion over the next couple of years, of course, as we continue to focus on this race. Thank you.
Yeah, looking forward to it. Thank you for having me.
Speaking of AI, check out the move right now in Oracle, continuing to decline as credit concerns grow there, with shares now more than 40% off their recent highs. We'll talk about it next. Stay with us.
Have AI valuation fears and recent market volatility become too much of a headache? One trader has a strategy on how to be AI immune. Tune into our Market Navigator segment later on today on Power Lunch to see what kinds of stocks are part of that portfolio, 2 p.m. Eastern Time.
Welcome back. We're over 30 minutes into the hour. Here are three big movers we're watching. Alibaba under pressure despite a revenue beat driven by strength in the cloud computing business, with the CEO calling out, quote, robust AI demand. In the release, the company now plans to invest around $52 billion into AI technology in the next 3 years. Meantime, Keysight Technology at the top of the S&P right now on the heels of a top and bottom line beat. Strong guidance as well from the electronic equipment maker, all driven by strong demand for its AI data center testing products. And then more pressure for Oracle today amid these growing concerns about the company's borrowing. The information out with the headline this morning titled, Oracle-linked borrowing binge worries lenders, something we've been talking about for a while there. We saw the move up in credit default spreads widening on concerns that the borrowing binge, right, will ultimately weigh on balance sheet and the financials of a company like Oracle.
Yeah, all those shares well off the session lows this morning. Still to come, the CEO of newly listed Aeromexico with his read on demand and any lingering shutdown hangovers for the airlines ahead of what could be one of the busiest days in TSA history. When we're back in a moment. Apollo-backed Aeromexico completing its return trip to the public markets nearly 4 years after it exited bankruptcy. The airline's debut comes as the Trump administration pursues a crackdown against some Mexican airlines, citing competition issues. Joining us this morning here at Post 9 is Aeromexico's CEO, Andres Conesa. Welcome. Good to have you.
Welcome, and thank you for having me here. Great to see you.
Talk about what you're going to use the IPO proceeds for.
Well, we have a large capex program for the next 5 years, so this is part of it. Together with the operating cash flow that we have for its basically investments, not to enhance the customer experience, additional fleet. So many things going forward.
Route structure widening as well. Is Europe part of that story?
Which one?
Europe, your route structure.
Oh yeah, well, I mean, we have a large offer to Europe. No, we have 10 daily flights. We are adding a few of them. We are flying to Barcelona next year. We're also connecting some other cities aside from Mexico City, like Monterrey, to Paris. So yeah, we have part of that. We do that with 787s. We have an all Boeing fleet. We have a large fleet of Maxes and the 787s.
Is the business a reflection of the economic backdrop in Mexico right now, or something bigger than that?
Yes, I mean, it is. I mean, the business is doing well. Obviously, we are sensitive to the economic cycle, but we focus on the corporate sector and the medium to high-end leisure part, and it's doing well. We have a great couple of years. We are, leading in terms of profitability among full-service carriers. So, as the economy recovers, we expect a better 2026. we think that we will have additional opportunities.
Should viewers think of you as more like the way we think of, we're talking about Delta in a second, but more of that premium class of carrier?
Yeah. I mean, we are type of full service, like similar to Delta. We're part of the Delta family. We're one of the founders of SkyTeam. Yeah. So you can think of Aeromexico as a Delta in Mexico.
So what is your anticipation of what demand looks like right now?
Well,
What will it look like?
we're expecting growth for the Mexican economy of around 2% for next year. So that means, around 10% growth of demand. We're planning to grow between 4 and 6% next year. So steady growth. So that's more or less the outlook.
You mentioned Delta, your partner to a certain extent, joint venture partner, but also has come under regulatory scrutiny in the U.S. What is the plan there in terms of potentially unwinding that partnership?
Yeah, we received an order from the DOT to terminate the JV that we have with Delta. We challenged that order. We believe, and we in the docket, we introduced our arguments. We got a stay from a federal court in the U.S. So as long as we have this stay, we can continue with the partnership until the issue is solved. So I think it's again, as we argue, a very valuable partnerships. We connect Mexico and the U.S. We are between the two. We have the largest offering. We've connected new cities that before didn't have service. So we think we should keep it. But again, pending the final resolution, we will take action.
The government called it legalized collusion, controlling almost 60% of operations at the fourth largest international gateway to and from the United States. Is that true?
Yeah, well, everybody has its hubs. I mean, our home is Mexico City. U.S. carriers, American has in Dallas, United in Houston, Delta in Atlanta. So when you're at your hub, you have most of the slots. That's the way it works, right? So you can, for example, a couple of airlines in the U.S. based from Texas connect to 30 different cities in Mexico, and they have more than 50% of the slots. So it's not uncommon, and JVs are part of that. If you look at JVs all over the world, they operate in saturated airports like Heathrow, like Haneda in Japan, New York, Mexico City. That's the way it works. We're not different than the others, and that's why we challenge the order, and we think we should prevail. Regardless of that, we continue to grow. Delta owns 20% of our equity, so again, we are part of it. They are in our board, and we have a large expansion plan going forward, including to the U.S.
Yeah. Ed Bastian sat here a couple weeks ago, and we talked a lot about this important move. We'll watch it closely.
Yeah.
Good to see you. Thanks for coming in.
Thank you for having me. It's a pleasure, and thank you for the space.
Thank you. Energy prices now down double digits from those July highs. We're going to look at just how low oil might go when Money Movers begins in a minute. Good Tuesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen live at Post 9 of the New York Stock Exchange. Today, NVIDIA's chip challenge. Stocks under some pressure as Meta reportedly plans to use Google chips. We'll explore what it might mean for the AI trade.
Plus, watching oil. Prices extending earlier declines on these oversupply fears and Ukraine peace talks. But with supply continuing to outpace demand, just how low could prices fall?
And Best Buy, Kohl's, Dick's Sporting Goods among the retail names crossing the tape today. What the reports signal about the state of the consumer and holiday shopping expectations.
First up in the markets, the S&P is barely positive, and the Nasdaq is actually lower today by about 0.5%. Under the hood, you do have some strength in communication services. That's the group in the S&P tied to technology, which is working well. A lot of the media names, Meta is rallying today, AT&T, TKO, some of the telecom names, healthcare, consumer staples, all working. But information technology, the other big tech group, is weaker, and that's what's weighing overall on the Nasdaq. It's been part of the trend that we've seen over the last few weeks as a bumpier ride. Small caps outperform, up 1.3%, and treasuries rally with the 10-year going down to 4%. We'll start with the AI trade, another move higher for Alphabet, and reports of a massive chip deal with Meta. Deirdre Bosa has it all in today's Tech Check, which leads us off as we're glued to this move, Deirdre.
Yeah, so Sarah, here's why this deal matters. It's because Meta is one of the biggest GPU buyers in the world. So if it is exploring billions of dollars worth of TPUs, Google's custom chips, that is technical validation. It's also a major win for Google Cloud because Meta would have to run every TPU inside of Google Cloud. So not just a chip win, it's new revenue, long-term lock-in for GCP, an AI native advantage that Amazon AWS and Microsoft Azure, the other hyperscalers, do not have. Now, this absolutely powers the Google bull story. TPUs give Google real efficiency gains. And remember, too, that Anthropic has already committed to expand its usage of TPUs. However, the narrative that TPUs are about to overtake NVIDIA across the enterprise, that's where investors want to be careful. I spoke with Aaron Jin, CEO and co-founder of HydraHost. It's a startup that runs large-scale AI workloads for startups and enterprises. This was his point, which is extremely relevant.
Does an enterprise want a fully integrated solution, or do they want a modular solution? I think that's really the question. Because Google would be a fully vertically solution, because the only way you use TPUs is through Google Cloud. And versus NVIDIA is a horizontal solution. It works out of the box, it's a horizontal product, and I think enterprises is drawn to the modular.
So for most enterprises, committing to Google's full vertical stack, that is a tough sell. If they want optionality to be able to plug into NVIDIA or AMD or whatever comes next, being locked into a single cloud is not exactly the right play. And in AI, of course, that leaderboard, it changes extremely fast. Narratives, as we have seen over and over again, they can swing harder than the fundamentals. Just Google itself went from broken to beloved in a matter of months, though the business hasn't changed all that dramatically. They've been working on TPUs for over a decade. By the way, guys, you can already see this next turn. Silicon Valley has moved onto Anthropic's new model, Claude Opus 4.5, just days after the Gemini release. Anthropic says that model beat Google on several benchmarks. So guys, another sort of signal of how quickly this market can turn. Google is on top right now. We shouldn't get too comfortable here.
Right. No, we were just hearing about that, how the new Claude model from Anthropic was beating. So what are TPUs? What's the difference? And does it make sense that NVIDIA would be down so much? Is it a real threat to their dominance?
I mean, if you think that NVIDIA is going to be the dominant player for many years in the future, yes, what TPUs represent is a custom AI chip that a hyperscaler can sort of design on its own with Broadcom and is more efficient. So I guess there's that fear that it could eat into some of that market that NVIDIA currently dominates. What is a TPU? TPUs are Google's custom designed AI chips that are highly efficient. So they may not be as powerful as NVIDIA, sort of on a chip-by-chip basis, but powerful enough for Gemini 3, which is the top model on the market right now, to be entirely trained and served on TPU. So that's a big deal. However, if you think that sort of the pie, which you hear all the time, the AI pie is only going to get bigger and bigger, demand is going to continue unabated, then there's room for all of them. And there's room for, Amazon, Trainiums, and other chips that, OpenAI may be working on. So that's kind of the key. And Sarah, I may frame it more as, or less TPUs versus NVIDIA GPUs, and maybe TPUs versus the other hyperscalers and what they're working on, because you're not seeing the same kind of momentum from what Amazon is working on, and that gives Google Cloud a huge advantage, which is currently, the number 3 hyperscaler. Does this give them a chance to, catch up or even leapfrog the AWS and Azure's of this race? Maybe, and that's really key, I think.
Also, Google's a big customer of NVIDIA and its chips still.
Indeed.
Yeah,
Dee, thanks.
Remains so.
Deirdre Bosa, let's stick with the tech trade this morning. Joining us today is Janus Henderson's Head of Technology Research and Portfolio Manager, Denny Fish. Denny, it's good to have you. Thanks for the help. We definitely need it, because I was just thinking all of these discussions are getting so rich. I mean, we've talked about the reliability of LLMs, debt and depreciation, circular financing, and now TPU competition. Is that changing your models, or has everyone been all over this?
Yeah, no, it's actually relatively consistent with what we've been thinking, and that is, this is a race to the frontier. And if you think about all these companies that are competing with each other, whether it's Google or Meta or Anthropic or OpenAI, Microsoft, etc., they see the shiny object out there, that's 3+ years away. And they're all chasing artificial general intelligence. And so we fully expected that along this journey, you're going to continue to get models leapfrogging each other. It's what we've seen with each iteration of ChatGPT, of Gemini, now Claude, XAI, et cetera. And so we would expect that to continue. And if anything, last week you just needed 2 data points, and that was NVIDIA's earnings, which were remarkable, and Gemini 3, which was also remarkable. And what both of those implied was that scaling laws are firmly intact, and we are still in an aggressive phase of GPU, TPU, accelerator demand as we go through this training phase before we even get to the knee of the curve of inference.
Right. So how do we know which frogs, so to speak, are going to leap next? I mean, will these micro rotations continue?
I think they will. And I think one thing investors should be cognizant of, when we get to a point where the models stop leaping each other, that actually would be cause for concern, because that would suggest that scaling laws are starting to diminish, and the ability to continue to throw compute at the training problem would actually could actually slow the demand for infrastructure, but we don't see any signs of that so far.
But why didn't the market take it that way? If you said that, the NVIDIA release was a relief on that front.
Yeah, so, who knows what the market's going to do from day to day. I mean, the infrastructure trade, if you will, has been so strong for so long. It's not unusual for the market to take a breather. It just tells you that the market was expecting really solid numbers. And, if anything, the hyperscalers just continue to raise CapEx expectations, and sometimes the market gets a little ahead of itself. But, there has been nothing that we've seen over the last couple of weeks to change our expectation of where this infrastructure build is going to go. And I think one thing that, investors also need to understand is there are natural governors here. You can only build data centers so fast. You can only get, permitting so quickly. And then if you can actually get the power to the data center shell. And so as a result, very different than the dot-com bubble, where it's really easy just to lay down fiber or put up cell towers. This is going to be really prolonged. And, in these short-lived assets like GPUs or TPUs, they don't go into the facilities and they don't get deployed until the power shell or the shell is up, the power's there, and they're ready to go, because these things are so expensive. And so the carrying costs would just be huge. So we're still in an environment where every GPU that comes off of TSMC's foundry, there are 10 people in line for it, and we are just getting started at putting these short-lived assets into data centers.
So then is Taiwan Semi, if you didn't want to deal with the daily back and forth, is that the most consistent play?
Yeah, it's one of the largest positions in our fund, and you're exactly right. And that's because you can buy GPUs anywhere you want to buy them, as long as you go to TSMC. And TSMC has continued to extend its lead over Intel and Samsung. And it's at the earliest, even if Intel gets its act together, we're probably probably looking at 2029, and Samsung continues to lag but is making some progress. But yes, TSMC is the only game in town right now, and so as a result, not only can they're the only ones that can really produce the chips at 2 nanometer right now, but then that also gives them pricing leverage as well. So you kind of get your cake and eat it too.
I mean, the other stock that has stood out this week is Broadcom, which had a huge move up yesterday. It's giving a little bit back, but not much today. And again, NVIDIA competition issues. NVIDIA was down both days, and today it's, these Google chips.
Yeah, no, and the market's just voting with its feet. Broadcom has been the partner to Google for almost a decade now with the TPU. They have been able to execute in custom ASICs better than any of the competitors, whether that be Marvell or Allchip or MediaTek or others that also compete in this space. But Broadcom's been at it a long time, and as a result, every large hyperscaler, with the exception of Amazon, actually has a relationship with Broadcom right now, as well as OpenAI, and it's because they're just really good at doing this. And so, I'm not surprised to see some yin and yang in the market between NVIDIA and Broadcom, but I still do believe we're in this rising tide lifts all boats. Now, one thing Broadcom also has, in addition to just designing the accelerators and working with TSMC, they have an incredible networking portfolio. And if you think about the two most important aspects to an accelerated computing data center, it's actually the GPU or the accelerator and the networking that goes along with that. And those are the key bottlenecks. So, Broadcom's really in the sweet spot there.
Right. Yeah. That 2-year relative strength against NVIDIA chart is really interesting now. That's for sure.
Yeah.
Denny, appreciate it. Hope to talk soon. Denny
All right. Good deal. Thank you.
Still to come this hour, CNBC getting a hold of a private memo sent by NVIDIA to Wall Street analysts. The message, NVIDIA isn't the next Enron. Those details coming up.
Then up next, a growing consensus for that rate cut in December. How recent comments from some top Fed officials are changing market sentiment. The Treasury Secretary took note as well on our air this morning.
What I think is interesting is that the governors seem to be leaning toward cutting rates.
Welcome back. Recent Fed commentary adding to the odds of a December rate cut. CNBC senior economics reporter Steve Leisman is with us now. So now the Doves are speaking out after the Hawks had their turn.
Yeah, we had a whole week of Hawks, but the ever-changing winds, Sarah, of the Fed's December policy debate look now to be blowing more decisively towards that rate cut in December, despite the possibility of a significant number of dissents. Comments by leading Fed officials and reporting by CNBC suggests the Fed is, on balance, more concerned with a weakening jobs market than it is inflation running too hot. New York Fed President John Williams making clear he supports a near-term change in the policy rate and that he has more concerns with jobs than the upside risk to inflation. And as he has done repeatedly since taking office on our air and elsewhere, Fed Governor Stephen Miron in a Fox Business interview this morning advocating for quick and deep rate cuts, saying the weak job market results from tight Fed policy. That followed comments last night by Minneapolis Fed President Neil Kashkari, not a voter this year, saying he supports the Fed helping the jobs market, but noting that cutting rates won't solve the bigger problem for most Americans, and that is inflation. Several voters on the committee have either opposed a cut outright or supported a cautious approach to rate cuts. That could mean several dissents in December, but Governors Miron, Waller, and Bowman, and now President John Williams look ready for that rate cut, and that's very much a leadership contingent there of the Fed. So where are the probabilities? As Sarah mentioned, 76% for December. That same cut has an 82% probability of happening by January. And that is 33% before Williams spoke. Meanwhile, Treasury Secretary Scott Bessent criticizing the Fed this morning for talking too much, saying it's time for the Fed to move into the background. He said the economy has not improved and that he doesn't even understand why there's even a discussion about not cutting rates. Sarah?
Agree on why there's a discussion about not cutting rates, but as far as the talking, I mean, how else are we going to figure out what the Fed is going to do? The whole reason that there's uncertainty about the rate cut is because several members don't want it.
You know, Sarah, I think people forget the bad old days when we had no idea what the Fed was going to do, when we complained about how mercurial and opaque they were, and we had no idea what was going on, and we had to do, remember the Greenspan briefcase indicator, right? That was a joke, but there was a lot of seriousness about that joke, which was that we had to rely on things like that. So you can have, you can have it one way or the other. You can go back to the days when they were smoking cigars in the room and keeping quiet, or when they got rid of the cigars and started talking. So I'll take the latter any day.
Yeah, I mean, it wasn't that long ago that we didn't even have press conferences at every Fed meeting, remember? And then it was like, Is it live? Is it not live? Is there going to be a press conference? Is there not going to be a press conference? The flip side of that argument, Steve, though, is that maybe monetary policy was more effective when it was surprising the markets in terms of, adjusting in terms of the market, the currency rates and everything else, when it wasn't as widely telegraphed and priced in.
I think, Sarah, that the reason why the Fed went to transparency, there's a democratic reason for that, which is the idea that a bureaucracy with all that power should be more transparent and open. But I think the number one reason is because a lot of academic work showed that transparent policy is smarter policy and is better policy. And that we really left a lot on the table, and it cost the economy, it cost markets money in order when you surprise them. If you tell somebody what you're going to do ahead of time, they have time to prepare for that and make it so that whatever losses are coming because you're on the wrong side are mitigated by the transparency. And so the Fed there was a study in 1986 by Marvin Goodfriend. He was at the Fed and he said, look, we're not winning any friends or getting anybody any favors here by being opaque about our policy. And then there was the Taylor rule came out, and a lot of academic work showed transparency was a better way to make policy, and I don't think we ought to go back. What's also interesting, Sarah, is they've been employing large language models before they became the flavor of the month on Wall Street in order to figure out what all that Fed talk means. And so somehow, some way, the market is able to get it right what the Fed's going to do, even with 19 people talking multiple times between meetings.
Yeah, no, market structure has evolved, technology has evolved, the media has evolved since those days of the briefcase. It's hard to imagine that you can put this genie back in the bottle, Steve.
But that's not what he was arguing for, was he, Bessent?
No, I think Bessent is angry at the presidents because they're more hawkish than the governors. I think that's it. He's getting a lot of pressure from the president for rate cuts. He also said that 3 of them live in New York, and I can't really figure out that that's true. I don't think that's accurate. But I'm gonna posit that the combination of me and Sarah, we're better than the large language model. At least I think so.
100%.
So far.
Agree. Okay, I have one more question about this, just of where the votes are going to come down. I didn't watch the Myron interview, but I think the question for him is whether he dissents, because he's been dissenting in favor of a deeper cut, because now the rate cut is at risk. In other words, will he vote with the committee if the way is for one cut?
Yeah, and what I don't know, Sarah, is if it doesn't come out, does he get a chance to re-vote and change his vote?
Right.
It's close. I mean, here's what I don't know. If you put that wall back up, guys, I know we want to move on, but you put that wall back up, I don't know how many of those people in that yellow zone go over and go side with the chairman because it's the chair. That's part of the way the Fed works, you know? If that's what the chair wants and it's a close call, you know, I'll go with him. I could see Goolsbee, Jefferson, I could see 3 of those folks siding with the chair because that's what the chair wants. And one other thing we did not discuss, Sarah, I think you might have talked about this in the 10, this idea of a hawkish cut. That the Fed comes forward and says, you know what, we're going to cut here, but we see a pause in the offing, and that might bring some of those people who are nervous about a cut here. At the end of the day, if the Fed cuts a quarter, they're at the north end, call it, of their restrictive rate. So it's not like you're getting down to neutral right away. That's where Myron wants to go. So yeah, he could dissent, but I think there's probably, if that's what the chair wants, that's what he'll get enough votes.
Yeah, I mean, they tried the sort of hawkish cut thing last time. Didn't go so well because here we are again with the cut. Thank you, Steve. Steve Leisman.
Pleasure.
When we come back, Goldman laying out its year-end playbook and why it says to focus on what it's calling in-the-money themes. They'll explain coming up next.
And then oil is moving lower once again here, but Barclays pushing back, saying the risk continues to skew toward higher prices. Analyst joins us later to explain. Don't go anywhere. Welcome back. We were just having a discussion about the Federal Reserve and what the Fed is going to do at the next meeting on December 10th. And one of the questions I asked Steve was, what would Fed Governor Stephen Miron do? He's been a dissenter at the last few meetings in favor of a deeper cut. Would he vote to push through the cut, to get the cut? In other words, to get enough votes to get the cut. So I just asked him, and he said yes. In fact, he would. He would not dissent just to make, in his words, a rhetorical point. He would not inflict real harm on the economy just to make a rhetorical point. So again, bodes well for the cutters who are looking for enough votes for the Federal Reserve to cut, now that we know that there are a few members out there that are saying publicly in the last few weeks that they do not want to cut. So just adding some reporting in there. Our next guest saying the macroeconomic environment is constructive for risk assets heading into 2026, identifying opportunities across small caps, international markets, and fixed income. Joining us now, Goldman Sachs Asset Management Global Co-Head of Public Investing, Greg Kalnon. Greg, it's great to have you. Welcome.
Great to be here. Thanks for having me.
Small caps are having a nice day today and making a move higher. Is this tied to what I was just talking about, Fed cuts?
I think it does relate to Fed cuts, but it's also valuation, right? So the Russell 2000 is an indicator of small caps is up something like close to 10% this year. S&P is closer to 13.5,
That's always
14.
the case. You could always make that case for small caps in the last few years.
You can always make the case for small caps over the last few years on a valuation perspective, but this is definitely related to the Fed cut, right? So when it was an indication starting in August, September that it was likely that the Fed was going to cut, that's when you saw small caps take off. When we had a little bit of indecision about what the Fed was going to do, and the probability went from whatever it is 70% today to down to 40% last week, you saw small caps sell off, and so you're seeing that come back again. So I think that's the other part of it. So you have the Fed cut, you have valuation. I think there's a lot of opportunities here where we talk about AI and the hyperscalers and the largest cap companies, but there's a lot of innovation going on in small cap too, and so that's also playing through.
But it does raise a question about what happens. Are they AI losers? In other words, do they have the scale and the capital to compete and innovate like some of the other companies around AI?
We think they're AI innovators, and so they are opportunities to play in that space because they're at the front lines of AI. They can definitely compete in niche markets. They're not going head to head with the hyperscalers, right? That's not what they're trying to do. They're trying to find their own niche in the world, and we think there's plenty of opportunities within AI to do that.
I wonder how you're thinking about the sort of tug of war, rotation-wise, between AI and tech and healthcare, right? And whether or not that flows back and forth, or whether now that we've rediscovered healthcare, it's almost caught up to the index for the year, it sticks.
Yeah, we don't think that there needs to be a tug of war, and we don't think that that needs to apply to different markets. What we would say is there needs to be a broadening of equity markets more generally. So that's what we're more constructive of, and you've definitely seen that this year relative to prior years when you basically have had the S&P 500 take off and everything else be kind of muddling along. And so we think that there's opportunities across sectors within the S&P 500, and so you're seeing that with the AI healthcare piece of it.
Healthcare being like the tip of that spear.
Yeah. Definitely healthcare being the tip of that sphere. You're also seeing broadening out of markets with respect to the U.S. and international developed markets, EM. So you're seeing other parts of the equity market really start to do a little bit better.
What is the international case after already solid outperformance this year?
I think that continues, right? So the case going forward is we're just beginning to see fiscal expansion in Germany. We have a new administration in Japan that is also supportive of fiscal expansion. And so if that remains the case, then you'll continue to see growth there, and hopefully you'll see continued momentum in the equity markets as well.
Although, didn't Oppenheimer, your Oppenheimer, Goldman's Oppenheimer, write that probably the next 10 years you're going to see international outperformance versus U.S.
That's part of our thesis. Now, look, it doesn't need to be at the expense of the U.S., but I think we've been so caught up in it's the U.S. or nothing that other markets can participate, right? And so with the S&P 500 up 13.5% this year, international markets up 25% in developed markets, that could continue. It doesn't need to be at that same level, but that can continue.
Do you think what wins going into year end? The historic seasonality that's obviously positive starting really this week, or the impulse to lock in decent gains?
Well, we're long-term investors, right? So we're not focused on what's going to happen between now and the end of the year. So we're not really caught up in the impulse dynamics here. What we see for the next year is a good market backdrop for risk assets. We also think that there's a lot of uncertainty and complexity in markets, and so it is important to have downside protection in the portfolio. And if we do believe that the Fed is cutting, which we do, then it also makes sense to look for other parts to build income in your portfolio above and beyond just government bonds.
Like dividend
like international stocks also typically have higher dividend yields. There's other parts of fixed income markets, securitized, high yield, other parts there that you can generate higher yields than you could just from straight government bonds. And so those are certainly two places to access additional income. You can also do other strategies within the S&P 500, so covered calls, other types of option-based income-generating strategies.
And what's the right amount of exposure to have to the mega cap tech, AI, hyperscaler trade?
I think it's the market cap in general, right? So I don't think that we would go way overweight AI. We wouldn't go way underweight AI. I think we'd be, pretty much neutral. There's still a ton of opportunity, a ton of momentum in AI. We don't think that it's an AI bubble. Certainly we've seen valuations increase, and I think what the market's doing over the last couple of weeks is really just trying to find the winners and losers and being disciplined, which is a very natural, evolution within markets.
Yeah, really, it does push against the whole bubble, buy everything.
Although you guys have been very consistent that the spending trajectory is sustainable.
The spending trajectory is sustainable. There's more to go on this. These companies are trying to build the super app, and that requires a lot of capital expenditure.
All right, Greg, thank you for joining us to
Thank
give
you
us
for
some
having me.
updated views. Greg Kalnon, Goldman Sachs Asset Management Global Co-Head of Public Investing.
Let's get a news update with Seema Modi. Hey, Seema.
Carl, U.S. and Russian officials are reportedly meeting in Abu Dhabi today to discuss a potential peace deal over the war in Ukraine. Now, that's according to NBC News. White House Press Secretary Carolyn Leavitt said this morning there are a few delicate but not insurmountable details that need to be sorted out and will require further talks with Ukraine, Russia, and the U.S. The vehicle used by Pope Francis during a visit to Bethlehem more than a decade ago being transformed into a mobile health clinic to provide treatment for Palestinian children. The Pope Mobile initiative was blessed by Pope Francis before his death. Organizers say it will be capable of treating 200 children a day. And Spotify reportedly plans to raise subscription prices in the U.S. in the first quarter of next year, the first hike since last June. That's according to the Financial Times, which says Spotify is leaning on price increases to drive profits. Confident users will stick around. It's also facing pressure from major record labels to raise prices to keep up with the pace of inflation. Sarah.
All right, that's a bummer. Thank you, Seema Modi. Still to come, some massive moves in the retail sector this morning. We'll get to earnings from Dick's, Abercrombie, Kohl's, and more when we come right back on Money Movers.
what we're doing is really, I think the street, we're cleaning out the garage. I think it's good to give people a visual. And so the Foot Locker team, we talked about it. We said, we got to go in here. We've only owned it for about 10 weeks right now. We said, we need to go in and we need to clean out the garage. So we got to get rid of all the old inventory that's there that hasn't worked very well, impair some underperforming assets, and that's what we're doing. Stores and then some other assets, and we're really being really aggressive to do this. I think our shareholders want us to do this and get it done one time between the third quarter, fourth quarter, be the vast majority of it's done, and then really get a fresh start in 2026.
That's Ed Stack, the executive chair of Dick's Sporting Goods. Last hour on Squawk on the Street, some concerns over the Foot Locker acquisition appear to be weighing on shares today. Our Courtney Reagan following the street reaction and a number of other retail names today. Court, we thought he kind of laid out an interesting case.
Yeah, very, very much so, of course. And you've got this sort of messy quarter because of that acquisition of Foot Locker, which we'll get into in a second. But I was hoping to start with Kohl's because shares are up 30% this morning. Now, this is the second official day of CEO Michael Bender's term as permanent CEO. Shares up 215% since he stepped in as interim CEO May 1st. And all of this is driven largely by Kohl's forecast for a smaller drop in sales and a larger profit for the full year than previously expected. Now, Bender told me on the phone this morning he's pleased with the company's third quarter results and progressive improvement the last three quarters, but he isn't satisfied. Comp sales are still down. Bender, like many others, is calling the consumer choiceful and told me his goal is to provide his shoppers value. And he doesn't just mean price, but product quality too. So Bender said shoppers are choosing Kohl's lower price but higher margin private labels in place of national brands as an example of where they're finding that value. And while Abercrombie & Fitch's holiday quarter sales are below the street's expectations, it beat third quarter estimates, and Hollister sales growth, that continues. But the namesake Abercrombie brand slowing also from some inventory missteps. Shares surging there, even with that disappointing forecast, also up 31%. Now, Best Buy, they increased their forecast for the full year going into this final and, of course, significant quarter of the year, including a rise in comp sales. Previously, the estimate had suggested there could be a decline. Now, CEO Corey Berry told reporters consumers are resilient but deal focused and are willing to spend when they need to or when there's innovation. As you talked about, Dick's Sporting Goods again beating expectations for sales. Comps of 5.7%. That's the main business, and that strength continues. But as you talked about, the Foot Locker acquisition, it's going to cause some pain. Foot Locker margins are forecast to contract between 1,000 and 1,500 basis points over this fourth quarter, the holiday quarter, while Executive Chairman Ed Stack, just as he told me too, he's going to clean out the garage. He means he's got to clear out some old Foot Locker inventory that's not working. He's going to close some stores and sort of reevaluate all the assets. He told me he spends about half of his time now on Foot Locker. He is the executive chairman, but he still goes into work pretty much every day and sits right down there, right next to Lauren Hobart in the office there in Pittsburgh.
Yes. It'd be nice to hear from her sometimes, too. So, Courtney, what do we add it all up, and what do we think about the holiday season? I mean, is there really a thread? Because it does feel like some of these stories are so specific with regard to their categories or how they're executing.
You're so right. And everything, I've been trying to headline this for the last week, 2 weeks or so. This is what I'm thinking. I'm thinking what we can say is, yes, the consumer is discerning. I like that word, choiceful. The consumer is discerning. So they're going to be careful where they spend, but they are willing to spend more and without discounts on products that they see as innovative. So that's what Dick's Sporting Goods said, but that's also what Gap said, or things that they really feel they need, whether it's a replacement good or it's a staple. And so it sounds easy. Just give the customers what they want and then they'll pay for it. But that seems to be the most common thread that I can pull through all of these different retail reports and executive commentaries.
Yeah, we're awash in holiday surveys as well. Goldman with one today.
So many.
Almost every age cohort is a little more cautious than they were a year ago. Thanks, Courtney Reagan. Still ahead, oil with another move lower. How possible peace negotiations between Russia and Ukraine are impacting prices. Plus today, CNBC reveals its official NHL team valuations list. The Toronto Maple Leafs taking the top spot. For the full list, you can go over to cnbc.com/sport. We're back in 2.
Yes, sir, team. It's me in the building, but I did not take any trades today. Didn't like anything I saw. But we'll remain patient. Look forward to seeing you guys tomorrow. I just wanted to check in, let you know that I love you and I appreciate you. And I salute you.
Welcome back. Oil prices heading lower this morning as the U.S. attempts to broker a peace deal between Russia and Ukraine. For more on the impact to oil markets, let's bring in Barclays oil analyst Amar Singh. Amar, appreciate the time this morning. Good to see you.
My pleasure. Thank you for having me.
So whether it's individual reports today or just the prospect of these talks making progress in Geneva, to what degree is it really weighing on the commodity today?
Well, we've seen this volatility caused by geopolitical headlines quite a few times, and I don't think Russian position has necessarily changed a whole lot since the Alaska summit. And we've been here, like sort of at this place several times before. So we'll see how this eventually shakes out. But ultimately, it does not change the view on fundamentals. If you look at Russia, their crude oil production this year has been flat to slightly down this year. And this is despite the increase in OPEC plus targets, which means they're basically producing close to capacity. So even if we get a ceasefire and we get the sanctions relief, potentially at some point, I don't think that that's gonna like sort of necessarily mean that they'll produce more. So ultimately, you know, we're sticking with our $66 per barrel Brent outlook for next year on average.
Right. So this bearish argument that if you were to game it out aspirationally, a deal gets done somehow, and as you said, sanctions come off, there's not going to be this spring-loaded release of supply.
Exactly. I mean, it might matter on the margin for refining margins, I would say, because there's been a lot of attacks by Ukraine on Russian refinery infrastructure over the past several months. And that has helped boost refining margins quite significantly. So if you get a cessation or like sort of some sort of a pause in those attacks on the back of the ceasefire, then those refining margins could potentially come lower. But I don't think on the flat price for crude, it would make a whole lot of a difference.
And then what about the demand side, Amar? China appears to still be driving a lot of the demand, even though it has adopted EVs faster.
That is correct. So by our numbers, China's demand over the first 10 months of this year is up 400,000 barrels per day. And that's compared to our own forecast of 280 for the full year. And that's primarily because even though they've adopted EVs quite significantly, the share of EVs has gone up in the vehicle sales quite a lot. But they still remain an industrial powerhouse, and industrial activity has been quite strong this year.
Yeah, I guess it takes also a lot to produce EVs. It's not just about the consuming EVs. This is one of the points that the Aramco CEO made earlier to me.
That's right, yeah.
A few weeks ago.
As for retail consumer-facing prices, I think RBOB's probably down double digits year on year. I wonder to what degree that's going to actually make its way to the consumer, at least here stateside.
Yeah, I mean, so if you look at what we have in our balances, we have a 1.7 million barrels per day of surplus for next year. And we think that that's comfortably in the price. The forward curve for crude right now is sitting at $62 per barrel. Our forecast of 66 is only $4 ahead of that. And as I mentioned, you know, refined product cracks, including RBOB cracks, have been boosted a little bit over the past few months because of refinery outages in Russia and the fact that there's very little refining capacity, which is spare outside of China right now. And so that's why we have a situation in which cracks have been a little bit higher. So if we get some sort of a ceasefire, maybe you could get some respite for like sort of end consumers over here in the U.S.
Interesting. That'll be a key story for 26. Maybe talk more about it as we get closer. Amar, thank you. Good to see you. Amar Singh over at Barclays today.
Thank you for having me.
Up next, Michael Burry doubling down against big tech. The famed short seller doubting NVIDIA's financials now. The company is fighting back. Those details on the other side of the break.
Welcome back. NVIDIA defending its financials in the face of pushback from short seller Michael Burry, now sending a memo to Wall Street analysts standing by its projections. Christina Partsinevelos is getting a copy of that memo and joins us now. Christina, how is NVIDIA fighting back?
Yeah, by responding and addressing Michael Burry. And this fight is actually escalating. And I say that because Burry, who is the investor who called the housing crisis, claims big technology is cooking the books by depreciating AI chips over 5 to 6 years when they really burn out in 2 to 3. By his math, that understates cost by roughly $176 billion through 2028. Depreciation is just how companies spread out the cost of equipment over its useful life. So if you say a chip lasts 6 years instead of 3, you only expense half as much each year, which makes your profits look bigger. And that's the point Burry's trying to make. NVIDIA pushed back directly, though. The chip maker sent a private memo to Wall Street analysts on the weekend that explicitly names Michael Burry and refutes several of his claims. NVIDIA says it's nothing like the accounting frauds that Burry's comparing them to. The company doesn't use special purpose entities to hide debt like Enron did. It doesn't rely on vendor financing like Lucent. And it says over 90% of its sales come from profitable hyperscalers, government, as well as enterprise customers, and this according to Bank of America. The company also pointed to its free cash flow, which hit $22 billion last quarter, up from 60% from the prior quarter. I know Michael Burry's number was different than that. But Burry fired back on X yesterday saying, quote, "I stand by my release on my timeline." In other words, he's going to release more data, but Burry hasn't dropped those promised details. He is, however, promoting a newsletter, which is about $379 a year, by the way. Wolf Research did also review the NVIDIA memo and said NVIDIA's inventory as well as receivables look reasonable given just how fast the company continues to grow. The question, though, is whether Michael Burry can actually back up his fraud claims around NVIDIA with actual data that we have yet to see. Guys?
Yeah, I'm not sure alleging fraud is exactly what Burry's getting at. He's definitely taking issue with depreciation schedules, right?
Yes, and that was the whole 6 years versus 2 to 3 years that he's saying that these chips, their life is much shorter. But the argument against that is that Microsoft's CEO recently said that now they're able to pair older chips with newer chips, showing that they too can use older models for quite some time. You had CoreWeave say that they had their H100 chip, which is an older chip from about just a few years ago. They were able to rent out that chip at 95% of its original price of its contract, which shows that it still holds value. NVIDIA is saying that they're still selling out of even older A100 models that are at least 5 years old. So there's still demand for these older chips, which would mean that the depreciation cycle is a little bit longer.
Meanwhile, Christina, Street's so hungry for incremental clues. I know you're watching Dell. Will be the next big tech name to report later on. We had some high-profile downgrades in the last week or two, and margins there have been a big story.
Exactly. That is what we're seeing with Dell. The big focus is on whether soaring memory chip prices are going to squeeze profit margins, to your point, Carl. So memory prices have really surged over the past 6 months, and memory accounts for anywhere between 10 to 70% of the bill of materials, depending on the product. So for AI servers, it's a little bit less. For older products, it's more. The issue is that Dell's gross margin estimates for the quarter have barely budged just in recent months, despite these higher memory costs. And so that potentially sets up for a margin miss, and that's the concern. But there is a bullish counter argument. Dell's inventory ballooned from just under $4 billion to over $7 billion, suggesting they've been stockpiling memory just ahead of these price increases. So, they've been aware of it and they're playing ball. Competitor Lenovo also just reported that memory pricing wasn't hurting their margins at all, saying that they remain confident margins won't be affected in the foreseeable future. And beyond margins, investors are also watching Dell's AI server guidance. The company needs about $10 billion in the second half to hit their $20 billion full-year target. But overall, really, the earnings are going to reveal whether Dell bought enough memory early to protect margins or if they're about to face some serious pricing pressure, guys.
Yeah, Hewlett-Packard Enterprise also on deck. I mean, another competitor here. So where have they fallen when it comes to questions about the AI trade, as we've seen some of it unravel a little bit in recent weeks?
The servers are all saying that they're booming from all of this demand because they build said servers for NVIDIA, etc. The problem is just the margins front, which then you can make the bullish case for a lot of these memory chip makers. I know Micron just got a price target increase. SanDisk is another name that has done incredibly well over the last little while, a memory provider. Western Digital, a chip equipment maker too that falls within the memory category, also has been doing quite well. So there are some names that you could, I guess, play for the stronger memory pricing argument. And then as for Hewlett Packard Enterprise and Dell, there are some just concerns about margins. I know Dell more so than HPE.
Okay, Christina, thank you. We'll watch it. Dell reporting earnings after the bell today. You know, the stock market's holding up relatively well. We have this rally in small caps, and you know, some of the cyclical groups are working as well. Communication services strong as Alphabet is higher another day, but NASDAQ, we've climbed back from some earlier losses. It's kind of unchanged as NVIDIA remains under pressure. The 10-year yield is behaving nicely, though, lower. Bonds rallying. Market's more confident of a Fed cut coming in December.
Yeah,
so all
for
of
sure.
that is helping.
Well, we managed to get past the 50-day, which had been some resistance, 67.12-ish. We got through that this morning. That helped. And then the VIX below 20, I think, got some people's attention, too, as things calmed down a little bit. Of course, tomorrow we'll get some incremental earnings out of Autodesk and Workday and Zscaler. And, of course, you would expect volume to kind of trickle off as people start leaving for the holiday.
Thursday market closed, Friday half day. We watch the retailers always during this time of the year, and also we're getting earnings from them. I think, you know, for all of those that say AI is a single factor on this, you know, moving this market right now, I think the Fed is a really big pull as well. I mean, things feel a lot better when the market is positioning for a Fed cut in December. That's been the story over the last few sessions, even more powerful, say, than better earnings from NVIDIA.
The street does not want a Fed that is behind the curve, that's for sure. We'll see what the afternoon brings. Let's get back to Post 9 and the Judge.
All right, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, surging Alphabet. The stock nearing $4 trillion in market cap. It is a stunning turn of events over the past 6 months. We'll discuss and debate the whole AI trade with the investment committee, as always. Joining me for the hour today, Joe Terranova, Stephanie Lake, Brian Belsky, and Josh Brown. We will check the markets. It is a Dow and small cap kind of day. NASDAQ is basically flat, but I'm telling you, the biggest story continues to be this move in Alphabet, which is why we're leading with it again today. Got to $3.98 trillion in market cap, pre-market. It needs today to get to $331.48 to hit $4 trillion in market cap. Joe, I just asked our executive producer, Kevin, this stock has added $2 trillion in market cap since the Eddie Q sell-off 6 months ago. Now, I know NVIDIA has had some unbelievable moves. $2 trillion in market cap added to this name in 6 months. That's unbelievable.
It's staggering, and if you think of what I keep talking towards, which is the return on investment related to AI, this was probably the one Mag 7 name where you had the least confidence coming into 2025 that they actually would do what they're doing now, which is potentially have that strongest ROI on the AI spend. So that dramatic reversal in sentiment is remarkable. It's a credit to Sundar Pichai's strategy of a full stack approach. And now we're hearing about these tensor processing units, which have really been in place for the better part of the last 12 years. Google has been developing them for quite a long time, but what does that allow them to do? Okay, you don't have standing in front of you the regulatory concerns that we had at the beginning of the year. They introduced Gemini 3, which is being widely applauded, and there you go, okay, we're able to defend against OpenAI, and now the unthinkable. They're actually have the ability to challenge NVIDIA's GPU chips.
Oh, I thought you were going to say the unthinkable that Berkshire added a stock like that.
$4.9 billion. Yeah,
by the way, but it's up 16%, okay, since that was revealed on November 17th. So you got the equivalent of the Good Housekeeping seal of approval from Berkshire Hathaway on Alphabet, and this stock has just been a freight train ever since. Brian, you own it as well. I just don't know that we've seen anything quite like this.
No, I was trying to go through the math too, and you were talking to Kevin in terms of the $2 trillion ad. You know, we were very fortunate in April during the depths to double our position in Google just because we did not believe in the demise of Google due to ChatGPT and OpenAI. And you got to take a big picture, think about this as well. Now, with what's going on in terms of its potential business with Meta. Remember earlier in the year they talked about joint ventures and more work with Apple. These are really, really big strategic decisions that were brought on by some of their founders that came back into the business and helped them really derive where they're going in the next several years. And by far, it's our largest overweight in the Mag 7, number one. By far, it's our largest overweight in communication services. And then back to Berkshire, if you take a look at the cash positions alone and how Google is not only managing those, but investing that. And then per Joe's point, in terms of the return on invested capital, those two things are major things that Berkshire has always looked at.
I'm old enough to remember when Steph sold Google, right, and bought Meta. Remember?
Yes.
Remember?
Yes.
Now I'm wondering if we're going to have a reversal. You going to sell Meta and buy Google?
Are you nuts? Are you
I don't know.
absolutely nuts?
I mean, look at the direction of these stocks.
No way.
Put up Meta.
Yeah.
Well, take a look. Put up Meta versus Alphabet, actually, over the last 6 months. Let's just look at that for the sake of the conversation. Because I'm just bringing it up.
Of course.
Because, you know, Meta, everybody was all bulled up on Meta after their worst year ever. Then they had their best year ever. And now I think we have a much more idiosyncratic picture as it relates to the hyperscalers, who is perceived to be well ahead of the pack, who has more questions about it, and where 6 months ago, Alphabet seemed to have all the questions about it, we are asking those questions of Meta now.
So we're supposed to buy low and sell high. So those guys that actually bought more Google, Alphabet, congratulations to both of you. I think Josh also owns it, so congratulations, that's great. But I think that there's tremendous value in Meta, especially after the 21% correction, especially since the earnings estimates actually went higher despite the concerns about higher expenses. So it's now trading at 17 times forward estimates. You know I've been adding to it on the decline because they are seeing the ROI, just like you just mentioned.
Yep.
In a different way. They're seeing better double-digit impression growth, 14% because of AI. They're seeing time spent increase 5% because of AI. And they're getting pricing power. And oh, by the way, they have a $31 billion buyback program, which I'm sure they're in there down here. At least I'm hopeful. And I do like that they are using Broadcom's custom chips. They might use speculation. They might use Google's custom chips. They're setting themselves up to be in the game, and no one's given them credit because they don't have a cloud business. That to me is crazy speak. And so I think we're going to make a lot of money in Meta over time. Just have to be patient because I don't see a near-term catalyst, but the stock is awfully cheap for the growth that you're getting. By the way, 20% earnings growth, 26% revenue growth. That's pretty impressive.
That's the problem, I guess, Josh, is what Steph just said. At least it relates to Meta. I don't see a near-term catalyst because all of these other names seem to have near-term catalysts, and they're capitalizing on them, like Google, Alphabet, which according to the information now, Meta is considering spending billions of dollars on Google's TPUs. They currently rely on NVIDIA's GPUs. So this is another near-term catalyst for this name, that name being Alphabet, which you don't own, by the way.
Yeah, well, the whole world owns Alphabet. It's like the fourth largest company in every major index. So the question is, are you overweight Alphabet or not? And I screwed up with this name. I sold it closer to 200, and I did believe that ChatGPT usage and Claude and a lot of enterprise AI products would be a threat to search. And I think they still might be, but that doesn't matter because what Google has done beautifully is respond to the challenge around its core business with new product, and that new product is working. And it's not just Gemini 3. Yesterday I was on the show, we talked about Nano Banana, which is their answer to Sora. Like, they're gonna have best-in-class products in every major category of AI, and we weren't sure that that would be the case as recently as 6 to 9 months ago. So for the people who made the bet that they would, those people are getting paid right now. I think the lesson, though, for me and for everybody else, is how easily a narrative can form based on share price action, whether it's up or down, and then how quickly that narrative could not just fade away, but completely reverse. Think about the storylines that we've seen this year around AI that have come, gone, and then completely went the other direction. In the early going, Meta was the most aggressive in AI. They were hiring engineers and paying people billion-dollar salaries vis-a-vis acquisitions of startups. It really looked like they were off to a running start and everyone else was still sleeping. Now, Meta's in this bucket where nobody's really sure about whether or not their AI strategy beyond monetizing Reels will be good. Same with Apple. They're not spending enough. Why aren't they doing anything? Why don't they buy Perplexity? Wah! Now the narrative is, look, they didn't spend too much. They didn't get themselves into off-balance sheet debt deals with Blue Owl. They didn't do any of that stuff. New all-time high. So I don't know what the narrative will be on Meta 6 months from now. It could be the polar opposite. People could look at them and say, thank God they don't have a cloud business where they're spending all this money to facilitate other people's AI. Thank God they could just focus on their own business. So I don't think that we want to just look at the last month of Alphabet and Meta and Microsoft and draw these like hard and fast conclusions about what might happen in 26, because you could just flip the deck of cards in the air and pick up the cards in a different order, and things could look very different.
Sure, that's fair, but this looks like a gross miscalculation from the depths of that day in May, when, I'll give him props again, when Lebenthal came out on the show and said, I think this is way, way, way overdone. Lord knows I've given that man enough grief about some of his positions in certain stocks. So I will cite him and that call as many times as it takes to get, back into his
good graces.
Good graces.
We're not talking about a steel stock or capital.
We'll get him with something else, though.
And get invited back to his ranch to help him clear some of that brush. The other big story today is Broadcom.
Sure.
It's overtaken Meta's market cap. That's a story in and of itself. Because if you had listened to Steph, and when NVIDIA was going nuts, and everybody was having its, this party over what NVIDIA was doing, Broadcom was quietly keeping pace, not to the same degree in market cap, and not necessarily to the same degree in monthly or annual appreciation or anything like that. But this is a statement move that Broadcom is now has a higher market cap than Meta.
Yeah, I mean, the leadership is amazing. Hock Tan is now there at the company until 2030. That's a good sign, because he has designed this company with a diverse portfolio of revenues, right? So they have software, and that is a recurring revenue business, high margins, and that's 40% of their revenues. They have AI, that's 30% of their revenues, but growing at a rapid pace, and that's driven by their custom ASIC chips, where they have 4 customers, and they have 2 potential new customers for next year. Could be a $100 billion revenue opportunity for them between now and 2027. And they have the networking business, so they're connecting all this stuff in the data center. And so I think you add it all up, they've had better than expected growth, better than expected earnings surprises, and guides higher than NVIDIA. And so it has done better in the past year, much better than NVIDIA. I think it's a little more owned now, Scott, but I don't think it's nearly as much as NVIDIA. So I think that there's
I'm sure that's fair.
And so, but that's how I invest, right? I don't want to be on one side of the boat. I don't necessarily need to be on the boat by myself, but I want to be somewhere in the middle with great leadership, great free cash flow, industry high margins. And so I still like the story, but I've told you this, I wouldn't be buying it here because it's had such a nice run and it has re-rated, but I do like it very much for the long term.
You've never been the shiniest toy investor out there.
No.
That's
Definitely
sort of
true.
in your DNA.
Yes.
You want to make sure the toy's good and popular, but it doesn't have to be the shiniest one on the shelf.
Good bones, mismanaged, maybe new management coming in that can actually correct the company, and operating leverage, of course, is the big one.
There's a lot of derivatives off of the news that we're speaking towards this morning, and one of them is Broadcom. The relationship that they have with Alphabet and the TPU chips is remarkably important, and it's one of the reasons why you saw yesterday on the news that Broadcom rallied so much.
It's an 11% customer.
Right. So conversely, you have the challenges that are in front of AMD because of their relationship with NVIDIA.
AMD's down today, and part of like why NVIDIA's down on the news of the Alphabet TPU thing with Meta rather than the GPUs from NVIDIA.
Because Meta, the reliance for Meta is on the AMD chips and the NVIDIA chips. So AMD is going to be down on that. So I think there's a whole universe you have to be careful for here from a second derivative.
We haven't, like, Microsoft was the first sort of out of the barn, right? And then, it seems to have fallen to the wayside a bit. Bernstein's defending it today, making the case of why you want to own it. That's what their note is titled. Positioned to be one of the major winners in Gen AI, and yet the stock has been down significantly recently, even after a positive resolution to the OpenAI negotiations and a solid quarter. After having spent time with the company, we believe the concerns are either overstated or simply wrong. Brian.
I think that's right, because what you've seen in Microsoft and Apple in particular, Scott, this year is that they've kind of traded places in terms of what's your defensive pick, within the Mag 7. So we've seen so much more momentum, and now Broadcom, and then the NVIDIA stuff. And so I think we're going to see flows back into Microsoft, especially into next year, and Apple, just because I do think the market's going to become more defensive over the next 6 months, and it makes a lot of sense.
Both Microsoft and OpenAI have very strong Microsoft and SoftBank have strong relationships with OpenAI. If you pull back the lens here over the last month, you'll see that Microsoft's down 12%. If you look at SoftBank over the last month, it's down 43%. Why is that? Because right now the valuation of OpenAI in the private market is being questioned, and now in the public markets we're looking towards which companies have the strongest relationship. It's Microsoft and it is SoftBank, and you're seeing them used as a proxy to figure that valuation.
That might be the
OpenAI.
case, but commercial bookings up 111% and RPOs up 51% in the past quarter, and the stock is down 13% from that.
I
when numbers went
understand
higher,
that, but
to me, I understand.
You call it silly season, and I don't disagree with you. But sometimes the fundamentals disconnect from the reality of what's going on in the market.
For sure, but that's your opportunity, and that's where I started buying it, and I did.
We own it. I don't
before
disagree.
The quarter.
You know what the bottom line of this conversation is, before we move to something else, is like Tony Pasquarello is talking about today, Josh, from Goldman, the dispersion among these names. This is no longer a monolith story. Just forget that, because it's not going to do that anymore. These companies are out for blood on each. They may have relationships with one another. It's like, yeah, a lot of the UFC fighters know one another out of the octagon, but when they're in the octagon, they want to kick the you-know-what out of the other guy. So this is it's a battle. It's an arms race. It's a fight. Whether it's a fight to the finish or what have you, these companies are not going to trade the same way anymore.
I'm so glad you said that, Scott, because I think that is the capstone point to this discussion. In the early going of a growth business, let's say like cloud, or now like generative AI, the success of your competitors actually helps you because it validates the category. In other words, you could say to your investors, look, we're spending a lot of money, but so are they, and so are they, and look at all these contracts they just got. And that's like it's a positive thing, and everybody's kind of on team industry growth. And then, as things mature, it's like, oh, wait a minute, we're losing customers to those guys. What do we have to do to out-innovate them, or price better, or whatever, to take share back? We're there now. A lot of businesses, it takes decades to get there. We're there today, and a win for one of these companies is now being interpreted by stock traders as a loss for the other. And it's as plain as day when you just look at the divergence of the rising fortunes at Alphabet and the falling share price at Microsoft, which has hit its wagon, for the most part, to OpenAI. One is seen to be pulling ahead and one is seen to be lagging. Now, again, it's a horse race. It could switch again. But this is just the current state of things. And I think Pasquarello nails it with that point. And I think we all need to start thinking about the AI trade, quote unquote, going into next year as not all one big theme that you just throw money at the 20 biggest market caps. Now, we got ourselves a ball game.
Yeah, we do. And I'll tell you what, if we just continue with that, the name that's been, gotten a lot of pitches up and in is Oracle in this ball game. Shares are down again, almost 3%, down more than 17% in 3 months. down 25% month to date. The stock got downgraded today to a hold at CFRA. The target got dumped to 200 from 300 at DA Davidson today. Its CDS is up again. If we can show you the CDS, it's going to show you again. That's where the green has been in the credit default swaps. And that is the story in and of itself. And by the way, a credit investor at a major bank telling our own Seema Modi, who's been on top of this story from the beginning, that they're starting to get a lot of inbound calls from equity investors who are trying to understand the structure of Oracle's debt. Joe owns it in the T. He can't do anything. He said as much. He's not happy about it. You don't have any rules around your position in Oracle. So what are you thinking about these days?
Well, we'll use the baseball analogy. They have to take some pitches here. You talked about high and tight or high and inside. They need to take a few pitches here and see how this balance sheet situation follows through. But I think it's a whole notion of needing to go out in the public market or wanting to go out in the public market. I still that they've gone out in the public market, and we're taking a look at it. We still own it across the board in terms of our tactical portfolios that we oversee, and it's becoming even more of a value call for us, and we've had it for a while. So I'm not concerned at this point, Scott. I still think from an operational perspective, it's still the best-in-class software name.
So you're doing nothing for now?
We're doing nothing for now.
What would cause you to do something?
Well, let's see if we'll see a further drop, or if we see some sort of a reversal here and the stock spikes up here a little bit, I might lessen my position, just because we've gone back and talked about for the last year, we're entering this high dispersion market, Scott, and you want to be more of a stock picker. You don't want to be too concentrated in certain names. So I think that will give us an opportunity. If we see a spike here, we would lessen the position.
All right, Steph's trying to be a stock picker in retail, which the retail ETF, the XRT, on pace for its best day since May 12th. Retail sales for September, forget, the data's way backward looking now because of the shutdown. September retail was the worst print since May. Confidence was weak. One of the names, Dick's Sporting Goods, was on the ledger today. They beat on the top and the bottom line. Shares were down, though, because the company is closing some Foot Locker stores to protect profits. The stock has come back. It's up 2%. Silence that. Thank you. As Stephanie Link buys this name.
Yeah. First time ever, by the way.
Yeah, what was the big draw for you?
Could I just go back on retail sales? I mean, I know that September data, but it was up 5.7% year over year. So it's still quite healthy. That's up from 3.5% the prior month. But this is really old data. The other data I'm looking at for the consumer, JP Morgan comes out with their Chase card data every month. And card spend last month, this month rather, November, 4.5% versus last month, 3.3%. Johnson Redbook, they come out with data monthly as well. Retail sales at Johnson Redbook up 6%. I do not think the consumer is in dire straits by any means. The confidence numbers will have you believe that, but I don't. On Dick's, it's down 11% year to date. It was down 7% this morning. This is a very strong franchise with a phenomenal management team, best in class. Their core business was great. 5.7% comps. That was much better, and that was against a 6.4% comp last year, so they're comping the comp. It is Foot Locker that's the problem child. You know, Scott, I like those kinds of stories where there's a little bit of a turn that's going to happen, and I think that their kitchen sinking Foot Locker right now was very poorly run, which is a surprise, to be honest with you, but I think they're going to fix it, and I think they're going to continue to gain market share.
Okay. Macy's, Gap, Walmart, Lowe's, Nike. Take a look at all of those. Dollar General, 5 below. That's where the action is today. There's Gap up near 10%. You sold that last month. Maybe early, maybe not. The jury's going to be out on that. There's DG, which is having a nice move. Estee Lauder's notable today. We can throw that up. It was cut to a sell at Rothschild. Don't see it that often. Stock's not doing too much, but nonetheless, on a green day for retail, that one is not. Best Buy raises its annual forecast. And then how about restaurants getting a bump? Brinker's ripping today. Citi goes to 176. Notable there. Chipotle, Texas Roadhouse is a biggie today. There's Brinker. You bought more Starbucks. That's now your largest discretionary position out of this group. Why buy more now?
It's really done nothing since May when the new CEO was announced, Brian Niccol. And so I want to take advantage of that because he is best management in the whole industry. In all of probably the S&P 500, he's one of the very best. And they are making progress on the turnaround story. But turnarounds, you know, take time, Scott. But they said that they were ahead of the plan last quarter. They had the first positive comp in 2 years last quarter. And they are fixing the store experience and the menu changes and mobile payments and that sort of thing. So I think that there's a lot that can happen that could go right for this company. It's not priced that way. And so I added to it, and I'm going to continue to add to it on any negative days.
Shack is up near 3% today. Josh, again, almost everything in this space is having a good one.
Yeah, look, I think these stocks basically sat out most of the rally this year. It just was not about the consumer discretionary. We do have this K-shaped phenomenon where the higher priced luxury brands have held up better, and then the middle class stuff has not done as well. And then at the low end, you've had companies find success. So we kind of have this hollowed out consumer. I don't think it changes anytime soon. Shack's really unique because it's a growth story within the space, and I think investors are paying for this stock because they expect it to grow faster than its competitors. That's been the history over the last few years. I don't think that'll change either.
Let's make one more move here, at least one more discussion point before we take a break. Bitcoin, it's an A-block story, I think, still, until it isn't. It's down again, okay? Bitcoin is. Coinbase got downgraded today at Argus. So, you know, there's a belief that the market overall is not really going to be able to fully stabilize until Bitcoin does. You own Coinbase in the ETF. So what's your view on that?
I think I said yesterday, I've said last week, and I'll say it again today. I think it's going lower. I think the entire crypto space...
Coinbase is going lower.
It's going low because of what's going on with crypto. It looks to me like the crypto asset class peaked on October 6th. We're in the midst of a liquidity-driven sell-off. You could cite whatever reason for it. But in terms of observing momentum on a very near-term basis, there's no signal that I see in front of me that suggests a turn.
Did you believe, do you believe what others do, that until Bitcoin firms up, at least stabilizes somewhat, that the market itself is going to feel a little more volatile?
I think sideways trade in Bitcoin is gives the free pass for equities to move higher. I think if we break down below 80,000 once again, I think that will have a liquidity effect on equities.
All right.
Short term in its nature.
All right, let's do that break. And coming up next, a big earnings pop for a name that both Josh and Joe own, plus a price target hike from one of Steph's names reporting earnings next week. We got a lot to debate. We'll do it coming up. Let's hit some stocks on the move as well as some calls. We're going to start with Zoom. We talked about it yesterday, Josh, with you heading into the print. They did post a stronger than expected earnings. They upbeat guide as well. Take a look at that. You made a nice call on that yesterday. They also increased the buyback. What do you think now?
I mean, you can't sell it. They just delivered everything that people have been waiting for 4 years to see this company deliver this entire post-pandemic period. So I think you have to ride it. The risk reward going into the number, as I talked about, was asymmetric. There was almost nothing priced in. They did way better than nothing. Third quarter total revenue was up 4.5% year over year. GAAP operating margins 25%, pretty good. Non-GAAP 41%. Things are trending in the right direction. Cash flows were up 30% year over year, and they have traction with the $100,000 plus enterprise customer. That's up 9%. So, like, what else would you really want to see? I got price target raises all over the street. I'm going to stay long.
All right, next one. Applied Materials got upped at UBS. Target goes to 285 from 250. Joe T.
There's a surge in memory. DRAM demand continues to increase. Pricing continues to increase. For this company, look, it's been KLA Corp, it's been Lam Research, it's been Applied Materials. I would say you've seen more strength in KLA Corp and Lam Research than you have Applied Materials. Applied Materials is now seeing a little bit of a mean reversion positive performance, and that's on the fact that wafer fab equipment in 2026, you're expected to see a 20% surge in demand there. And that's really where Applied Materials business is most centered on.
All right, Snowflake, target to 280 from 270. Loop Capital makes the move on encouraging channel checks. Steph.
Yeah, so on the 27th of October, they pre-announced the quarter, so I don't expect any fireworks next week, but I do expect good product revenue growth of 25% plus. Operating margins probably beat. They were expected about 9. Whisper is 11. Gross margin 72.2%. I think that's going to be flattish. So I think it's going to be a good quarter, but I think a lot of good news is priced in. It's up 60% on the year.
All right, Live Nation, buy 164 is the price target at UBS. Josh, that's you.
Yeah, look, this is one of the most valuable assets in the entire entertainment space. It truly is one of a kind if you want to bet on live shows and our continued enthusiasm for them. This is the only ticker that you can really buy. Here's what's announced for 26. Lady Gaga back on the road, Guns N' Roses, BTS, Metallica's going back out, Linkin Park, Ed Sheeran, Lynyrd Skynyrd's going back out. Like, next spring and summer, another blockbuster concert season. This is the company that's going to benefit most. So I remain long. I think it's a crown jewel asset within the space.
Monster reiterated buy at Argus today. They think Monster's able to grow both its domestic and international revenue. Joe T.
So think about a consumer staple company that's able to deliver double-digit revenue growth. It's up 41% year to date. Coke, by the way, is performing well also. But really, Monster Beverage provides you the opportunity to ascertain in a sector that normally doesn't deliver very strong growth, and this company can execute. And they've executed in terms of diversifying the product mix remarkably well and now expanding it internationally.
Belsky, they say FT says Spotify is going to raise prices in the U.S. in the first quarter of next year. You own that name.
Yeah, well, they've done an amazing job with their content. They continue to add more and more podcasts. They are, I've said this before, they're the Kleenex of streaming in terms of music, and they actually do a better job than Apple. I never thought I'd say that, but so Spotify we've owned for years. We love that company. In fact, it's our largest absolute and relative overweight in the communication services sector.
All right, we'll take a break. Coming up, we have your small cap playbook. Small cap, the Russell's ripping today, up 1.75%. Now, Jefferies is out with a list of the names you should take a look at. I'll tell you what they are next.
Hello there. We're back on halftime. I'm Contessa Brewer with your CNBC News update. Israel says it has received human remains handed over by Hamas to the Red Cross. Prime Minister Benjamin Netanyahu's office says the remains will be taken for forensics testing and identification to determine if they belong to one of 3 deceased hostages remaining in the Gaza Strip. Today's handover is the latest since last month's ceasefire began. West Virginia Republican Senator and former Governor Jim Justice, along with his wife, are being sued by the U.S. government for more than $5 million in unpaid taxes, penalties, and interest dating back to 2009. A motion filed with the court just hours after the suit was docketed indicates the couple agreed to pay the amount requested. It did not indicate when or if they can pay the money. The senator's office has yet to comment. And Tokyo is no longer the world's most populous city. A new United Nations report finds Indonesia's capital city, Jakarta, now has that title with an estimated population of nearly 42 million people. It soared from 33rd place in 2018. That is tremendous growth. Scott?
All right, Contessa, thank you very much. I want to hit a story now which has seems to have moved the market in multiple places. A report that Kevin Hassett is the front runner to be the next chair of the Federal Reserve. Bringing our Steve Leisman now to discuss this because the movement in markets is notable on this reporting. Steve, the 10-year below 4% for the first time since October 29th. Stocks have pretty much hit the highs of the day. The Russell 2000 has added to its gains on the idea of lower rates. The dollar is down. And I don't think this would be much of a surprise to those who would say that the president wants to put somebody in that role who is going to do what the president says he wants him to do or her to do.
Yeah, and just to be clear, Scott, we don't have confirmation of this story. We're running our usual traps to see if we can do so, but we have not. If it's not that big a surprise, I think, as you suggest, that Hassett is a front runner, has been thought to be a front runner for a while. The 2 Kevins is the phrase that maybe people have used, Warsh and Hassett. We did hear, and I was able to report it several weeks ago, that they also liked Rick Reeder over at BlackRock. So that's a possibility out there as well. I think the story here is that the market, as you suggest, does see looser Fed policy coming from a Kevin Hassett-run Fed, and that would be for 2 reasons. One is principally he is one who is seen doing more of the president's bidding than perhaps some of the other candidates, and that would be a reason why he would be a front runner. The other reason, though, is not just doing the bidding, but more believing in the longer-term effects of the president's policies. One of the things that the Treasury Secretary and other administration officials have complained about is we're doing all these things that we think are going to bring down inflation in the future, increase growth, and allow you to run with a lower funds rate. The current leadership of the Fed is like, that's great. We'll react to that when it happens, but we're not going to do that preemptively. Whereas the thinking perhaps is that a Hassett-run Fed would be more likely to say, hey, you're doing all these things on the investment side, and there's this boom in productivity. We had Bessent actually say that this morning, that he wants Powell to take the attitude towards productivity and technology investment that Greenspan took in '96, where quite famously he went against a bunch of the hawks in his committee and did not raise rates because he believed in the productivity that was coming from technology. Bessent wants him to do that now. That Hassett more likely to do that than perhaps some of the other candidates.
Yeah, and I mean, Bessent obviously saying on Squawk today, too, that they could actually name this person before Christmas. You know, also on the idea of the type of person that the president would want, all you need to do is look at the way that the Fed governor role was filled. Not to take anything away by any stretch from the bona fides of Myron, but he was put in that role presumably to do what the president wanted him to do, and that's argue, and if he had to, vote for interest rates to be lower. I mean, can we agree on that? without being controversial, I don't think it's controversial. I don't think it's controversial to say that.
I don't see where we disagree. No, it's not. It's also not controversial to point out that he is on leave from the administration, and that has never happened before, as far as I can tell historically. So, and that's been a point of controversy about Myron, and he is in there doing what the president wants. And as you say, suggest he has given some intellectual and backing in the data for his points of view that the funds rate ought to be lowered down. He does say towards neutral, so he's not embracing all of what the president says. Hassett, you could imagine, and I think we've had him on, saying the same thing, believes rates ought to be lower. And then, the question becomes, okay, two things. One is, you're going to bring rates down. If there's inflation, are you ready to go back the other way? And then the second thing is, are you the kind of person that would give the same leeway to a Democratic-run administration as you would a Republican one, or are you playing politics with it? That would be a matter of concern. But hey, the market doesn't care about that. The market says, hey, we're going to put Hassett in. That means lower rates. Buy it.
No, that's right. I mean, that's the way that we're not gonna judge. Our opinion, anybody's opinion who does this, is irrelevant on good, bad, indifferent, whatever. The market votes. We report what the market votes. The market likes the idea of somebody in that role who is going to advocate for lower interest rates, who is more aligned with what the president's view is. And that is a man who wants interest rates to be lower. All you need to do is look at all of the asset classes that are moving on this conversation that we are having based on the report that was put out, and it would tell you exactly that story. Small caps, they like low rates. Tech, the NASDAQ was flat 41 and a half minutes ago. It's now up 0.5%. Cyclical stocks that would play a role into the Dow, for example, up 1.2% is the Dow. The discretionary sector is up near 2%. Follow the money.
Yeah, I would make a point, Scott, of something that I learned during the pandemic, and I'd be interested if you have a chance to see what your traders think about this. But one of the things that I thought was most remarkable about the pandemic, and they all may have known this already, is companies make plenty of money during inflation, and that the stock market itself is not concerned about inflation. The bond market ought to be, but it isn't. Individual Americans are concerned about inflation, and that creates a political dynamic. But when prices go up, input prices go up, companies were perfectly able to raise prices and keep their profitability high throughout the inflation run we had from the pandemic. So if you're concerned mostly about the stock market and the level of stocks, I don't put inflation up there as a real high concern, other than down the road if the Fed has to come and force a recession in order to get control of inflation. But in the near term, I was very surprised, and I learned a lot about how companies operate in an inflationary environment. Of course, Jeremy Siegel, who I talked to about this in the middle of the pandemic, he was not surprised.
Steve, thanks. Appreciate your insight into what has been a market-moving report, no doubt. That's Steve Leisman joining us there. You guys have a thought on that?
A few weeks ago, I bought the GLD. That was my entry into owning gold. I will probably buy more of the GLD, and the reason being is we are going to see certainly a Federal Reserve Board that wants to adopt easier monetary policy in 26. Gold is the way I think you play that.
And you don't fight the Fed, which is why the market likes this maybe announcement.
Right? That's my point.
Of course, but I would also say, the market doesn't care so much or gets so alarmed about inflation if growth is better than expected. And I've said that a lot. We're growing at 3.5–4% GDP. Inflation is sticky at 2.5–3%, but earnings are growing at 12%, much better than expected because of what Steve said in terms of the pricing power, and then companies also being really good about restructuring, reorganizing. Maybe they lay off some people and being more productive.
We've reared an entire generation of investors that believe you buy stocks if interest rates go down, and so that's the key thing to remember. And I think the other thing too, that you got to throw in this dual mandate stuff. And I think as long as growth remains very strong, it makes sense that we could continue to see more cuts.
Josh, quick thought before I go. I just think it's so clear as to how the market views what's not an announcement. It's nothing official, of course. It's just a report. But it's a report that the market would like because of the trajectory of rates that one would glean would come from it.
I guess I would just say be careful what you wish for. We just saw this morning the biggest drop in consumer confidence since 2021. What was happening in 2021? Prices started to get out of control. What are people angry about now? Definitely not their wages, definitely not the stock market, definitely not the rate of employment. They're mad about prices. If you really think this is the answer to whatever is going on economically in this country, I wish you luck. I wish you luck. Great luck.
All right, we will take a break. We're at the highs of the day, or the lows of the day, depending on which asset class you're talking about, because it's all relevant. We did mention the Russell continues to elevate, which is why next is the perfect time to give you some small cap picks. We'll do it. All right. It is a Russell kind of day. We were just talking about that. And how perfect that Jefferies is out today with a list of 17 buy-rated names that should see earnings and sales acceleration in 2026. Valero is one of them. Josh, that's on the best stocks list, isn't it?
Yeah, so these companies are benefiting from the fact that the feedstock, the price of oil, it remains low, but demand for gasoline and other distillates remains high. So that's called the crack spread, and that spread has opened wide. It's remained wide and that's enabled a lot of Wall Street firms to come in and raise their earnings expectations for next quarter, next year. That's why these stocks are leading the market. That's why they're on my list.
COHR, Coherent, Brian Belsky. It's on the list.
We've owned it in our SMID portfolio for about 3 years. It's one of our core positions in terms of technology. It's an electronic components name. It's got very steady earnings. It's more cyclical than maybe some large cap names that we've owned it for a while. We really like it.
Textron, TXT.
Same thing. A bigger mid cap company in the industrial space. We've said a long time that we're going to see more capex in industrials. This engine company is one of the best run and a pretty good dividend as well.
Joey, what about Edwards Life Sciences?
That's been
on the list.
Really good producer in terms of performance for us. One of the rare names in healthcare. I think Josh talked about life sciences yesterday, looking into 2026. A lot of these names are building positive momentum, seeing a lot of capital being invested in the research, and it's being reflected in really strong earnings and revenue growth.
You know, Dollar General's on this list too. Sorry, Josh, go ahead. My bad.
Agilent reported stock looked like it was going to open down 5%. Huge reversal just prior to the open. Take a look at this chart. Take a look at the stock breaking out above its old highs. These life sciences, sort of annuitized businesses, the recurring revenue, some of the best stocks in the market.
I was mentioning Dollar General being on the list. I only bring it up, Steph, because don't you have a history in this name?
Long time ago. I mean, I think I probably sold one of them for Target, which was another disaster. You know, I'm not as crazy about the low-end consumer. I mean, the low-end consumer certainly is struggling, and that's not a surprise, and that's nothing new. Unfortunately, the low end always tends to feel the pain from inflation, from higher gas prices, whatever it may be. So, to me, it's more of a struggle.
But wouldn't that play into stories like this? That's the whole thing. If the stock is up 39% year to date, we've probably talked a lot year to date about the lower end consumer struggling, and yet this stock is up 39%.
Well, I think the stock has been kind of a weak player in the last couple of years. I mean, if you look at the chart, it's just been this year that's actually done a little better. I think they've done better than feared, and they've done a better job in terms of cutting costs. But in terms of same-store sales, that really remains muted for Dollar Tree, Dollar General, the whole cohort.
Okay. Santoli is next with his midday word. right, welcome back. There's the Russell. Intraday, about 2%. Mike Santoli's here for his midday word. This is all part of the Hassett bump that the market got on that reporting that he is apparently the front runner.
Sure. Look, I think that was an extra push in the direction the market was leaning.
Oh, for sure.
We're in a mode right here where it's like, okay, a 7% opening drop in NVIDIA can't break this tape. The rotational rhythms are back. We're starting to run toward last week's high. Let me not let it get away. And so, yes, beta was killed in the downturn. That's coming back. That somewhat represents Russell. Also within the Russell, I always point out the biggest holdings in the Russell, a lot of them are kind of super low quality meme-ish type stocks. Those are not the ones driving the Russell. Bloom Energy, IonQ, they're in the top 5 of the Russell 2000. They're actually down on the day. So it is a little more robust. It's following what's happening with banks. Regional banks are very strong today. So it all fits together, and it also comes on a day when, in other circumstances, you could have gotten a little bit stressed over the consumer confidence stuff and maybe some of the mixed retail data. So I think it's what the market needs. I don't think there was ever any mystery that if it came down to it, stocks like potentially irresponsibly easy Feds, if that's what we're going to get. And you can see some proof of that.
Yeah, and we'll see if that carries through for the rest of the day. I'll see you at 3.
Yeah.
That's Mike Santoli. Finals are next. Three o'clock Eastern Time closing bell. This market's going to be really interesting right into the finish. Adam Parker, Bryn Talkington, Ed Yardeni, Warren Pies. We just added Richard Fisher, too, the former Dallas Fed president, to react to the reporting that is moving the market today. I will see you then. Final trades, Josh Brown.
Uber, stock's in an 11% drawdown. I like it right here.
Belsky.
Humana, sticking with the mid-cap theme, HUM.
The Linkster.
Zoetis 18 times, top down 21%, industry leader, buying opportunity.
Joe T.
Zoom, technical breakouts going towards 100.
Look at that move on the back of earnings. Thanks for joining. I'll see you at 3. The exchange is now.
All right, thanks very much, Scott. Welcome to The Exchange. I'm Dominic Chu in for Kelly Evans on this Tuesday afternoon. Stocks are near session highs right now, with the small cap Russell 2000 index leading the gains up roughly 2% as a December rate cut is looking more likely. We're seeing some really big moves in retail. Kohl's and Abercrombie shares up north of 30%, 30 half 60. Following earnings reports, we're going to go dig into the retail trade, and one name not on this board our analyst is more bullish on than ever for this holiday season. We're also watching NVIDIA. That stock is under pressure today on a report that Meta Platforms plans to buy chips from Google, not NVIDIA. And that is why Google parent company Alphabet is at a fresh record high today. Those shares are up 14% so far this month, easily making it the top performing Magnificent Seven stock. That's putting Alphabet on pace to cross the vaunted $4 trillion market cap mark as it goes from AI laggard to AI leader. Now, that big AI shift is where we start today, and we've got some team coverage. Deirdre Bosa looking at how Google is building out its AI ecosystem. Christina Partsinevelos is digging into how that's impacting the supply chain. And Julia Boorstin has the Mag 7 stock that can't seem to find its AI footing. Deirdre, we're going to start with you.
So, Dom, in AI, the leaderboard, it changes fast. And narratives, they can swing harder than the fundamentals. Just look at Google. It went from broken to beloved in a matter of months, not even because the business changed that dramatically. Now, it's on top now because it started executing. Gemini 3, its model landed. TPUs, its custom AI chips, they're gaining traction. And Google is shipping AI at a Google scale. It has the distribution. But just as markets got over their skis on the other side of this trade, this probably is not a winner-take-all situation. Take the emerging chip narrative. Yes, Meta buying Google custom chips powers the Alphabet bull story, but the narrative that TPUs are about to overtake NVIDIA across the enterprise, not so fast. TPUs, you have to remember this, they lock you into Google stack, so they only run inside of Google Cloud. For most enterprises, that is a tough sell. They want optionality to be able to plug into NVIDIA or AMD or whatever comes next. There's room for both, essentially. So the real fight isn't Google versus NVIDIA. It may actually be Google versus the other hyperscalers. TPUs, they strengthen Google Cloud against the #1 and #2 hyperscalers, Amazon and Microsoft. And it raises the question, if Google has all of this momentum in custom silicon right now, where's the pickup for Amazon's chip, Trainium?
All right, so again, since you opened the door for this, Dee, where is Amazon exactly in this race, since it is the biggest cloud computing player out there and a hyperscaler itself?
It's the biggest cloud computing player out there, the #1 hyperscaler, so it should be leading in AI, right? And what we're learning from Google is that having your own custom chip is a huge part of that. We know that Amazon has been working on its own set of custom AI chips. The most well-known is Trainium. It even signed a deal with Anthropic, but it's, not a very well-kept secret that there's disappointment, not just on Wall Street, but in tech circles with that chip. It certainly does not have the momentum that Google does, and that's just on the chip side. Dom, I bet you'd be hard-pressed to name, Amazon's family of AI models. Most people would. It's Nova, by the way, but they're not climbing the leaderboards, and that gap between sort of Google and everyone else, not just Amazon, by the way, has been increasing in recent months, or at least the narrative has. It's always been there. They're executing, and Wall Street is now appreciating it.
All right, Deirdre, that's the story here on the hyperscaler front. Thank you very much for that. Google's chains and gains now are triggering a big rotation in the AI supplier names. Christina Partsinevelos joins us now with the moves across that supply chain. Christina.
And let's start with NVIDIA shares because it weighs so much on the NASDAQ 100. Shares are down about 3.5% today as the rotation into Google continues, and investors really worry about competition from Google's TPUs like Deirdre highlighted. Bank of America's Vivek Arya already models NVIDIA losing 6% market share of the AI chip market next year in his base case. So the street's known this was coming, given Google's been in the chip game for a decade. It's not necessarily new. What we're seeing right now, though, is a massive rotation in those stocks. Google supplier names like Broadcom, Celestica, TeraWulf. You can see on your TeraWulf almost 8% higher. Meanwhile, names with direct ties to OpenAI, which we'll get to in a second, NVIDIA, Microsoft, CoreWeave, Oracle, SoftBank in that mix are all lagging on sentiment as OpenAI deteriorates, and that's in regards to sentiment. And what's driving this is the market's view that Google's Gemini 3 is now competitive with OpenAI's ChatGPT. And Google's doing it with cheaper TPUs instead of NVIDIA's chips. That's putting pressure on OpenAI's entire supplier ecosystem. And now Meta is potentially jumping ship as well, like we just spoke about with Deirdre Bosa. Broadcom CEO Hock Tan sits on Meta's board, and Broadcom is Google's partner on these TPU chips. Meta's the biggest chip buyer that doesn't run its own external cloud. So could this signal maybe their own custom chip program isn't working out? I know some of the sell-side guys are just talking about that. Or does Meta just want to diversify away from its own chips? The question, though, is whether this is a real shift in AI infrastructure or just short-term trading noise. I know on Monday, Dom, Bank of America actually put out a note saying just be prepared for another sentiment shift and that they're buyers of those OAI suppliers like NVIDIA, like CoreWeave, and some of the neo-cloud players.
All right, so a lot of companies are dealing with this graphics processing unit, tensor processing unit, maybe a hybrid of both. Christina, amid all of this, the name that we want to talk about kind of secondary to NVIDIA is Advanced Micro Devices. So where exactly does this leave AMD?
Yeah, that's the problem. AMD is just getting the brunt of what we're seeing with NVIDIA. The stock is selling off because AMD is also considered a competitor to Google's TPU. Google's TPU is it runs very specific tasks, right? So it doesn't work like a GPU. And the fact that companies or large language models like Gemini are using TPUs, there's no mention of AMD's chips in that mix too, is just weighing negatively on sentiment. And often when NVIDIA does poorly, sometimes AMD is lumped into that mix versus some of the hyperscalers and their own custom chips. So I think that's more of a signal that the market is just hesitating right now with NVIDIA and AMD because they don't see as much upside in the stock prices in the near term. I think that's a big part of it. These companies are great. They've been doing great products. They have a full market share, a grasp of everything. But at the same time, if you're an investor, you want to know that the stock can go up. So that could be more of a reflection of why the shares are down.
All right, changes are afoot in semiconductors. Christina Partsinevelos, thank you very much for that. Now, while Alphabet makes big strides, its Mag 7 peer Meta Platforms, the aforementioned, cannot seem to catch a break when it comes to the artificial intelligence race. Julia Boorstin has the Meta Platform story. Julia.
Well, Dom, Meta shares are rising today on its potential diversification away from NVIDIA. But Meta's massive AI funding has been weighing on the stock. Shares underperforming the other tech giants, down about 16.5% since its last earnings report, despite beating expectations. Raising red flags for investors, Meta's capital expenditures are growing far faster than its revenue. This year's CapEx are projected to be as much as $72 billion. That would be an 84% increase from last year's CapEx. So that would mean that Meta's CapEx as a percentage of revenue could be as high as 37% this year. That's a dramatic leap from past years. Analysts are asking when investors will see a payoff from all of this spending. There has been a measurable impact in AI improving ad results. Revenue has beat expectations for the past 13 quarters. But Meta's flagship AI model, Llama 4, has been called underwhelming. Goldman Sachs flagging the competitive intensity around foundational models and how there is less visibility into Meta's potential returns than there is into its rivals. And analyst Laura Martin notes that Meta is seeing growing expenses for its VR headsets, its augmented reality hardware, AI-enabled Ray-Ban glasses, and its metaverse division, with no clear return on that invested capital. She warns that what she calls this strategy diffusion will lower Meta's success rate. Dom?
All right, so Julia, Meta has seen a lot of personnel changes also recently. The ranks are shifting around. How do some of its big departures and its high-tech hires actually contribute to the overall story around its future?
Yeah, well, on one hand, we're seeing some big spending, some big investments in terms of big name hires. And on the other hand, Meta just lost Clara Shai, who is the head of business AI, and her job is really to build out the business of making sure all those advertisers also use Meta for customer service and use their bots. And even though her division is going to be folded in under another current Meta leader, you're not going to have someone actually replacing Clara Shai right now. So there's some questions about that potential for that enterprise business. And Jan LeCun, who was this visionary leader in terms of AI, has left Meta to go start his own thing. And he had a whole nother approach to AI, thinking about world models as opposed to the text-based innovation around AI. And so his departure will certainly leave a hole as well. Meta says that they have an incredible, robust team, but they're also spending a lot for those executives they have in this space.
Cannot make an omelet without breaking a few eggs, I guess. Julie Boorstin, thank you very much for that. Our next guest says that there's a big AI winner, and that will be the one that controls the full stack, soup to nuts, infrastructure, models, applications, everything. And that's why Google now has that lead. For more, let's bring in Lo Tony, founding managing partner of Plexo Capital. He's also a CNBC contributor. So, Lo, let's talk about the full stack, the soup to nuts aspect, and whether it is, rightfully so, that Alphabet is being anointed this kind of new up-and-coming king of the AI race.
Yeah, well, first, thanks for having me. And I think, yes, we're seeing the story right now is that the AI narrative is shifting towards Google. And it starts with the infrastructure layer. And my core thesis has always been about the vertical integration. I've written extensively about Apple and how they have been able to create an incredible moat around their business using that playbook. And Google has done the same thing, the ability to control the infrastructure, models, and applications. And Google's the only hyperscaler that really has integrated across all three. And on the infrastructure side, as your team pointed out, Google has spent a decade building out the TPUs, working with Broadcom. And, you know, these aren't general purpose chips. They're optimized around Google's workloads, the search, YouTube, ads, and now Gemini. And so that loop is able to compound when you combine that unique proprietary data that Google has access to with the ability to train. And we're starting to see those results. So what's new and what's really shifting the market recently is the TPUs, right? And so the fact that they're seeing the ability to not only perform really well on the inference side, which is kind of running these applications, but now they're also competitive on the training side as well, which has normally been the place where the NVIDIA TPUs have dominated. And so now that we see that Meta is evaluating potentially moving to these, that's significant. Now, Dom, if you remember the last time we talked, the last time I was on the exchange and you were hosting, I spoke about the fact that we're going to enter in this hybrid era of seeing multiple chips, right? GPUs in this case, also TPUs. And so, you know, Google has that footing. And there's one more thing that I want to point out, and it relates to what Julia just spoke about, which is the conundrum that Meta's in. And the fact is, Meta really cannot afford to be able to compete similar to Google in building out vertical infrastructure because they don't have the offering of products. So when you look at Google, it's all about capital efficiency. The best way to achieve vertical integration and still maintain these software margins that we're used to is through cash flow, not by issuing heavy leverage. And Google Alphabet is the most capital efficient of all of big tech right now. And we know that's not the case with Meta. So when you think about the entire suite, you know, that's why there's so much excitement about Alphabet Google.
All right, Lo, there's a lot to unpack here. And unfortunately, we're not going to get to unpack all of it in the time allotted here for our segment. But there have been plenty of instances. You speak about this full stack approach, this idea of vertical integration. That also implies a somewhat, at least on a relative basis, closed system. You're beholden to a certain level of that stack if you're a business or enterprise customer. There have been plenty of times throughout business history where that kind of closed source has led to the downfall of certain types of companies out there. I can even think of Apple back in its early days because of that system. What exactly then is the right way for these companies to approach the hybrid model if you don't want to go down the road of being too closed in a system that limits your ability to service enterprise customers?
Yeah, and I think that really gets at the core of when we look at Google's ability to have these TPUs, the custom silicon that's optimized for their internal products as well as their external offerings. So again, the whole benefit of having this hybrid environment is there are going to be some customers that will need to use and have certain tasks that are going to be best done in a GPU, but the ability to also have the TPU in that same environment to be able to have the optimization that comes from some of the services they'll need from a Google. So I think that's what's going to be different in this instance.
What exactly then is Meta? If I could bring it back to that point of the conversation, what exactly is Meta's path forward here? Some would argue that Meta has the customer, user, social media platform base to be able to help develop AI faster, help train large language models, help develop some of that AI infrastructure. They just can't maybe provide the hardware or some of the infrastructure per se. So what exactly is Meta's plan going forward?
It'll be interesting to see, because what Meta's chosen to do is to make the same types of capital investments that the hyperscalers do as well. But when we think about the offerings that Meta has, they don't compete with the hyperscalers like Google, who are able to not only amortize that capital expenditure across their internal products and have the benefit of having the data from those internal products to develop the models that then can be used to train and offer services for their cloud customers as well. So that's a great product base to amortize these costs around, which are generating multiple cash flows. Meta doesn't have that. Meta's main purpose is using these models for their internal use only. So optimizing ad revenue and the potential to monetize certain consumer offerings. The challenge is we know how fickle consumers are. And so the question becomes, and this is where analysts really dig in, does Meta need to invest all of this money? And potentially we might be seeing a shift away from Meta trying to do their own silicon internally and just shift to someone else who can offer it at a much cheaper price than they're paying for their GPUs from NVIDIA.
All right. Low Tony there with the latest there on the tech trade. Thank you very much. We'll see you soon, sir.
Thank you.
All right, coming up on the show, consumer confidence just reached the lowest level since April. We're going to look at the key reasons why, whether it could lead to a pullback in consumer spending, and how it all affects and factors into the Fed's next decision on interest rates. Plus, some good news on the housing front, helping the home construction ETF to some nicer gains today. Is the real turning point for the housing market here? The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. Government data finally trickling out after that long drought due to the government shutdown. The numbers are painting a more mixed picture as inflation was cooler than expected, but both retail sales and consumer confidence disappointed. Confidence, by the way, hitting its lowest level in 7 months now, while recession expectations did tick slightly higher. Joining me now to discuss all of this is Dana Peterson, the chief economist over at the Conference Board, alongside our own CNBC senior economics reporter, Steve Leisman. Steve, let's start with you first. We had a lot of data today, and it does paint that very mixed picture. So what exactly was the takeaway, and what does this mean for rates next week or 2 weeks?
Well, a bit of older data, but as I've said, old data is better than no data. I think what it does is it sets or it reduces the expectation for both third quarter growth a bit because of that miss on the retail side, and it sets the expectation or the level that we expect consumer spending a little bit lower for the fourth quarter as well. There are things to work out, as you know, Dom, including the economic impact of the shutdown that's supposed to be a negative for the quarter it happened in, and then maybe you get it back in the next quarter. So a bit of shuffling around of GDP between the quarters there. I think the expectation here is that the Fed is on track, in part because of the weakness we're seeing, both in the consumer confidence data as well as in the retail sales data, on track to cut rates because of concern about weakness more than they're concerned about inflation.
All right, so that is the kind of tipping point right now that we're dealing with the scales. Dana, is the inflation the bigger threat, or is the slowing jobs market the bigger threat? It seems as though the conventional wisdom consensus has become the weakening job market matters more. So how does that factor in to the consumer confidence data we just got from the Conference Board?
Well, I think that sentiment that labor market data matter more was certainly underpinned in our consumer confidence measure for November. More people said that jobs are hard to get, and also prospects for future job opportunities as well as income and finances were worse. Now, I do have to note that there's been very little firing, but nonetheless, the unemployment rate has been ticking up because the people who are being let go, especially in finance and tech, are having a difficult time finding new jobs. So absolutely, the Fed's going to be focused on employment over inflation.
There's also, Dana, an interesting kind of crossroads here when it comes to some of that economic, maybe not pessimism, measured caution, I guess you could maybe call it that, versus what we're going to do for the holiday shopping season. I know that Deloitte just came out with their survey on holiday spending. It looks as though 57% of respondents think that the economy will be weaker in the new year in 2026. Maybe their spending is going to be lower this season as a result of that. How much of the kind of circling the wagons, kind of pulling in the horns do you expect out of the consumer this season?
Yes, we also have a survey on holiday shopping that we released a few weeks ago. And indeed, the results were the same. Consumers are saying that they're going to pull back on spending this year relative to next year. They are going to focus on buying gifts and items that or services that their friends and family need over want. And also, many of them are not really looking to travel. And so I would say, yes, we are going to see probably a softer holiday season than we did last year.
Steve, this also kind of all brings us to this idea that maybe the Fed would be hypothetically in a good place to lower interest rates just to help restore some confidence in the overall economy. I know that you reported on some news coming out just this past hour with regard to some movement that we might see on the naming of a new possible Fed chair. It might be Kevin Hassett, although I will say a White House spokesperson has maybe downplayed that notion a little bit. Can you take us through just what exactly is happening with regard to that Fed picture and whether or not the Hassett story maybe takes away or adds to some of that economic uncertainty?
Well, first of all, we have not been able to confirm the Hassett story. I have no doubt that there are people inside the administration who are talking to Bloomberg on this issue. I'm sure they did not invent this, so it's something worth taking into account. Even while the White House says it's pure speculation, I think you have to take into account that there is some momentum, perhaps, for Hassett inside the White House, and I don't think that that's a surprise to the market. He has always been thought of as a front runner from the White House standpoint. Whether or not that's been true from the Treasury standpoint is a different question. I think maybe there's been other people that have impressed the Treasury Secretary, but again, as the Treasury Secretary told us on air this morning, it is going to be the president's decision made sometime around Christmas. I don't know that it relates to the poor economic data that we've had recently, but it does relate to the idea that the president wants lower interest rates, and the thinking is he wants to put somebody in who is best able to deliver that to him, and that's probably why the market rallied on the news and what the expectation is. The bond market doesn't seem to care, Dom, and that's a significant factor. I guess Rick gave it a poor grade, the recent auction, but the bond market is not trading as if it will have a profligate Fed, although I will point out the dollar is trading that way.
All right, Dana, the last word goes to you from an economist's perspective. Should Americans be optimistic about 2026 or more cautious?
It depends on who you are. Certainly, if you work for an industry that's being hammered by tariffs, then you may be wary, fearing that you might be let go. But I would say that many consumers who are on the lower end of the spectrum in terms of income will see some breaks in taxes. They won't have to pay taxes on things like tips and overtime. So there's going to be a little bit of a boost there for those groups. But by the end of the year, we will see cuts in government spending that probably will impact more Americans.
All right. Dana Peterson at the Conference Board, Steve Leisman, thank you both very much. We appreciate it. Coming up on the show, a look at today's mystery chart. It's a retail name, not one of the high flyers in today's trade, but one that our analyst says is one to own this holiday season. That chart revealed ahead.
Welcome back to The Exchange. I'm Contessa Brewer with your CNBC News update. The FBI is working to schedule interviews with 6 Democrat lawmakers who appeared in a video urging service members not to follow illegal orders. That's according to NBC News. The Pentagon yesterday launched an investigation into one of the lawmakers, Arizona Senator Mark Kelly, threatening to return him to active duty to face a potential court-martial. Senator Kelly called the threat absurd last night on MS Now and says he won't be silenced. A bipartisan proposal introduced in the House today is looking to crack down on fraudsters using AI. The AI Fraud Deterrence Act would expand penalties for AI scams and criminalize the impersonation of federal officials using AI, though it would carve out satire and other acts protected by the First Amendment. And who wants a national holiday the day after the Super Bowl? I mean, Tom Brady and who else? The NFL legend and comedian Dreskier featured in a new ad for GoPuff delivery service, which is working with a nonprofit, I kid you not, the the Super Bowl Off Coalition, that's the name, to make the Monday after the game a federal holiday. Last year, a survey showed more than 22 million Americans planned to miss work after the game. They call it Super Sick Monday. You know what I say, Dom? Lightweights. They should just get back to work like the rest of us.
I was going to say, I'm always back to work the day after the Super Bowl, but I wouldn't be opposed to taking it off. Contessa Brewer, thank you very much for the news update there. Coming up on the show, our next guest still believes in the AI theme as a secular trend. Why, though, is he trimming his exposure to AI? We're going to ask him about that and where he's deploying that money instead, coming up next.
Zenimal, we make screen-free meditation devices, mostly for children. I myself suffered from anxiety at a very early age. So when I had my own daughter in 2015, I knew that I wanted to give her the same solution that I found, which was a mindfulness meditation practice. So I created a device that she could have in her control at all times. I was able to find a medical grade factory in China to do that for me at a price point that all families could afford in America. Being a single mom and being the sole provider for my children, there are decisions that I have to make, and wondering if putting in my own money into trying to save other children is the right decision. You have to have a gut check on that. And then the more recent announcement of the additional tariffs of an extra 100% on top of the 30% that we are already paying could potentially cripple the company completely. The second leading cause of death for kids aged 10 to 14 is suicide. And when you start to take away products that help children in their worst of times, that becomes a really sad thing.
Welcome back to the exchange. All three major averages are extending yesterday's gains. The Nasdaq is managing to move into positive territory at this point, despite chip stocks being under pressure. Our next guest says the recent tech volatility looks more like a rotation than an actual rout, but he's still trimming his direct exposure to AI names. So joining me now with where he's putting his money is Paul Christopher, head of global investment strategy over at Wells Fargo Investment Institute. Paul, thank you very much for being here with us. Let's take us, please just take us through what exactly you mean when you say that you are out of some of these AI names into other parts of the market, but you still believe in the AI trade.
Well, yeah, that's the fundamental premise, is that we think there are years left to go as AI and other technology developments continue to evolve. Cybersecurity would be one, digital assets would be another one. We already have some automation in the economy. We think that expands quite a bit more. And artificial intelligence could be an adjunct, could be a helper for all of these other technologies, in addition to standing alone by itself in helping people in their daily lives. So we think there's further trend to go. We're still in the early innings, but because we're in the early innings, there's a likely tendency for markets to get a little bit extended at times. And so in August, we pulled back on communication services. We thought it had gotten a little extended. We rotated that money where? Well, we want to put it in some place that's an ancillary trend to technology, but maybe isn't quite so highly valued. So, for example, utilities with a PE of 20 compared to mid-30s for IT and information technology and comm services. And then at the end of October, we pulled back on information technology as well. The same idea. It looked like it was getting extended, so we go to look for an ancillary trend. In this case, we took emerging markets. Think about a Korea, think about a Taiwan. Chip manufacturers, hardware manufacturers. We think that is going to be another way for investors to play the longer-term theme, but without maybe that short-term overexposure.
Now, all of those places are filled with certain parts of those sectors or industries on a relative overvalue versus undervalue basis. So how exactly then do investors play it? Do they try to go after the fundamental stories that are undervalued in those places, or do they just buy an ETF or mutual fund that tracks some of those trends?
I mean, if you want to do the due diligence, yes, that would be the best way, would be to go and kind of dive deeper. But our feeling is that these sectors are going to become more and more dominant in these other countries, just like they have become in the U.S. over the last 10 to 20, even 30 years. Tech has become a larger and larger share of the S&P 500. So going forward, a small allocation to a broad-based basket of emerging markets could be a good and diversified way to play those markets in addition to what you have here in the U.S.
All right, the tech and comm services trade is something that we've talked a lot about. Other parts of the value chain, in terms of the sectors in the market, are also getting more attention these days. We've seen the huge run-up in healthcare stocks over the course of the last few months. Are there other parts of the market that you think are overweight ratings versus what we see in tech and comm services?
Yeah, we would be trimming. What you've seen happening is, what you're describing is actually a rotation. It's been a rotation away from technology and into some defensives. So some of those consumer stocks have made it to the top of the performance rankings over the last 6 to 8 weeks. Healthcare, which is one you mentioned, we would be fading those consumer stocks and taking the healthcare back to market weight, and then using that money and rotating that once more into the areas that we tend to favor. Again, utilities, well, we like those. We like industrials. We like financials right now.
What about the financials trade makes them How exactly do financials fare in 2026 given that backdrop?
Yeah, that's a good question. So a couple of different angles on financials. First of all, if you're looking for some diversification away from a little bit not quite so centered on technology, you could do financials because, look, we think the interest rate on the short end of the maturity spectrum, the yield curve, we think those rates come down some more. Meanwhile, the rates on the longer end of the maturity spectrum, those 10s, 20s, and 30s, we think those yields stay firm or even rise a little bit that would favor banks, right? Because the bank is going to pay you the deposit rate. That's the short-term rate. That rate is falling. Their costs are falling. At the same time, the longer-term rates, that's what they lend at. That generates their revenue. Those rates are steady to higher. So that's one way to play, or one way to think about financials. But another way to think about it, and again, this touches a little bit on, but it's not entirely centered on technology, and that is that these technology companies increasingly are expanding via debt. And so we think that's maybe an interesting way to think about the financials as well. So it's got a foot in there, but not both feet into the technology trade. It gives you a little bit of diversification in an economy that we think is going to improve with falling short-term rates.
All right. Paul Christopher at Wells Fargo, thank you very much. Have a nice holiday, sir.
Thank you. You too.
All right, coming up on the show, home construction. The ETF, ticker ITB, is up nearly 9% just over the past week on renewed hopes of a December interest rate cut and stronger than expected data. But can that momentum continue as we head into a housing slow season? We're going to discuss when the exchange comes back after this. Welcome back to the exchange. Pending home sales came in hotter than expected in the month of October, but will that momentum last into the colder winter months? Diana Olick joins us now with the latest there. So, Diana, these are contracts signed but not yet closed.
Exactly. That's right, Dom. Yeah, pending home sales in October rose nearly 2% month to month, while the street was looking for essentially flat. So it was a pretty good gain. Sales were down, though, 0.4% from October of last year. Now, this count is based on signed contracts, so people out shopping in October and inking deals when mortgage rates were falling from their recent highs. So that drop may have helped push demand. Rates, of course, have come back up a bit in November. Now, there were more listings available than the year before, but supply hasn't really moved month to month in a while and is actually weakening now. Why? Because a whole lot of sellers are delisting their properties. Redfin just reported that nearly 85,000 U.S. sellers took their homes off the market in September. That's up 28% from a year earlier and the highest level for that month in 8 years. Why? Well, it's because so many listings are going stale. Redfin reported that 70% of listings in September were on the market for 60 days or longer. Now, while some sellers are lowering prices even multiple times, others are looking at the slow winter months ahead and deciding to, wait until the usually strong spring market happens, Dom.
All right, Dinah Olick there with the latest on the housing market. Very interesting dynamic at play there. Thank you very much for that. Coming up on the show, here's one last look at today's big mystery chart. It's up more than 5% today on an earnings beat and a full-year guidance raise. The analyst we have coming up called it one of his top picks for the holiday season just last week. Those shares are up 9% just since then. We'll reveal the name and his other favorite long idea for the holidays coming up next. Welcome back to The Exchange. As you can see there, shares of Best Buy are up roughly 5% on an earnings beat. The retailer also hiking its sales forecast, expecting shoppers to upgrade their technology and splurge on devices this holiday season. None of this, though, is coming as a surprise to our next guest. He says this time of year typically bodes very well for Best Buy, but this year even more so. For more, let's bring in Loop Capital Markets' Anthony Chukumba on that story here. And by the way, that was our mystery chart, Anthony. So take us through the reasons why Best Buy this time of year is great for the holidays.
Sure, absolutely. I think it really comes down to three specific product categories. One is gaming, and we have seen very, very strong initial sales of the Nintendo Switch 2. As a matter of fact, Nintendo just increased their full year guidance for Switch 2 unit sales. The second is PCs, and they definitely have gotten a really nice tailwind from the basically switch from Windows 10 to Windows 11. And Best Buy has about a third domestic market share in PCs. And the third one is smartphones. And Best Buy is definitely benefiting from very strong sales of the iPhone 17. So it really comes down to those three product categories for the most part.
How exactly are they bucking the trend when it comes to a holiday season where multiple surveys out there say that Americans want to spend less money, and these are the types of products that cost more money on a relative basis to the other items on their shopping lists?
I think that's a very fair question. I mean, look, at the end of the day, I think that consumer electronics are just becoming so ubiquitous, right? Like, can you imagine not having a smartphone? Can you imagine having a PC with, that you can't update? And obviously Switch 2 is just a cultural phenomenon in and of itself. So while we do have a somewhat cautious outlook for the holiday selling season, I think that folks are going to prioritize consumer electronics over a lot of other product categories this holiday selling season.
All right, so you got it right on Best Buy. So I said it in the intro before. What exactly is the other trade that could play out in this holiday season if it's not going to be on the device and high-end electronic side of things? Is there another top pick, and where exactly does that go with the consumer spectrum?
Sure, and it almost goes to the exact opposite end of the spectrum. It's Five Below. And we really like Five Below. Their merchandising has improved markedly under their new CEO, relatively new CEO, Winnie Park. They're spending more time on bringing new products. They're really, leaning into licensed trends. They raised prices on a bunch of 15-20% of their merchandise assortment. And they actually have a fairly easy fourth quarter comparison. Their comp store sales were actually down 3% in the fourth quarter of last year, basically because they were too conservative in terms of ordering inventory.
And how exactly do they stack up, by the way, on that Five Below side of things? With some of the other discount retailers out there, why are they your top pick relative to, say, a Dollar Tree or the other dollar type stores out there?
Yeah, that's a great question. I think that they're a very unique animal, right? When you're thinking about a Dollar General, when you're thinking about a Dollar Tree, in a lot of intents and purposes, they are small supermarkets at this point. And so they're competing with a lot of other retailers out there, whether it's a supermarket, whether it's a convenience store, whether it's Walmart, whether it's Target. With Five Below, given their merchandise assortment, it's all very discretionary. It's really targeted towards teens and preteens. You can find a lot of those products at other retailers, but there's no other retail that has all of those products for that target customer base. And so I do believe that they are in a stronger position, quite frankly, heading into the holiday selling season relative to some of the other dollar stores.
There are also other parts of the market right now in retail that might be a focus. We don't often talk about the idea of home furnishings and home supplies and goods like that. But where exactly does this holiday season, given the tariff backdrop, given the uncertainty around the economy, given the uncertainty around jobs, where does that put somebody like an RH, for instance, on the high end of things, a Williams-Sonoma, some of the other home furnishings retailers out there?
Yeah, I think that's a really good question. And I think you really have to look at each company very much, on a company-by-company basis, right? RH, for example, they don't really have a, sort of holiday business to speak of. And Williams-Sonoma was the exact opposite end of the spectrum, right? I mean, in the fourth quarter, specifically their Williams-Sonoma concept, it's huge for them. And they have a lot more sort of like giftable type items. And I also just think that right now Williams-Sonoma is just being managed better, just run better. And so I feel a lot better about Williams-Sonoma's prospects for the holiday selling season than I do for RH.
All right. Anthony Chukumba of Loop Capital Markets, thank you very much. We appreciate it. Happy Thanksgiving.
Same to you.
All right. And speaking of Best Buy, CEO Corey Berry will be sitting down with our own very own Jim Cramer to discuss those Q3 results. That's a 6 p.m. Eastern Time show. You will not want to miss it. Corey Berry, Best Buy, talking about all the trends this holiday season, and of course, vis-a-vis the consumer health. Still ahead on the show, the S&P is gaining a little more than 12% over the past year. And while that's nothing to sneeze at, teams in one professional sports league are seeing an even bigger increase in their valuations. That story is coming up next. The Exchange is back after this. day for hockey fans out there. CNBC is out today with our annual list of NHL team valuations. Now, the average NHL team is now worth $2.2 billion. That's a 15% gain from last year. The Toronto Maple Leafs top the list, valued at $4.3 billion, followed by the New York Rangers, Montreal Canadiens, the Los Angeles Kings, and Edmonton Oilers. NHL Commissioner Gary Bettman telling Squawk Box just this morning he thinks the league is undervalued.
To put the Toronto Maple Leafs on the market on their own, they would sell for far more than the $4.3 billion valuation. But it's okay, because if you look at it, we're up 100% roughly over the last 3 years. So I think we're getting some credit.
All right, so joining me now is the man behind that list, CNBC's senior sports reporter, Michael Ozanian. You're like the czar of sports valuations. So to Gary Bettman's point, and to every other Major League Sports commissioner, these are relative academic exercises compared to market exercises. So take us through what exactly goes into valuations. And we do know that when they come up for auction, they do tend to go for higher than those valuations.
We look at revenues, and then we compile expenses as well. And then we look at past transactions, Dom, and look to see what sort of multiples of revenue and EBITDA teams have been selling at. We'll find out about the commissioner's claim about the Maple Leafs next summer, of course, because Rogers has a call on I think it's about 15-20% of Maple Leaf Sports and Entertainment that it does not own. So we'll find out what that price is in a few months.
Well, it's interesting, too, because we've seen some of the recent history of the NHL has centered around the championships being very Florida-centric, right? I think of Tampa Bay Lightning. I can think of the Florida Panthers. How exactly do they rank, given the overall scheme of these NHL valuations compared to traditional franchises like the Edmonton Oilers, like the Maple Leafs, like the Canadiens?
Florida's done well as a business, like you mentioned, the last two cups, but relative to the top of the league, they're not in the top third of the league. The reason is really local TV revenue. If you look at teams at the top, like the Maple Leafs, the Canadiens, the Rangers, the Edmonton Oilers, these are teams that are getting premier local TV deals. Even though the Rangers have had an 18% cut in what they're getting from MSG Network, it's still very high compared to the Florida teams and some of the teams in the Southeast and Southwest. The two key factors outside of market is, do you control your arena? Do you maximize your arena economics? Do you keep that revenue, even from non-NHL events, things like concerts, ice capades, and other things like that? And the other question is, what's your local TV deal? Because the national money, which has grown very well for the NHL, they just doubled their Canadian TV deal recently. In a couple of years, their U.S. TV deal is likely also to double, analysts are telling me. That money gets split evenly. It's the local money that the teams keep.
All right. Michael Ozanian with the latest official valuations for the NHL. Thank you very much.
Thank you.
All right, for more on that complete list, check out cnbc.com/sport. That does it for us. Thank you for watching The Exchange. Power Lunch starts right now.
Another day of gains for stocks, a shifting leaderboard in AI, and a retail rally despite a souring consumer. Welcome to Power Lunch, everybody. I am Brian Kelly. We'll be back on Monday. Google going from good to great or even greater, at least in the stock market. Alphabet hitting another record high. Are they about to win the multi-trillion-dollar AI race? We take a closer look at what this might all mean for stocks and the market. Plus, some retailers are rocking even as consumer confidence is dropping. Two big chains, both up more than 30% today. Tell you who? We'll tell you why. All right, everybody, we've got a lot to do on this very busy Tuesday. Remember, markets are closed, thankfully, for Thanksgiving. So let us jump right in. We'll kill the music, and we'll take a closer look at the miraculous run from Alphabet. It is at a new record. Alphabet is up 32% this quarter. Oh, and Alphabet has almost doubled in a year. We've also got some new news on NVIDIA with a rather odd internal report and a new tweet. We'll hit that in a moment, but let's start with the Alphabet news and a stock that really just doesn't seem to want to stop at all. Christina Partsinevelos joining now to kick things off from the NASDAQ. Christina, let's start with Alphabet. A lot of news here, and that stock certainly has responded.
Yeah, the first bit of news is the information reporting yesterday that Meta was considering renting, Google's TPUs, the Tensor Processing Units. Just think of it as Google's in-house chips that would pose a threat to NVIDIA. The fact that Meta is considering using Google as opposed to other competitors like NVIDIA, AMD speaks volumes to how well these chips perform. The other bit news is just last week, Gemini 3, that would be Google's large language model, came out to rave reviews, and it was trained on Google's in-house chips, TPU, so another hit to NVIDIA. And so this big, rotation into Google right now, you're really seeing it not only reflected in Google shares, but you're seeing it reflected in Google suppliers like Celestica, TeraWulf, and then away from OpenAI suppliers too, because of how Gemini 3 performed to OpenAI's ChatGPT. So you're seeing some negative reaction in CoreWeave, Microsoft, NVIDIA as well. And so there's just this dynamic, and it's crazy how quickly sentiment can shift. What is it, just 6 months ago, Google was delayed on their whole AI strategy, and today they're the #1 with their TPU chips that are, going to steal market share away from NVIDIA GPUs and that whole narrative.
Okay.
And so you're just seeing a little bit of a rotation.
I got a lot of questions. Number one, TeraWulf, I love it. Paul Prager, the founder and CEO. Maybe we'll get him on the show tomorrow. That stock's up 8% right now. They seem to have nailed it. He's been on many times. That aside, in sort of plain English, Christina, because I am not a mechanical engineer, nor do I play one on TV. What is the difference between a GPU and a TPU? Because I know what a CPU is, but that also dates me.
Just think that the TPUs perform very specific tasks, whereas GPUs do more with compute. So they're more advanced, that's why they're more expensive, they have more memory. But the argument is that you don't necessarily need these super advanced chips with even more memory when you need the large language models to do very specific tasks. So why not get very specific chips? And then why not use in-house chips? So that's what Google's doing. It's an argument to lower the total cost, but still have a performance that compares to NVIDIA chips.
Okay.
That makes sense?
Yeah, it does, but here's the question. If Meta is thinking about using Alphabet/Google's chips, is Alphabet now making semiconductors for other people? Because NVIDIA's job is to build chips and then they sell them to everybody. They make ketchup and they sell them to anybody who wants to throw ketchup on it. Google was just its own thing. Are they now building semiconductors for other people?
I should preface that Broadcom is the designer for Google. So that is the peak of all this, the connector of all this. And Broadcom CEO Hock Tan actually sits on Meta's board. So perhaps Hock Tan is influencing Meta to use some of Google's chips. The other thing is that Meta spent a lot of money also trying to build in-house chips. So many are questioning, why would Meta want to go and get and rent and then possibly buy Google chips? The one argument that I've seen is maybe this is all about supply, securing more supply at TSMC, the world's largest chip contractor. You have NVIDIA that's talking about demand being through the roof. TSMC can't keep up. So then you have Google saying, well, look, we just got another customer, Meta, so give us more space. So that is also perhaps an argument that could be made for as to why Meta would consider Google.
Well, it also explains why Broadcom, which is, as you pointed, the builder, the contractor, if you will. I think Kramer referenced it this morning. That stock's up today, but up 16% in the quarter. I want to switch gears. Was another story out, kind of a weird story. Came out yesterday afternoon in Barron's. Others picked up on it. I know you've got the note. Apparently, and if I get anything wrong, Christina, tell me, as I know you will. NVIDIA put out some kind of internal 7 or 8 page internal memo effectively reassuring their own employees about their accounting?
Reassuring sell-side analysts because they wanted to sift through the noise. So they sent this out.
Not internally for the company. When they say internally, it's like for semiconductor analysts, so it's external.
Yeah. Exactly, for the chip guys. And so many of them got it on Friday evening, some over the weekend. Some sheets were shared over the weekend, and you had people saying this is a fake memo, but it's true. Sell-side chip analysts did get a 7-page memo just going over several points that have been raised as of late. A lot of concerns about NVIDIA's accounting practices, concerns about NVIDIA's days of inventory that have increased to 119 days, well over the 10-year average. point. Just concerns that perhaps Michael Burry himself has brought up. In that 7-page memo that was sent to sell-side guys, there was even a link to Michael Burry's tweet, who argued that NVIDIA might be fudging the books a little bit with its accounting practices, arguing that the depreciation cycle for these chips should actually be a lot shorter than the 6 years that NVIDIA claims. And so it's quite telling when a company that's worth over $4 trillion needs to address these issues. Like, they don't need to. So that's another argument. Like,
Well,
why did
I think that is the story. And to add to that, and you forgive me for I'm looking down on my phone to read, NVIDIA in the last hour put out this tweet: "We're delighted by Google's success. They made advances, blah, blah, blah. NVIDIA is a generation ahead of the industry. It's the only platform that runs every AI model. It's done everywhere computing is done. NVIDIA offers greater performance, versatility, and fungibility." Basically, NVIDIA is putting out a tweet saying, "Good job, Google. We're still the leader." I just find it very odd that a $4.5 trillion company, biggest company in the world, would feel the need to defend itself. I think that's the story.
But then that could just speak to the PR team or the CEO and their egos, maybe, and not necessarily the quality of their chips. We know that NVIDIA has been working on their chips well in advance of everyone. They're 2 generations ahead, even before what's being released in the market. And Google has been working on these TPUs for a decade, and they've been around longer than all other hyperscalers when it comes to building in-house chips, and only now really getting the recognition that they deserve on financial media outlets. But to your point, why is NVIDIA even bothering to reply? The strength is that the PR team is at least provides more, conversations for you and I, and they're more responsive to journalists, and they give answers. Exactly.
I'm not sure that's the reason they would do it. Maybe we should quote Hamlet and Queen Gertrude, and "Methinketh thou doth protest too much." I don't know. We're going to leave it there. Christina Partsinevelos, great discussion right off the top. Let's stay on all of this and more with us. His take on AI, tech, the markets, your money. Chris Verrone, partner and chief market strategist at Strategas. He is one of the top analysts on Wall Street. We are glad to have him. See, we said that so you don't have to. Right. See, Chris, so you don't have to put out a tweet that says, "I'm actually the best." But do you find this NVIDIA stuff a little odd?
Listen, what I find maybe encouraging is that we've taken NVIDIA down 15%, and if anything, the market's gotten broader and has acted okay under the surface. I think that's been maybe the most impressive thing of the last 2 or 3 weeks, that you've had this almost rotational weakness where they've hit some of the big weights, but it really hasn't hit the market at large. I mean, if anything, some of the real economy stocks that you would think are probably the benefactors of AI down the road are actually starting to perk up here. So I welcome that message. I think when a stock like NVIDIA is down, there's so much narrative fitting after the fact where you start to say, "Oh, it's down because of this or because of that." I mean, maybe it's crowded positions in weak hands. I mean, the stock was $80.
Maybe it's up too much, right?
Stock was $80 in April. They traded it to 200.
It's made a lot of people multimillionaires. One of the greatest companies in modern history.
We're down 15 off the highs. We're still in a long-term uptrend. Let's see how this responds in the 160, 165 zone. That is major long-term support. I do think, as you noted, the fact that Broadcom is making new highs here is still pretty notable. And in fact, when you look at the rest of the Mag 7, I mean, Apple breaking out here, I think, is an important message. Meta and Microsoft trying to rally. The market's not that bad.
I'm going to compare NVIDIA to Brad Pitt. I don't think I've ever done that in my life. And the reason I do that is because when you have a star the level of Brad Pitt, everything he does makes news. Yeah. Brad Pitt eats sandwich, right? Like, that's a headline. And People magazine has like a picture of Brad Pitt eating a peanut butter and jelly sandwich. NVIDIA's kind of that way now. They're so big, they're so important. They're in more than 700 ETFs. They're, 8% of the entire S&P 500. Can you blame anybody, including the financial media, maybe you can, for picking up on when NVIDIA does something or makes a small amount of news? It's going to be a bigger deal because they are effectively the Brad Pitt of the stock market.
Well, you certainly can't blame people, but what does it reveal? It reveals where the positions are crowded, where maybe the emotion is most heightened. And I think that's been the story with this stock the entire time. What I think people are missing, though, is, like, take, for instance, on Thursday and Friday. You know, Thursday's the big reversal. NVIDIA opens up strong post-EPS.
We're up 2.5%.
They sell the market pretty hard. Breadth actually was not bad. And then on Friday, you back it up with 10-to-1 advancers decliners on Friday. On, what was a good day, but externally wasn't a great day. 10-1 internals versus decliners. That is a market that's broadening out. That's a market that's going to the real economy. And this is the whole thing with the AI story and NVIDIA in particular. If this is going to have benefits beyond just the chip companies, it's time for it to show up elsewhere. So I think a very important 4, 5, 6 weeks here to see if the market can diversify beyond just the big cap techs and into the real economy.
Okay, let's go on that because yesterday the markets popped. The NASDAQ did not close above its 50-day moving average.
You know what has?
Technically, would you have felt better if it did?
Of course for NASDAQ, but you know what has, what I think is interesting, and this was true even a couple weeks ago, Russell 1000 value index was making new highs. Russell 1000 growth has not. Very different picture than I think the one that we're used to. And think about what's starting to show up here. The move in consumer discretionary the last couple days. I mean, you talked about from very depressed attitudes.
Yeah.
If you look at any of the sentiment work, UMich consumer sentiment is in the, I think, 3rd percentile historically. Actually, that's where you want to be leaning into consumer discretionary and starting to buy those stocks when sentiment is as depressed as it is. I thought the stand that the KRE, regional banks, have put up over the last couple of weeks is important. I think the fact that the home builders have started to show some life here, equally important. I think this is a market getting away from the myopic focus just on AI to a broader message. Hey, the real economy is probably okay.
So that's an interesting take that you referenced home builders and regional banks because they're both very interest rate sensitive. I want to show you a Twitter poll that we put up last week.
Sure.
Okay, so we showed this already, but we asked our viewers, what's going to be the most important thing for the market the next couple of months? Rate cuts, the macroeconomy, this tariff ruling from the Supreme Court, or AI spending? I really assume, Chris, that AI spending would not only be the #1 choice, but with a bullet, like way above everything else. Man, I was wrong. I was the wrongest of the wrong. Fed rate cuts. 32% of our respondents said Fed rate cuts. Would you agree with that?
I would. And you know what's interesting is, all this attention the last 4 or 5 weeks of, is the Fed going to miss the December meeting? What does that mean for the economy? If you look out, looking at, say, June Fed Fund futures or even next December Fed Fund futures, so 6 months or a year from now, they really never moved that much. They've been hanging out in this 3.25 neighborhood. So whether December was live or not live, we think it is. I do think they cut. I think the market has finally started to move there. But whether it was or it wasn't, June 2026 Fed Fund futures really never moved that much. I think we're on an easing trajectory, and we shouldn't forget that. Brian, the other thing, I was doing some work this morning that I don't want to forget. If you look at how some of the great bubbles have ended, whether it was Nikkei in '89 or even tech in '99, 2000, I mean, in '89, JGB yields went from 4.5 to 8.
Japanese government bonds.
Went from 4.5 to 8.5, right? In '99, 2000, U.S. 10-year yields went from 4 to 6. These typically don't end with the Fed cutting and rates lower. I think it's a really important distinction from, say, today to what we saw in those prior to it.
I love that. We'll end it there. It's an optimistic note. And the CME's Fed Watch tool. We got Leishman coming up as well. Shows an 85% chance of a rate cut now at the meeting. Chris Ferrone, bouncing from topic to topic. We love it. Appreciate it.
Great to be
Have a great day. Happy Thanksgiving, by the way. Thank you. Well, I've got some breaking news. The latest monthly Treasury statement is out, and it's a fresh read on the nation's fiscal health, the aforementioned. Steve Leishman with those headlines and could probably also talk about the Fed. Steve.
Yeah, Brian, thanks for that introduction. The Treasury reporting that the deficit hits an October record of $284 billion, but with a bunch of asterisks. I think that's the plural. Expenses were boosted by a calendar change, moving some stuff from into October from November of about $105 billion. So that's also an issue, but they were reduced also less than 5% by the shutdown, some payments they didn't have to make. Revenue was boosted by delayed payments in California. Remember, they delayed the requirement that certain payments, corporate tax payments and other payments be made because of the wildfires. So we got a bunch of that in, so that changed the numbers. Custom duties, I don't think there's an asterisk on this one. They reached an all-time record for any month at $33 billion. So do the math, that's about $400 billion per year in tariff revenue coming in. The previous high was last month at $29.6 billion. Now, another thing on the other side, gross interest on the public debt increasing by $22 billion to $104 billion in October compared to $82 billion last October. It was an all-time record for an October, but not for any month due to increased debt outstanding as well as higher inflation accrual. Brian, just a little note, this report itself was delayed by the shutdown. Should have been out a couple weeks ago.
Okay, can I pivot quickly? You just heard our conversation. How much have expectations?
Yeah, just keep your foot down and then pivot so you don't get called for traveling.
I get called for everything, mostly double dribble and ups and downs because I've got a 4-inch vertical. Steve, how much has the Fed rate cut chances? How much have they pivoted in the last couple of days? See what I did there?
Okay, so before John Williams spoke, the probability of a rate cut was 33%. And we had been talking to a lot of the hawks out there. They had been talking a lot. And then John Williams came forward and said he thought the Fed needed to cut in the near term, which everybody took to mean December. And also everybody took to mean, hey, that was reflecting the view of Fed Chair Powell because, hey, he's the president of the New York Fed, and oftentimes there's no daylight between them. So now I'm at 76%. I don't have the 85 that you were talking to, but we use the Refinitiv numbers. You could be talking about CME, but yes, it's a big deal. It has moved substantially and very forcefully in favor of a rate cut.
Substantially and forcefully, yeah, whatever the numbers are, they've certainly gone up. Steve Liesman, appreciate it. Thank you very much. And folks, with that change in forecast comes a move in the bond market as well. The 10-year yield earlier today briefly below 4%. It's exactly, well, that's 2-year. The 10 years, look at that. It's exactly, if you're on the radio, it's 4.000%. Not exactly counting out to pi, all the digits, but a lot. It's exactly at 4%. First time in nearly a month we saw a brief drop below 4%. That little drop that we've seen reverberating kind of across Wall Street, shaping everything from mortgage rates, tech valuations, regional banks. You heard Chris talk about it, home builders as well, inflation, the Fed's next steps, all that stuff kind of now in play with that expectation for a rate cut on the December 10th meeting. Again, kind of circle with a red Sharpie that meeting. Oh, by the way, one also wonders, when will we get a full announcement of a Federal Reserve Chair candidate? Kevin Hassett, according to some reports, maybe leading now. We've got Michelle Bowman, Rick Reeder of BlackRock, Chris Waller, who's a Fed governor now, Kevin Warsh. We got two Kevins. So you're Kevin 1, Kevin 2, whatever, alphabetical order, former Fed governor. Could also be a surprise candidate, but Kevin Hassett, maybe the leading candidate right now, could get that announcement prior or at the meeting from the president. All right, coming up, why this mystery sector is hopping even as the data around it is dropping. All right, this may be one of the weirdest moves all day. Retail stocks, most of them, rocking today. The XRT, big retail ETF, soaring over 4%. You got Kohl's, Abercrombie and Fitch. They are soaring. They're both over 30% today after reporting stronger than expected results for the third quarter. Kohl's, a 52-week high, posting a surprise profit there. Abercrombie and Fitch, apparently their Hollister sub-brand doing well. I don't know, even as consumer confidence didn't come in well. Let's talk about it all with Courtney Reagan joining us on set. I think I'm not saying it's a weird move because the stocks are up because they posted good results. It's that the consumer confidence number came in lousy, and retail's rocking.
I know, because it's always consumers say one thing, but what they do is something different. If you ask someone, how do you feel about your finances? How do you feel about the economy?
Say terrible, awful.
Right. But when you say, are you going to buy Christmas presents for your kids for Christmas? Of course. Christmas always comes. And so when you look at what the CEOs of all these companies are saying, very specifically, the Kohl's CEO, Michael Bender, says consumers are choiceful. This is a word they're all using. But he said they're value seeking beyond price. So it's not just about what something costs, but you have to provide me value. Is that item going to fit my needs? And the Dick's executive chairman, for instance, says, consumers are willing to pay up if that product improves my performance. If it's a bat that's going to make the ball go further. Some of those bats at Dick's Sporting Goods, by the way, hundreds of dollars selling like hotcakes.
Yes.
You know,
my son plays Little League.
Right, exactly. So you know, right? I mean, if you need a product like that, there's innovation and it gives you value. Whatever value means to you beyond price, you're going to pay.
The point you made is so important because all these surveys, like when people ask about their economy, they say it stinks because most people always say that.
Right.
Like they would, almost everybody except for like 7 billionaires would like to have more money than they have right now. So I get it. More important question. What does choiceful mean? Is that a new word?
Yes, it's a word that
choiceful?
retail executives
How are you
have been
feeling this
using.
holiday season? Well, I'm choiceful.
I know. It's a word retail executives have been using for maybe about a year now. Pretty frequently, Target uses it. Kohl's CEO was using it. Basically means discerning. Sort of, I'll buy when it works for me. So I'm not just going to spend frivolously. I'm not going to.
You look at a menu. What are you going to have for dinner? I don't know. I'm being very choiceful.
I know. We all kind of laugh at it.
You know what Kohl's should use? They can use this, and they should. Kohl's, if you're out there, you're welcome. What do you do? I'm getting Kohl's in my stocking.
Oh.
That could be a good thing.
Mm-hmm.
So if they're doing so great, and I thought Abercrombie was struggling, I guess.
Now, to be fair,
who's not doing well?
To be fair, Kohl's is doing better than they had been. They've had 3 quarters of progressive growth. They're still struggling, right? Their comparable sales are still down year over year. But under CEO Michael Bender, who is now permanent, he was interim as of May 1st, shares are up something like 215%.
Well, some of that is, as you know, hedge fund stuff, short selling. That's not the core business.
And over the summer, there was one day that was a little strange with retail activity really showing that the stock was surging. But my point is, yes, they're doing better. They're not doing great. And Michael Bender told me this morning he's pleased, but he's not satisfied. He's got some progress. To your point, Abercrombie, Hollister doing great. The Abercrombie brand is struggling, had some inventory missteps. They're working through.
Is the teen back? I guess the baggy clothes look is back,
So
right? Is athleisure dead?
No.
Because I see a lot of people wearing baggy clothes, which as a husky individual, I prefer.
Yes, so athleisure is not dead. I'm not going to comment about that. That's dangerous territory. But yeah, the younger kids often you see pretty low-rise, baggy pants.
It's like the vanilla ice
But
look.
I have to correct you in one small way. Abercrombie, the main brand, is actually not geared at teens anymore. Hollister is.
Okay.
Abercrombie is not. It's actually more upper 20s, lower 30s.
Those are teens to me.
Oh. But the point is, it's really gone under a really big transformation under Fran Horowitz. And it's very different than it was when he was in the 90s. So I just have to clarify that.
Yeah, when they used to have like
the shirtless models.
You said it.
I mean,
what shirtless models? Did you notice the shirtless models? That was male models.
I had a boyfriend or two that was
shirtless
employed.
male models. I want to make sure.
A boyfriend or two that was employed
At
by
the
that
What's the
retailer.
mall in Dayton?
There's several Dayton malls.
What was like the big one?
Dayton Mall, the Fairfield Mall that opened.
Courtney is from Dayton, Ohio. If you did not know, Centerville High School. My wife went to a competing high school named Oakwood.
Centerville, go Elks.
End of go
Pride never
Lumberjack.
dies.
End of story. Courtney Reagan Have a, by the way, blessed Thanksgiving and a great Black Friday. I'll enjoy watching you from the comfort of my baggy pants.
I was just
sitting at home doing nothing.
Oh,
Courtney,
well,
thank you.
Thanks, Brian.
All right, coming up, let's just say you think parts of this market are in an AI bubble or maybe overvalued. Where do you put your money right now? We'll talk about that in Market Navigator. Welcome back. Time now for your Market Navigator, and let's talk about what to do with your investments if you think we may be in some kind of AI-related stock bubble, or maybe just a little bit overvalued on the tech side. Well, Chris Brigatti has some ideas. He is Chief Investment Officer at SWBC, and he joins us now. Chris, great to have you on. I said that and he disappeared. It's like I feel like David Blaine. I just do it and they vanish. This is a stock that we don't talk about a lot, but we should talk about more because they're kind of big and well known in every nation. Coca-Cola. What is Coca-Cola's play with you?
Well, it's kind of basic in terms of sometimes the best offense is a good defense, and Coca-Cola sits right in the middle of the defensive sector of consumer staples. So if you want to look at what's happened over the past month when the bubble concerns started to rise, we've seen that the tech sector and the S&P 500 has dipped. Coca-Cola has actually gone up in price over the past month.
Yeah, it's up about 15% so far this year, 16% as of today to be specific. Our graphic says the anti-AI playbook. Is this only sort of an inverse AI play, Chris, or is it possible you buy Coca-Cola along with the other stuff?
Oh, I certainly think it's an along with play. I mean, Coca-Cola is a great stock to have in your portfolio. You got a nice, just below a 3% dividend, which is a great thing to have in a portfolio. And if you're going to kind of marry that with a little more techie play and get a little more boost from tech, you really have a balanced portfolio structure if you're looking at something like that. It's just a smart way to play the market.
Yeah, it's the most drunk, or I think soda, or one of in the world. It's kind of the Nike of sodas, if you will, for lack of a better term. And I don't mean in terms of performance, I just mean in terms of name brand. Why doesn't Coca-Cola get more attention? Why doesn't it get more love? Why isn't Coca-Cola a stock that we and others talk about more than we do?
I think it comes down to the fact that it's just kind of plain vanilla. I mean, it's a great brand. It's great marketing strategy. They're the market leader in their segment. So it's just not sexy. It's not exciting to talk about Coca-Cola from that standpoint. But if you're looking for excitement in terms of just steady gains in your portfolio, Coca-Cola can deliver that.
Coca-Cola can deliver. It has delivered this year. By the way, is there a vanilla Coke? I think there is a vanilla Coke. Is there not? Chris,
I think there is, yes.
I think there is. So it's the double entendre is well taken. Chris Brigatti, SWBC. Chris, have a great Thanksgiving. Thank you very much. Meantime, retail traders, they're pacing for a record year of buying, but where exactly are they putting that money? Gunjan Banerjee of The Journal is up next on set with just that. All right, we have got 2 days, day and a half, really, until the Thanksgiving holiday. We had a big day yesterday in the follow-through buying. It's coming through today, particularly in small caps. The Russell 2000 up another 1.7%. It was up 3% the other day, and in fact, the small cap stocks have been the greatest performing subsector of the market in the last couple of days. Again, just a couple of days, doesn't make a trend, but the buyers have broadened out what they are buying. We talked about it at the top of the show with Chris Verone, and we're seeing people sort of spread out their trades. It's not just 7 or 8 tech stocks they're buying. They're now going in to small caps. We'll see if that continues. The other trend the last couple of weeks has been crypto. Crypto, really the last 6 weeks or so, kind of out of favor with investors. BlackRock's spot Bitcoin exchange traded fund is having its worst month ever, according to FactSet data. The iShares Bitcoin Trust ETF saw more than $2 billion in outflows so far this month. All this is Bitcoin is down about 20% in that time. But even as crypto outflows are going up, it has still been a record year of buying by so-called retail investors. Those are investors that are buying for their own money. They're not big investment firms or hedge funds. They're doing it for themselves. Let's talk more now about what is going on. Gunjan Banerjee is the lead writer for Markets Live at the Wall Street Journal and, of course, a CNBC contributor. Gunjan, great to have you on. Happy Thanksgiving, by the way.
Happy Thanksgiving.
What are the retail investors investing in?
I think it's really been the year of the retail investor. We have never seen them quite as active as they are in markets this year. Everyday Americans, mom and pop investors, they've been pouring into broad-based ETFs. Think SPY, right? The Vanguard S&P 500 ETF. They've been buying gold. They're even sticking with the AI trade, which I think is really interesting because we are seeing some doubts creep in among institutional investors about how long. We are seeing purchases track 50% above levels last year.
I'm afraid to ask this question because I think I know what you're going to say. Are retail investors leveraging up?
They are, and I feel like every time I talk to you, there is more and more leverage in the system. And we saw the downside of that in the market over the past few weeks, right? Where a lot of these crypto leverage trades started rippling into the stock market and causing volatility there. But leverage, take at brokerage accounts, crossed $1.1 trillion recently. That's the highest level in records going back to the 1990s.
And I want to be clear, and I'm not advocating anybody borrow money or take leverage to buy equities or whatever, but they've made money, they've worked. I mean, these people, for the most part, with the exception of the April tariff lows and the recent rattling we saw, would imagine these highly leveraged retail traders have done very well.
And I think that's why a lot of them have stuck to these leveraged ETFs throughout the recent volatility. Assets in those funds crossed $140 billion recently. However, that's a trade that works until it doesn't work, and we saw it blow up with crypto recently. And for stocks, we just haven't quite seen that test yet, but those leveraged crypto trades have not fared well over the past month.
Do we know, and I hate to put you on the spot, but do we know if the people buying crypto are the same people buying specific stocks? Do they overlap?
Well, crypto is popular with a lot of individual investors, right? And they're feeling the brunt of that right now. However, if you've stuck to the stock market, I think individual investors walking into Thanksgiving weekend with their families, a lot of them are feeling pretty good about the market, right? If they've been careful about the level of speculation they're doing in markets this year, they're up, 15% on the S&P 500?
Yes, and that is great. And we want everybody to make money, not lose money. And you can sit around the table at Thanksgiving, you can brag to your family how smart you are. But if you had bought most other global markets in the world in U.S. dollars, you've actually done better than just buying the S&P 500 here.
That's fair.
It's been a global reflation route.
It has. But take a look at the returns in the U.S. market the past 2 years. I mean, we're at 15% this year. That's after 2 years of blockbuster returns. That was the best 2 years for markets in a quarter century. So if you've owned the U.S. market, I don't think you can complain. And a lot of individual investors do.
So I think the shorter Gunjan headline is a lot of people are going to be bragging around the Thanksgiving. And maybe rightfully around the Thanksgiving table, right?
I think so.
Because they've done well. When you see a change, let us know. We'll get you back on because we want to know if people are starting to dump out of certain things.
Well, I think they are dumping some of those hot momentum stocks. Think MicroStrategy, right? Think Robinhood stock. Think Palantir. Those are down double digits in November. So a lot of those retail favorites have gotten crushed. But that buying in broader ETFs has persisted. There have been 10 consecutive weeks of inflows into U.S. ETFs.
10 consecutive weeks of inflows. We love it. Gunjan, thank you very much. Have a great day. All right, let's get now to Contessa Brewer for a CNBC News update.
Hi there, Brian. President Trump said today a deal to end the war on Ukraine is getting very close. U.S. Army Secretary Dan Driscoll met earlier today with Russian officials in Abu Dhabi to discuss a U.S.-backed peace proposal. The president of the European Commission said Secretary of State Marco Rubio participated in a call with the coalition of the Willing today, Coalition of the Willing. He says that was to discuss negotiations. And she says countries called for continued financial pressure on Russia through sanctions. A group of 20 mostly Democratic-led states are suing the Trump administration to reinstate more than $3 billion in funding to homelessness programs. They argue the Department of Housing and Urban Development changes could jeopardize housing for some 170,000 people. HUD did not immediately comment. Brazil's top court rejected an appeal from former President Jair Bolsonaro today and ordered him to begin serving his 27-year sentence while in police custody. He's convicted of plotting a coup after losing the 2022 presidential election. Bolsonaro was arrested this weekend for tampering with his ankle monitor while on house arrest. We'll continue to watch that story unfold, Brian.
All right, Contessa Brewer, thank you very much. All right, on deck, the insane, eye-opening amount of money now flowing into the so-called prediction markets. Talk about sports because, you know, on Thursday it's going to be about family and friend and Thanksgiving and turkey and, oh yeah, sports betting. In fact, there are 3 big games. You got the Packers at the Lions, the Chiefs at the Cowboys, and the Bengals at the Ravens. Actually, all these games really, really matter. So let's talk more about sports and betting and also the prediction markets, kind of the NKO TV. New kids on the block in sports betting. Alex Sherman, sports and media reporter, on set with us here. Big games. How much of this money is now going to some of these prediction markets? And not the FanDuels of the world.
It's growing, and it's growing by the month. So this really was a category that was started earlier this year by Kalshi. And Piper Jaffray just came out with an analysis. You see it on the screen here. $9.75 billion in volume estimated for this month, which would be 15% month over month, driven in large part by the estimation of what is about to happen this weekend with those 3 football games you saw. And there's an interesting wrinkle about why this particular Thanksgiving is going to be so popular in the prediction markets beyond just the newness of this category. Take a listen to what Piper Sandler's Patrick Moley said about his expectations for this weekend.
This is going to be a big week for prediction markets. You have 3 NFL games that are going to be played on Thanksgiving. 3 of the teams that are playing are in states where sports betting is illegal. And what we've seen so far in the NFL season is that when you have a team that's in a market where sports betting is illegal, we see a volume bump.
So there are 30 states today that have legalized sports online betting. So that means 20 states have not. Well, guess what 2 of those states are? Missouri and Texas. And the Kansas City Chiefs play the Dallas Cowboys in that middle game. Also, by the way, Wisconsin has
And the Chiefs actually play Missouri, do they not?
They do.
Despite being called the Kansas City, Missouri.
Yes, a lesson on Kansas City.
I know, it's a
today.
geography lesson as well.
Right.
So let me ask you this. If sports betting is illegal, I can't access FanDuel or DraftKings or Golden Nugget, whatever it is. Can I bet on the game via Kalshi or Polymarket?
Don't call it betting. But yes, you can
wager.
You can invest in a category. Look, it's funny. You know, the Kalshi CEO Tarek Mansour said earlier this year, if you call this gambling, then you've got to call the whole financial system gambling. What we're doing is more like zero-dated options. It's a yes or no. Kansas City wins, Kansas City loses.
It's a binary coin flip. It's a coin flip.
You need a buyer and a seller for every contract. They're not like a bookmaker. There is no odds that they're setting, but there are a few different of these contracts that you can buy with yes-no outcomes, such as an over-under. In other words, will 51.5 points be scored in this game? Higher or lower? Yes or no? Above or below? Same deal with the spread.
Because that's so much different than FanDuel's. Will 51.5 points be scored?
FanDuel,
I mean, what's the damn difference?
Well,
darn.
Does this sound like a loophole to you, Brian Sullivan? I think it may be a loophole, but guess what? It is a currently legal loophole that is now a national product.
This loophole shall be closed at some point.
Well, in the meantime, all of the books themselves are losing volume. There's a good chart we have. Just take a look at the Robinhood graph of stock chart over the past year versus the DraftKings stock chart. You will see Robinhood spiking forward and DraftKings pretty much has plateaued. Why? Because you can bet on Kalshi through Robinhood, so that stock has soared.
So if and I'm just speculating wildly here because why not? If I'm the lobbyist or one of the lobbyists for FanDuel, for MGM, for DraftKings, for the sports gaming industry, I am on Capitol Hill right now. I am having lunch with a senator or congressperson's chief of staff's assistant's butler to try to convince that person to make a law that changes that loophole that you just referenced.
Right, and there's certainly people doing that. In the meantime, the DraftKings, the FanDuels, the Fanatics themselves are saying, we want into the prediction market. So all of those companies are planning on launching their own versions of this in the next month, 2 months coming up. I mean, it's happening soon, real time. So right now, Kalshi is the only game in town in the United States. Polymarket is legal in other countries. Contract market. The betting companies themselves say, we're not just going to sit here on our hands and do nothing. We want into this too, because all you need to do is look at where the volumes are.
I'm looking right now. Do you know Kalshi, pro football champion? 2 choices. The Los Angeles Rams at 19% or the Eagles of Philadelphia at 14%. This is interesting.
Right. So yes or no.
And they'll say this is not gaming. This is just a
zero-dated option.
Zero-dated option.
Or something like that.
Something like that. I love that. But great games on Thanksgiving. Happy Thanksgiving, Alex, even though I might see you tomorrow. Who knows?
Yeah.
Or on the turnpike. All right, we're heading into year end, and Wedbush's Dan Ives out with his top 10 tech names to own. A lot of tease. We're back right after this. All right, Wedbush's Dan Ives out with a new note arguing that we are not in an AI bubble. We're actually in the very early days of the AI revolution, and him and his firm remaining firmly bullish on tech stocks heading into year-end, despite, of course, some bearish views. So Dan and his team coming out with 10 different names that they say are sort of must-own for the AI revolution. There's a lot of well-known names on the list, but let us walk you through it. All right, here we go. Top 10 tech stocks to own for the AI revolution. Should we go backwards? Let's do it. 10 to 9, right? Palo Alto is number 10. CrowdStrike is number 9. Alphabet's number 8. It's been the hottest stock in the world the last couple of months. Meta up 7. Apple's at 6. Tesla's at 5. Advanced Micro Devices at 4. NVIDIA only coming in at 3 on Wedbush and Dan Ives' list. Palantir, number 2. And number 1, not NVIDIA, top 10 tech stocks to own for the AI revolution, is Microsoft. I think Microsoft may be the best positioned, best named tech stock certainly out there. So there is your top 10 list. Again, Microsoft, Palantir, NVIDIA, AMD, Tesla, Apple, Meta, Alphabet, CrowdStrike, Palo Alto, some ladies jumping, maids milking, partridges and pear trees. And don't miss Dan Ives. He's coming up on Closing Bell Overtime, no doubt diving more into that list as well. Dan coming out of a shell and coming on Closing Bell Overtime today. All right, 2025 shaping up to be a very good year for stocks and hopefully your money. But what do you need to watch out for in 26? We're not done with our lists. We got JP Morgan's big risks for next year. Next. All right, before we let you go, I want to highlight one of the top stories on CNBC Pro, because while this year has been a great year for stocks here and around the world, JP Morgan Chase says next year much murkier. One reason, escalating tensions between the U.S. and China. To find out some of the other big risks from JPM, you can scan that QR code on your screen right now or take advantage of CNBC Pro's special offer. Scan the QR code on your screen or head over to cnbc.com/pro for a limited time opportunity, folks. Markets are doing well. We'll see what happens in the final hour of trading, but I'm going to leave that to closing bell, which begins right now.
Brian, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with the rally's resurgence. The scorecard with 60 to go in regulation looks just like that. The majors all green. Most names within the tech space continue their rebound. NVIDIA is an exception, however. And how about the Russell? Small caps, along with the overall market, getting a nice boost today. On that headline earlier, that Kevin Hassett is the front runner, said to be anyway, to be the next Fed chair. Rates moved a little lower on that. In fact, the 10-year broke below 4% for the first time since late October. It's sitting right at that level now. We'll watch it closely. It does take us to our talk of the tape. Don't fight the Fed. That's saying especially notable today on that Hassett report and the move in the Treasury market. For more on what it all means, let's welcome in our panel. Trivariate's Adam Parker, PNC's Young-Yu Ma, and Requisite Capital's Bryn Talkington. Bryn and Adam are both CNBC contributors. This is great to have everybody with us. Adam, you first. I mean, we talk all the time. Don't fight the Fed. Don't fight the cuts. Don't fight the Hassett. Maybe the market is thinking about that today.
Yeah, I mean, the Pauly market had him in the lead anyway. So I don't know if it's that surprising, to be honest with you. You know, when I was writing over the weekend, I thought the sell-off last week was not about the Fed getting hawkish because the bond market was really stable. So, yeah, I think people are positioned in equities because they think the outcome for the Fed is skewed to the dovish. But at some point, I think 2026 is going to be the year where we get close to being done with the accommodation, and that might mean the Fed part of the bull case is less compelling.
Did we overdo the worry about AI last week, or what was that all about, you think?
Yes. And I think we did overdo it, and I think it was mostly, when you decompose it, a couple technical things in the market, some hedge funds selling, some delevering, some ETF selling, some short gamma positions. So it's technical stuff because the fundamentals, I think, are still quarters away from showing any weakness.
Young, you're pretty positive on the market, aren't you? You don't think, you think the Fed is going to cut in December, right?
Yeah, definitely. I do think there's a very high likelihood the Fed will cut in December. Once John Williams came out and gave positive comments about cutting, I think a lot of Fed members are on the fence, will fall in line behind that, and I think the prediction markets reflected that.
Yeah, I mean, because then December was close to 0%, and now we're back moving towards 100% for December. I mean, is there any risk in that for the rally here?
Well, I think what the risk is the messaging when the Fed cuts rates, because we do think that's going to come in December. I think when the Fed cuts, what's the messaging? Is it a hawkish cut? Is it more of a data-dependent, let's see where things go? Or is it more messaging that we're probably at a pause level for the foreseeable future? So I think that's where the risk probably comes in here. But I do think that incoming data will probably be on the soft side and will lean the Fed toward dovish in 2026.
Bryn, is that then overall bullish for where we go from here, despite some chop we might have or some increased volatility?
I think it has to be, because if we can actually get long rates to come down, as you pointed out, as they have today, plus don't forget we have midterms, and the second year of a presidential cycle is typically the best of the four. Midterms, I think, are going to be incredibly important. So I think the fiscal side of the economy will start to get juiced from the OBBB. If you get rate cuts and the long end stays down, that's great for housing, that's great for hard assets like real estate. And so I think it can set up where GDP and the economy are actually starting to pick up. And the key will be obviously if those inflation signals can stay anchored. But I definitely say between earnings, don't fight the Fed, which I'm a big fan of,
even if they're coming kicking and screaming, that definitely bodes well for the economy. And with earnings backing up the economy, I think that would point signs that the market will continue to go higher.
I'll come back to y'all in just a minute. I want to expand this conversation, though, on the prospects of a new Fed chair, and maybe if it is Kevin Hassett. Let's welcome in Richard Fisher. He's the former Dallas Fed president. He joins us now. We wanted you so high in our show because the market liked this report. Do you like the report?
Yeah, look, it would follow tradition. Janet Yellen, Ben Bernanke all came as former heads of the Council of Economic Advisors. Even that's where Kevin Hassett was before. And we've always talked about the two Kevins. Now, the only drawback to Kevin Hassett is he's not as photogenic as Kevin Warsh. You know, the president likes good-looking people, and Kevin's a handsome guy. But I think it follows with tradition. I think Hassett is highly respected, probably more respected by the Federal Reserve staff, particularly at the board level, than Kevin, although Kevin's very talented and capable. So I'm not surprised. And remember, he has to convince the committee to go his way. So I wouldn't get overexcited. I like to remind people that when Volcker was there, we had 4 governors vote against him when Reagan had instructed those 4 governors to argue for a discount rate cut, and Volcker resisted. He had 4 governors vote against him. Alan Greenspan had 2 governors and a president vote against him at one interval. As you know, Ben Bernanke was an excellent interview on Squawk Box. These aren't, they're put up like baseball cards, but you know, the fact is they're just trying to do their earnest best, focus on what's right for the U.S. economy. And I don't think Hassett or even Warsh would be any different in that regard. They're going to have to convince the committee. And that's what's going on right now. As to Williams, I don't believe he would have said a word without Powell's approval. Same thing with Mary Daly, who just talked about this recently, highly regarded San Francisco Fed.
The reason, Richard, why people aren't necessarily surprised at all by the Hassett name being floated, whether it's a trial balloon to see what the market does or not, who knows, but it's because there is a belief, at least in some corners, that Hassett would simply do the president's bidding. President wants rate cuts, Hassett's he's gonna cut rates, or certainly he's gonna advocate for it with the committee.
Yeah, but look at Myron. He hasn't been able to convince, good guy by the way, but he hasn't been able to convince anybody else on committee of his arguments.
Yeah, no, but with all respect to Myron as a governor, he's not the chair.
That's true, but the chair has to convince the committee, and I just gave you one of the most glaring examples. The most powerful, most significant Fed chairman in our history, Paul Volcker, had 4 governors vote against him. So this is something that a chair has to do, and he's going to have to really get the committee behind him and convince they are not dictators. They are consensus builders within the committee. That's how it works, no matter who's the Fed chairman is.
But for a president who I think has made no secret of the fact that he likes loyalty from those that he appoints into positions that he has the power to do so, do you
like Powell, for example? He appointed him.
Yeah. Do you take this this name in any way, if it becomes true, to be a mark on the independence of the Fed, given the person who's making the appointment and how we know he feels about the people he appoints to different jobs?
Yeah, you know I worry about that, Scott, but I was very impressed again. I love the way Bessent expressed this morning. He's learned a lot since he's become Secretary of the Treasury, how complicated the Fed is, and how it's just not simply about the rate cuts or the balance sheet or just the regulatory side. It's a complex organization. So I thought that was a way of sort of backing away from the president's focus on rates. Whoever's in charge, in my opinion, given that there are 18 other people at the table that they have to carry, is going to have to worry about what's best in terms of delivering on the dual mandate. And if they go too far, they carry on too far, and let's say they adopted Steve Myron's approach to, and they got the committee to do it, my view is the markets would go through spasm, feeling that the independence has been thrown to the wayside. I doubt that's going to happen, even though this president would like to get control of everything. But he also backs off of things once he makes strong declarations, and I think a Hassett appointment would be backing off somewhat, particularly given what Bessent said this morning.
Interesting. I'm going to get back to my panel in a second, but last question to you. If you had a vote in December, would you be a yes for a cut?
I probably would be. I'm sort of on the fence, and here's the reason why. In terms of the data, we don't have the hard data we'd like. I would want to listen to all 12 Federal Reserve Bank presidents, what their reports are in terms of what's going on in their districts. My guess is the net balance of what's going on in their districts is a little weakness, maybe more weakness than they expected in the last meeting. And if that's the case, then yes, I would be in favor of a quarter-point cut, as long as they don't report that inflation is getting completely out of control, which I don't believe is yet the case.
Well, it could be a hawkish cut. We don't know. We'll have to wait and see. Wish you a great Thanksgiving, Richard. Thanks for being with us, as always.
Thank you.
All right, that's Richard. That's Richard Fisher. He's the former Dallas Fed president. Give me one quick word on this as you were listening.
I think the balance sheet's what's going to matter the most. I think at the end of the day, if they do 2 or 3 more front ends, it's less important than if they start getting more dovish with the balance sheet. You got to be bullish on equities if they expand the balance sheet.
All right, the other big story we're following over this final stretch, Alphabet's ascent towards $4 trillion in market cap got close today. Dee Bosa is here with more on that stock's remarkable run, and it really has been remarkable over the last 6 months, Dee.
It really has been, you know, and TPU is sort of the cherry on top because Google already has the best model with Gemini 3. It's got search, Gmail, YouTube, other products. That gives it distribution and data. And now with Meta, a potential custom chip or TPU customer, you have real vindication of that strategy. This vertically integrated play. So even if TPUs are not the NVIDIA disruptor that some are calling for today, wider adoption of them is good business for Google. They only run on Google Cloud, so that is sticky infrastructure revenue and could give it a leg up on the other hyperscalers, Azure and AWS. Now you can see how the market is positioning around that story in this chart from Morgan Stanley. The Google exposed infrastructure names like Celestica and Lumentum, Broadcom, they have surged. Meanwhile, the OpenAI exposed GPU ecosystem has pulled back. So this really puts it in perspective over the last few months. But because Google is so vertically integrated, Scott, meaning that it owns the model, the data, the chips, and the cloud that runs them, Alphabet shares, they are the main beneficiary here. As you said, market cap within striking distance of that $4 trillion now.
Yeah, Dee, thanks so much for that perfect look at what's been happening with this stock, which really has been remarkable. Bryn, you own it, so I'd love your take, but also this idea that Tony Pasquarello puts forth today, that, and maybe this is a great reminder of it, there's just going to be a lot of dispersion within this group, more so than maybe we've seen over the last few years.
Yeah, I mean, that could be true, but I think ultimately where I think OpenAI is kind of back-footed here is, you know, Sergey's back. Sergey Brin is back. And I think that you can definitely say it's causation, maybe a little bit of correlation between him coming back, him kicking down the bureaucracy. I mean, understand earlier this year, Gemini was banned from being allowed to code inside of Google. Like, that is insane. And he got rid of that, right, working with Sundar. And so my knock on Google historically has been you don't have that founder mode. And I think with Sergey being back, you have this ability, this really need to execute. I think this is now Google's race to lose, and especially when you have Sundar with Sergey together, I think this is an exciting name to own for the next year.
I mean, that's Gene Munster's take with us right here on this. You, the idea of more dispersion within the cohort of stocks we're talking about, you agree with that?
I agree with that. I think it's very healthy for the market. I think it's a great sign that we see that. It's not the Mag 7 as a monolith. It's some being down 15, 20% and some being up 25%. And it wasn't that long ago that Google or Alphabet 6 to 9 months ago was kind of stuck in low gear. I think that speaks to the rapid developments in this space, the innovation, how quickly things can change, and why we shouldn't get too negative when there's this pullback that takes place, because innovation's right around the corner.
Hey, in your former life as a semiconductor analyst, how would you be viewing what's happening? Would you be putting out negative notes like this is insane, what's happening with some of these chip stocks? Or would it be totally justified in your mind?
You know, probably some weak triple breaking putt call of, you know, near term, medium term, long term, so that I can't be totally wrong in all directions. Fortunately, I don't do that anymore, so I can take a shot.
But you have to analyze these names, right?
I'll take
like,
your question.
You know, like NVIDIA. I mean, you could say NVIDIA is justifiably where it is in the market.
Look, my North Star for years, as you know, has been semis over software. I think we're in the early phases of that, not the long phases. The world can't function. The most important asset on earth is Taiwan Semi. Okay, world can't function without them. If something happens to the three fabs, you have depression followed by hyperinflation, right? So it starts and ends with Taiwan Semi. Can't function without them. There are software companies now that are big that who knows if they'll be companies in 5 or 10 years.
What about Broadcom? When you look at Broadcom, the fact that Broadcom's market cap has overtaken Meta, that's incredible, isn't it?
Well, Hock Tan and Zuckerberg are buddies. I mean, look, at the end of the day, I think compute broadly probably grows 3, 4, 5% above GDP for the next decade with higher margins, and the businesses are probably going to grow much faster over the next 18 months as data center spend's good. So I think you want exposure to semis. I think the question is the market right now parsing between cash flow generatives, AI exposure, and non-cash flow, or beneficiary or not. I don't really think I'm smart enough. I'm not Bryn. She is. I'm not smart enough to get these 3-month calls right on these big 8 stocks. Because as we just pointed out, Meta was everyone's favorite in January, and Google were the idiots losing share in search.
Well,
and now, 6 months later, the story's flipped and Zuck's a little crazy and everyone loves Google. So I just think you got to keep close to market weight the cohort because they're probably all going to outperform in aggregate.
What a great point, too, if you look at the chart over the last couple of months, 3 months or so of Oracle. Which was off to the races after its earnings report and the AI announcements and all that. Now we're watching the stock on a couple of fronts basically every day. The price of the stock, obviously, and now the cost of insuring against a debt default. Seema Modi's on that case again today, looking at both because both are a big story.
And Scott, just some color on the state of discussions. I've been hearing a credit investor at a reputable bank telling me this morning he's receiving more inbound calls from equity investors asking for clarity on this movement that we're seeing in Oracle's credit default swaps, what that tells us about the company's debt picture, how much more the company potentially needs to raise to fund its robust CapEx plans and the rapid development of data centers. Worth noting, Oracle's last debt raise of $18 billion was well received by the market. In fact, it was oversubscribed. So while there may be some more questions about Oracle's deployment of capital, there's clearly demand for it on the credit side. Now, separately, I spoke to D.A. Davidson's Gil Luria on the sell side. He expects that given the increase in commitments from OpenAI that were made subsequent to signing with Oracle, that it will need to reconsider the capital it's willing to raise and deploy. So if we actually see Oracle slow down its debt raises, that would be significant, Scott.
Yeah. Seema, thanks. A really big story that she really has been in the forefront of. Seema Modi, thank you. Bryn, I'll come back to you. Much ado about nothing. A market expressing a view in a short period of time that's going to be reversed. Not to mention the fact that Dell reports after the bell, which has been a story in and of itself in the whole AI trade too. How do you see those?
Well, I mean, I think Oracle is much ado about something. Something's called OpenAI, and I think they are, to me, are the most inextricably linked to OpenAI. And when you're like, this company is still nascent in its revenues, it's obviously negative free cash flow. Oracle's now going to go negative free cash flow to build this thing in the future. I think that has to be resolved. And I think, obviously, Larry Ellison has seen so many cycles. And I think with him still as chairman, there's a lot of they will get it done. But to me, as long as Oracle's trading cheaply, it's telling me that the market's more moving away from OpenAI and not thinking they're actually going to be able to pull off the $1.4 trillion over 5 years, which I think is exceptionally aggressive if they're able to do that. So I think it's a weak name that's telling us a lot of things.
Young, you agree with that? I mean, the stock move has been pretty extraordinary since the day it popped. You don't cover individual names, obviously, but what that represents was very much what was in the market last week. A good bit of fear about certain stocks within this orbit.
Yeah, I think the good news is a lot of these companies can pull back, right? Even though there are commitments, there's discussion, maybe some plans are underway. Not all this money's out the door. So I think there's a give and take here in the market, and these companies are going to take signals from the market. I think that's what people are thinking about or missing perhaps when I think there's just going to be too much overinvestment, that if there does look like there's signals in that direction, there can be some pullback in that regard. But I do think there's something real there that they do have to pay attention to.
I mean, I just focus on equities. So within the U.S. equity market, my interpretation would be if the bolus of companies don't raise CapEx, it gets killed. I think you need Goldilocks right now. it's still high.
No matter how you do it?
I don't think if they cut back on CapEx now, the market rewards that. It might be right medium to long term, but I think the short term will be, well, wait a second, I thought you were confident. So I think Oracle is just a weird one where every pod guy short it because it's the easiest one to short. They got to be neutral. And so they're saying, all right, well, this one's got a bunch of debt. And as Brent points out, it's more, in the future than everything else. And so Huberson debt caused the end of everything. I'll take something that looks like it's gaining share right now and long it against it. So I think it's a little more tactical, very short term on what's happened to Oracle in terms of it's the easiest big cap liquid one to short.
But you don't care, as long as the CapEx numbers remain solid, you don't care if it's using some cash, using some debt, whatever you got to do to stay in the race.
I think at this point, the CapEx has to slowly come up. It's Goldilocks. If it comes up too much, then I think it goes right where people freak out. But if it comes up a little and you still say the return profile is there, AI trade will be on for another 6, 9, 12 months.
All right, we'll leave it there. Brent, thank you. Young Yu, thanks
Brent. Happy Thanksgiving.
And Adam, you as well. And happy Thanksgiving to everybody. We appreciate you being with us once again. We're just getting started here. Coming up next, big money on the ice. The puck just dropped on CNBC's NHL team valuation list. We'll tell you who has the top spot. Might surprise you. And later, new developments in famed short seller Michael Burry's big battle with NVIDIA. We have the full details coming up. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC. Welcome back. CNBC out today with our annual list of NHL valuations. Average team now worth $2.2 billion, a 15% jump from last year. The Toronto Maple Leafs topping that list, valued at $4.3 billion, followed by the New York Rangers, Montreal Canadiens, Los Angeles Kings, and Edmonton Oilers. Joining us now, the man behind the list, CNBC senior sports reporter Mike Ozanian. It's good to see you. Welcome.
Scott, always great to be with you.
Surprise with Toronto or no?
No, not surprised with Toronto. They're going to get a new local TV deal next year. It's probably going to place them second overall in the league, only behind the Canadians, about $55 million a year annually. And one of the things we've seen with this list, Scott, like you'll notice, the Edmonton Oilers have usurped the Bruins.
Yeah, I was surprised by that more than anything else. How so?
The Canadian teams are getting increases in their local TV deals, while many of the U.S. teams are getting cut or staying flat. That's one of the big differences in driving revenue among the NHL
Is that
teams.
because the weakness that has persisted in the regional sports stats?
Exactly. The peak was 2019. S&P Capital's projecting several $100 million lower in RSN money by 2026. And what's happening is some of these U.S. teams switching to over-the-air or direct-to-consumer. Most of them aren't getting anywhere near the amount of money they were getting from the RSN. The Rangers took an 18% cut from MSG Network.
It's interesting because we normally look at national TV deals when figuring what that means for overall team valuations. Here you're telling me that the local TV deals have more of an impact perhaps than the broader deal with the major nets?
Yeah, I think when you're looking at the pecking order, the ranking within the league, it's the local TV and the gate. Like the Rangers get $180 million last year in net gate. The average for the league is $80 million. But to your point about the national deals, that's driving really valuations for all the teams because that money gets shared equally among all teams. The Canadian TV deal that starts next year doubled in value, and the U.S. TV deal, which is going to be up for renewal in 3 years, that also is expected to double. So the delta actually will be felt more by the bottom teams because their revenue's lower.
I was kind of expecting the Rangers maybe to be number one because of MSG. You know, you got the building, which presumably is worth more than I think it's the Rogers Center maybe where the Leafs play.
Great point, Scott. What a lot of people don't realize is MSG Entertainment, which is a separately traded public entity, they have a hard and fast lease agreement with the Knicks and Rangers that are part of MSG Sports. So MSG Entertainment gets a slice of that sponsorship, advertising, and suite revenue. Unlike the Maple Leafs, who own their building, like you said, so they just split it with the Raptors.
Glad to see my Washington Capitals on the list, at least number 9, $2.5 billion. Ted Leonsis and the gang doing a great job there. Mike, thanks.
Thank you,
That's
Scott.
Michael Ozanian. Appreciate that. For the complete list, check out cnbc.com/sport. Coming up next, famed short seller Michael Burry doubling down against big tech and raising the red flag on NVIDIA's financials. Now the company fighting back. We've got the details next. Welcome back. Closing bell now to the battle over AI, and one notable critic says it should really stand for artificially inflated. Michael Burry of Big Short fame in the thick of a throwdown now with NVIDIA. Christina Partsinevelos joins us now with more. This is an interesting back and forth. What do we make of this?
Well, NVIDIA right now is firing back, specifically at Michael Burry over accusations that big technology is cooking the books. So Michael Burry is the investor who called the housing crisis and claims companies are tech companies, I should say, depreciating AI chips over 6 years when they really just burn out in 2 to 3 years, which makes profits look bigger than they actually are. Depreciation actually spreads equipment costs over time, so longer lifespans means smaller annual expenses and higher profits. NVIDIA sent a rare private memo only to sell-side Wall Street analysts. I emphasize only, I'll explain in a second, but that explicitly names Michael Burry. The company says it's nothing like Enron or other accounting frauds. NVIDIA said also it doesn't hide debt, doesn't rely on vendor financing, and says 90% of sales come from profitable companies or customers like hyperscalers. NVIDIA also pointed to $22 billion in free cash flow last quarter, up 60%, which is higher than what Michael Burry was claiming. But it's interesting that NVIDIA only sent it to sell-side shops, the ones who publish reports on NVIDIA's share performance. Michael Burry responded on X saying he stands by his analysis and will release more details on his own timeline, but he hasn't delivered just yet. He is, though, promoting a newsletter, which is quite expensive, over $300 a year. Wolf Research, as well as Bank of America, saw their memo and wrote reports saying NVIDIA's days of inventory and accounts receivable numbers do look reasonable. So the fight matters because if Burry's right, big tech's earnings are inflated. If NVIDIA is right, which many argue is the case, the AI boom is stronger or has stronger economics than bears think.
Are you surprised at all that NVIDIA responded to Burry?
Yes. I think it has to speak to the stock's performance over the last little while. And also, if you look at NVIDIA's account, they also even commented on Google today. We know that NVIDIA shares have declined because of concern of Google TPU competition. Why, if they're the most popular kid at the school ground, do you just go and, pay attention to all the other people that are making fun of you or stuff like that? It's just weird that NVIDIA would be addressing all of these concerns from other people that, don't change the outlook. NVIDIA's demand is outpacing supply. They plan to hit $3 to $4 trillion in total addressable markets just in the next few years. Or they're being really defensive for a reason.
Well, I mean, others in this whole universe have been more defensive, I suppose, of late. I'm thinking of like Sam Altman against the short sellers, NVIDIA against Burry. You know what I'm saying? Like, we don't normally see it like that.
But this is a over $4 trillion market cap company with barely any of the float shorted. Why does NVIDIA even feel like it has to respond? Does it have to do with the fact that the share price has declined over the last little while, and this is really just about bringing that price back up?
We shall see. To be continued, because I don't think this is going away anytime soon, especially given the new Substack that Burry himself was teasing today. Christina, thanks. Christina Partsinevelos. Coming up next, Ed Yardeni. He breaks out his 2026 playbook. He'll tell us where he sees stocks heading in the new year. We're back right after this. Highs of the day for the Dow up 677 points. Got a nice boost midday again on that report that Kevin Hassett was said to be the front runner to be the next Fed chair. Rates came down. The 10-year sitting right at 4%, dipped below that level. First time, or the lowest at least, since October. We'll stay on it right until the close. We're back after this. Welcome back. At least one big-time bull says the Fed won't cut in December and won't cut that much next year either. And stocks will still climb even higher. Ed Yardeni is the president of Yardeni Research, joins us now. It's good to see you. You don't shy away from controversial takes. Some might find this to be just that. Why do you think this market can go higher even if the Fed does little?
Well, I think that if the Fed does cut rates, we'll have to watch what the bond market does, because last year when the Fed cut the Fed funds rate by 100 basis points, the bond yield went up by 100 basis points. I think much will depend on the ongoing data here. We do still get initial unemployment claims. We got retail sales numbers today, which are a little bit on the weak side, and the PPI was not too hot. So I'm not committed, to this notion that the Fed isn't going to cut. I mean, I go with the market's perceptions right now, and so I wouldn't say that it's not going to happen. But I don't think it needs to happen for the market to go higher, because earnings have been phenomenally strong. First, second, and third quarters of this year, analysts expected low single-digit increases in earnings. They came in at 10 to 15%.
But you don't want the Fed to make a mistake, even if all of that is correct, right? I mean, you don't want them to make a mistake. The unemployment rate is up. That's got some people nervous. If they wait too long, they get way behind the curve. That's a mistake, and the market would pay for that.
Well, I think you're right about that, and that's apparently increasingly the perception at the Fed and increasingly the perception of the market. I think the labor market has problems that aren't necessarily going to be solved by lowering interest rates. The idea of lowering interest rates is to stimulate demand, economic demand for goods and services that then boost the demand for labor. The problem with that thesis right now is GDP looks like it's growing around 4% in the second and third quarters. Demand is very strong, and yet the labor market is weak for a lot of reasons that probably defy any solution from the Fed. A lot of it has to do with retiring baby boomers, skills mismatch, a lot of inexperienced workers, and I think companies are going full bore increasing productivity. That's why GDP is rising faster than payroll employment.
Yeah, but I mean, some would say, yeah, well, imagine what would happen to housing and how that would be freed up pretty dramatically if the Fed was able to cut rates more than one time. It's been all but a non-player. It's been a non-starter.
Correct. Well, the same story was told at the end of last year, right? The Fed cut interest rates and bond yields and mortgage rates stayed up. Maybe this time around it'll be different. Inflation is still stuck around 3%. It's not at 2%. And it's not clear whether the bond market is going to give it a pass and say, all right, we're going to get down to 2%. I mean, you're making a good point. Clearly, everybody's swung to the idea that what's the big deal if they lower rates? You reduce the risk of things getting weaker, and if inflation remains persistent, then you raise rates. I think that's kind of the mentality at the Fed right now.
I mean, it's not like a quarter point's going to do much of anything, except
I don't think so.
Except, practically speaking, maybe not, but except it helps with the narrative that the Fed's on the case. The market can at least take some comfort with the fact that the Fed is less likely to make a potential mistake if they do it.
Yeah, my main concern about lowering interest rates when the economy seems to be living with the current level of interest rates, broadly speaking, we still have rolling recessions in places, but my main concern is a melt-up in the stock market, and that was less of a concern last week, and now, how quickly things can change. Now suddenly all this talk about the Fed being back is with me, but I just don't want to see this turn into a melt-up, melt-down situation.
No, I hear you. I mean, in many respects, too, the wealth effect created by the stock market going up has helped the economy stay pretty strong in the face of a very much bifurcated consumer picture, too. Ed, you have a great Thanksgiving, okay? I'll see you soon. I know I will.
Thank you.
You be well.
Absolutely.
That's Ed Yardeni. Up next, we'll run you through what to watch for from HP and Dell. Those names are reporting in OT, as you know. The Market Zone's next. Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli and 314's Warren Pies here to break down these crucial moments of the trading day. Plus, two big earnings reports in OT. SEMA is covering HP. Christina is covering Dell. Mike, I begin with you. We got 700 for the Dow. We got 2.25% for the Russell. We got a decent move back in the NASDAQ, too, which looks to me to be at the highs of the day. This is a pretty nice move yet again.
Yeah, there's definitely progress on the whole repair from last week's rupture. You know, coming into the week, Scott, I was saying, you know, are we building a more balanced bull? That was my line.
Right.
And it's kind of working according to plan, meaning the market attacked a lot of the AI excesses. It purged a lot of the low-quality froth, reset positioning, you know, kind of got everybody's expectations back into line and restored the ability for pleasant surprise. So now you get, you know, obviously dovish Fed rhetoric and expectations coming back into the market, which helps, but I think mostly just to remove that, like, doomsday scenario. And we melted down into the end of the year. So we're right back at Thursday's high on the S&P 500, right before we fell off that little cliff after the NVIDIA move. So a lot has been done. You know, I still think we're in convalescence mode. You have to be aware that there's upside still to the old highs, and you don't want it to necessarily get too wild in the next 2 days. But everyone knows the history. The days around Thanksgiving tend to have an upward bias.
Tighten that S&P up again for us, guys, please, and to control them, because you've been talking about V-shaped recoveries.
Yeah.
Look at that. That's a V. This has become very much, I know it's not March Madness time, but survive in advance.
Yeah, no doubt.
Survive the tremor, and then here we go, and we advance.
And even today, I was saying earlier, you saw that drop in NVIDIA. And there's times when NVIDIA is down 5+%, the rest of the tape's not taking care of it. Today, no real problem. We got non-tech kind of rising to the occasion, and that's allowing the VIX to bleed below 19. And so everything starts to fit together when a lot of that rotation happens.
Well, thank you, Alphabet and Apple. New highs for those stocks, too. Seema, tell us about HP.
Okay, Scott, the big concern is going to be around margins. Morgan Stanley recently lowered its price target on HP from $24 to $21 a share, maintaining an underweight rating on this idea that rising prices of memory chips will challenge margins of the hardware players like HP. Analysts there also referencing the last cycle in which memory spot prices of DRAM and NAND went up from 2016 to 2018. At that time, hardware players had to respond by raising device prices, though not fully enough to offset the cost. That may already be priced into shares of HP, which are currently down about 25% this year. More coming out when earnings hit at 4 p.m., Scott.
All right, Seema, thanks so much for that. Christina, how about Dell?
Oh, it's going to be very similar to what Seema just said. The big focus is whether soaring memory chip prices are going to squeeze profit margins. Memory accounts for roughly 10 to 70% of the bill of material, depending on the product. So AI servers, for example, it's a lot cheaper. The issue is that Dell's gross margins estimates have barely budged despite these higher memory costs, setting up for a potential for a miss for margins. But there's definitely a bullish counterargument. Dell's inventory did climb. It was under $4 billion to over $7 billion, suggesting they stockpiled memory chips ahead of price increases. And competitor Lenovo just reported that memory pricing isn't hurting their margins, saying they remain confident about the outlook. Beyond margins, though, investors are going to be watching AI server guidance. The company needs about $10 billion in the second half to hit their $20 billion full-year target. And the earnings actually are going to reveal Dell's inventory, whether it worked or not, or if they're about to face some serious margin pressure. Scott?
We shall see. Christina, thanks very much for that. That's Christina Partsinevelos and, of course, Seema Modi. Warren Pies, I'll bring you in. You say there were some signs of capitulation last week. Tony Pasquarello put out a note suggesting the same. Maybe it just looks a little different than historically we're used to.
Yeah, thanks for having me. Yeah, we upgraded equities at the end of last week to overweight, and we expect new all-time highs. Good chance to surpass 7,000 before the end of the year. You know, I'll just give you a few things to think about. Our sentiment model, which is it takes like as many of the most important positioning and sentiment things that we look at. It's registered extreme pessimism, so that's important. Specifically, we look at inverse ETF volume as a way to look at retail capitulation. This speaks to something Mike was talking about. We saw inverse ETF volume spike up to the highest level we've seen in 2 years outside of Liberation Day, and those have always marked near-term bottoms. The other thing I would bring up is that under the surface, there was a lot of pain, really, in this pullback. Even though the index was down 5%, maybe a little more than 5% peak to trough, the median stock was down more than 16% from a 52-week high. So if you back out and look at what does that usually imply for the index, that's usually closer to a 10% correction. So when I put all of that together and then combine it with where we're going seasonally, I think we're set up for a very strong end of the year.
Mike, that mess with you?
Yeah, for sure. Tactically, that does all fit together. I do think that the idea that we sort of talked ourselves into this notion that the Fed was going to choke things off, and maybe the economy was seen to be a little bit weaker. We were looking on
and
the
AI is a
downside.
bubble.
The other
whole
piece
thing.
of it, I'll say, is as we've been in this process, right? So we're at the levels the S&P reached, October 9th or something like that, a month and a half ago. In that month and a half, we've gotten through an earnings season. We've rolled forward where the 12-month forecast is. It's higher, therefore you've sanded the edges off the valuation concerns to some degree. And so, yeah, I do believe that there is room. Again, whether it means we're going to get all exuberant again, whether this rotation toward the equal weight S&P, which is up 1.5% today, after, by the way, starting today at almost dead flat on a 12-month basis, that remains to be seen. But I do think you basically have to sort of, I always say, keep expectations low, but be open-minded about how far these things can go once they start to run.
Not to mention, so much for that narrative that the Russell can't get out of its own way, Warren. You look now, we've eclipsed a 10% gain year to date for the Russell 2000. We're at 10.7% now.
Yeah, I mean, it's encouraging. I think it's encouraging to see equal weight and Russell do well. I think you have to understand the bet you're making. If you're going to be long Russell 2000, it's very much a rates bet. So it's one of the things we decompose instead. Of all the subsegments of the market, the Russell is the most sensitive to these rate moves. So yeah, we're down to 4% on the 10-year. If you're long the Russell here, you're betting on rates continuing to fall at this kind of glide path lower and economic growth hanging in there and being sort of robust. It's a needle that needs to be thread, and it's healthy for one day to see it doing this. But again, this is not. I've been on with you many times saying this is not where I would put my chips right now.
Is the best hedge on all this gold again? Are we back? Are we going to be talking about this again?
Yeah, we like gold. We've liked it all year. I think this is a secular bull market. We had a 9% pullback. We went from record outflows of the GLD ETF, something we watch for retail sentiment, and now we have outflows. So it kind of goes with what we saw in the equity market. We had to go through something to work off this excess sentiment. You're getting these reports of Kevin Hassett being the next Fed chairman. I mean, we're not here to make normative policy, and my job is to navigate markets. But when I look at that, I think that when you have really an extension of the administration coming into the Fed, that's going to create the environment where I think gold is going to have another strong year next year. That's a conviction prediction for us.
How are you watching this chart, Mike?
I think that all fits together. I think it's also been impressive the way that gold has just kind of hung in there fine as Bitcoin got wrecked.
Well, I was going to ask about that.
And the fact that Bitcoin is hanging in there is fine. I think it's a prerequisite for this market to actually kind of rebuild. What's also interesting, Warren was talking about the volumes in inverse ETFs as a sign of retail capitulation. This was not a dip, in my view, that retail stepped in and really bought aggressively and was ahead of the pros on, because they were really impaired by what happened in crypto. If you look at the kinds of stocks that are working today, they're not the retail favorites. And so maybe we're kind of past that moment when we lionize the risk-seeking individual traders as if they always get it right. Sometimes you actually have to be humbled and have the market reset in a different direction.
Yeah, we'll see if they regroup, so to speak, and come back in, because retail has been a pillar of this bull market. Warren, what about Bitcoin? How are you watching that?
Yeah, I mean, I think that it's a show and tell type of situation for Bitcoin. We have seen the outflows there, just similar to the GLD ETF. I prefer gold over Bitcoin in this environment, but theoretically, Bitcoin should do well. I look at it more from Mike's perspective, exactly what he said, which is this is a proxy for retail risk appetite. And I think that even though the market was only down 5% peak to trough, this goes to that median drawdown stat, is that everything around the edges, all that speculative froth, I mean, Bitcoin down over 30%, crypto, the whole crypto complex collapsing, DATs, digital asset, or digital treasury companies, those all getting hit. I think this is a great sentiment gauge and sets us up for a reset for the market more generally.
All right, man, I appreciate you. Have a great Thanksgiving. Mike, I'll see you on the other side of the holiday as well. Bell rings.
fade. Pre-holiday, Dow's going to go out better than 600. I'll see you on the other side of that into overtime. With Morgan and Jeff.
More green on the screen. Welcome back to Overtime. The housing trade seeing a nice pop today on increased hopes for a December rate cut. That is the end of regulation. The Epilepsy Foundation ringing the closing bell at the New York Stock Exchange. United Worldwide